Are you ready to dive into the world of cryptocurrencies and take your knowledge to new heights? Then you're in the right place. In this video, we present you to a comprehensive and engaging cryptocurrency full course brought to you by Simplilearn. Cryptocurrencies have taken the financial world by storm, and it's crucial to stay ahead of the curve. Throughout this course, we will unravel the mysteries surrounding cryptocurrencies and equip you with the knowledge and tools you need to navigate this exciting field. We'll cover everything you need to know, including the history and technology behind cryptocurrencies, blockchain fundamentals, popular cryptocurrencies like Bitcoin and Ethereum, and underlying mechanisms that make them work. But that's not all. We'll also delve into the topics like cryptocurrency mining, wallets, and exchanges, giving you a practical insight into how to engage with cryptocurrencies securely and efficiently. Our expert instructors will guide you through hands-on demonstration and real-world examples, ensuring that you gain a comprehensive understanding of this fascinating domain. In addition, we will discuss the impact of cryptocurrencies on various industries and the potential they hold for the future. You'll discover how cryptocurrencies are revolutionizing finance, fostering innovation, and creating new opportunities for businesses and individuals alike. So why wait? Let's embark on this exhilarating adventure together. But before we dive in, if you're looking to take your career to new heights and become a true expert in the realm of blockchain and cryptocurrency, consider checking out our professional certificate program in blockchain in collaboration with IIT Kanpur. It's an excellent opportunity to master key architectural principles and develop the skills needed to excel in this rapidly growing field. And if you're ready to be inspired, here's a success story that showcases the incredible potential of cryptocurrencies.
I always believe in upgrading myself. Upskilling not only helped me with a knowledge boost, but also helped me to reach new heights in my professional career. I'm currently the Chief Technology Officer at O3 Technology Solutions, New York, USA. We serve our clients in the banking, finance, and insurance sector. Hi, I'm Radhakrishna Mothukuri. I have 25 plus years of experience in the information technology domain. I work for large organizations like IBM India, Tata Infotech, Sun Microsystems, Gulf Business Machines in Dubai. After working for almost 14 years in Dubai at GBM, I wanted to make a career change. And to do that, I had to improve my portfolio. That's why I chose to upskill myself and decided to take professional certification program in blockchain from IIT Kanpur offered by Simplilearn. After completing the course, I was able to make a complete paradigm shift to my career. Grew to the position of CTO. Combination of skill set like artificial intelligence, machine learning, cloud computing, and especially blockchain is the reason my management thought I am the right fit to the position of CTO. The course helped me understand the end-to-end architecture side of it, which gave me ample knowledge about programming in Solidity and understanding the different blockchain platforms, technologies and functions like cryptography, cryptocurrency, NFTs, tokenization, decentralized finance, and decentralized applications. After completing the course, I'm definitely more confident about connecting with clients, understanding the problem statements, and coming out with solutions. I'm a fitness enthusiast. When I was in Dubai, I got into fitness. I lost 20 kgs of weight in 4 years. What my fitness journey taught me was to achieve something in life, you need to keep pushing and improving yourself. The funny thing is that I am a foodie too. I love to eat good food. So basically, I exercise to eat good food and still stay in shape. The same philosophy applies in everyone's professional career as well. One needs to keep upskilling and continuously try improving their skill to grow as a professional. I strongly recommend gaining new skills regularly to stay relevant and to achieve your career goals.
So if you want to explore more captivating videos like this one, don't forget to subscribe to our YouTube channel and hit the bell icon to stay updated with the latest content from Simplilearn. We are committed to providing you with high-quality educational material that keeps you engaged and ahead of the curve.
Meet Frank and Daniel. One day they decide to go for a trip to Venice. They made a budget list for all their expenses like residence, flight, etc. They thought of making their bookings online from a site that offered discounts to the first 10 visitors on that day. While making their respective flight bookings, Daniel's transaction failed, and he missed the offer going on. On the other hand, Frank paid his share very quickly and easily, and became one of the 3 lucky draw winners. Daniel was surprised and asked Frank how he could make the transaction when Daniel himself could not. To which his response was, "It's simple. I used Bitcoin, a type of cryptocurrency." Daniel was confused, and he asked what cryptocurrency is, and since when has it been in use? Frank stepped up and explained to him. Cryptocurrency is a virtual or digital currency that works on blockchain technology and is designed to work as a medium of exchange online to buy goods and services and make payments, which was introduced to the world first in 2013 by Satoshi Nakamoto. Daniel felt that it sounds similar to other online payment options. He asked what makes it so different. Frank explained, cryptocurrency is decentralized and free from any third-party interference, which means it is not issued and controlled by any government or central authority, unlike other payment systems that banks or governments are handling. And that's why a cryptocurrency transaction never fails. There could be many reasons for why Daniel's transaction failed, like he may have exceeded his transfer limit, or his account must have been hacked, or there could have been some technical issue with his bank server, or maybe due to high transaction fees imposed by the bank. But on the other hand, cryptocurrency charges almost no or very low transaction cost. There is no limit for making transactions. In fact, you have 24/7 access to your money. There is no extra delay or extra charges on making international transactions. And the best part is that anybody can use cryptocurrency without the hassles of paperwork. All you need to do is create an account on any digital wallet of cryptocurrency. This is what makes cryptocurrency different from other online payment options. Daniel was impressed by cryptocurrency, but he wondered how it works without the control of an external authority. Upon research, he found out that cryptocurrency works on blockchain technology. Blockchain is a set of blocks that record information of transactions, like who made the transaction to whom, the amount of trade in the form of a digital ledger that is distributed across the entire network, meaning the data is replicated and stored on each node across the entire blockchain network, making it more secure and impossible to change, hack, or cheat the system. Then it is verified and validated by every node to proceed with the process of making the transactions. The crypto in cryptocurrency stands for cryptography, which is a method of using encryption and decryption to secure the data in the presence of any third party with ulterior motives. Now Daniel was completely aware of the whole technology and concept behind cryptocurrency, and was influenced by Frank to adopt cryptocurrency in his daily lifestyle too. He did that by booking his ticket, but sadly, no discount. Like Daniel, cryptocurrency has influenced and impacted an enormous number of people worldwide. Due to this increasing popularity, new companies like Meitu and PayPal are coming forward and investing in cryptocurrency every day. In 2018, Malta, an island located in the Mediterranean Sea, south of Italy, was titled Blockchain Island, as it led to the economic stability of the nation. Many fintech companies like Binance and OKX have already begun to take advantage of Malta's financial incentives and have moved their headquarters to the blockchain island.
Since man evolved, currency has been a very important part of our lives. In the caveman era, they used the barter system. Now the barter system involves goods and services being exchanged among each other. So now we have a situation where a caveman is exchanging 7 apples and getting oranges in return. Now the barter system fell out of use because it had some glaring flaws. Now these flaws include having people's requirements coincide. For example, say you have 5 apples and your friend has 5 oranges. You want some of his oranges. Now until and unless your friend has a requirement for the apples that you own, he'll not be ready to make an exchange for it. There's no common measure of value. Now since there's no common measure in terms of which value of a commodity can be expressed, there's a problem when you have to decide how many apples you're ready to trade for 1 orange or a mango. Not all goods can be divided or subdivided. For example, you can't divide a live animal into different smaller units. The goods cannot be transported easily. Now unlike how modern currency fits in your wallet or your mobile phone, the goods that you own cannot be taken with you everywhere you go. After realizing that the barter system didn't work very well, currency went through a few iterations. In 110 BC, an official currency was minted. In 1250 AD, gold-plated florins was introduced, and this was used across Europe. And from 1600 AD to 1900 AD, paper currency gained widespread popularity and was used across the world. This is how modern currency, as we know it, came into existence. Modern currency included paper currency and coins, credit cards, and digital wallets. For example, you have Apple Pay, Amazon Pay, Paytm, PayPal, and so on. All of this was controlled by banks and governments. Now, this means that there was a centralized regulatory authority that limited how paper currency and credit cards worked. Now imagine the scenario of doing an online transaction. Here you're thanking your friend for paying for your lunch and you're saying that you're sending them money to their account. Now this transaction takes place successfully, but there are several ways where this could have gone wrong. There could have been a technical issue at the bank. For example, their systems could have been down, the machines weren't working properly and so on. That means there's a central point of failure, which is the bank. The users' accounts could have gotten hacked. For example, there could have been a DDoS attack or identity theft and so on. Or the transfer limits for that account were exceeded. This is why the future of currency lies with cryptocurrency. Now imagine the transaction between two people in the future. One of them has the Bitcoin app and there's a notification asking whether they're sure they're ready to transfer 5 Bitcoins. If yes, processing takes place. Here we're authenticating the user's identity, checking whether they have the required balance to make that transaction and other things. Now after that's done, the payment is transferred and the payment is received. All of this happens in a matter of minutes and is as simple as that. This in turn removes all the problems of modern banking. There's no limits to the funds you can transfer, your accounts cannot be hacked, and there's no central point of failure. Now, as of 2018, there's more than 1600 cryptocurrencies available. Now, there are some popular ones like Bitcoin, Litecoin, Ethereum, and Zcash. And a new cryptocurrency crops up every single day. Now, considering how much growth they're having at the moment, there's a good chance there's plenty more to come in the upcoming years. So what exactly is cryptocurrency? A cryptocurrency is a digital or virtual currency that is meant to be a medium of exchange. Now, cryptocurrency is quite similar to real-world currency, just that it does not have any physical embodiment. It also uses cryptography to work the way it does. Now, some of the features of cryptocurrency are that there's a limit to how many units can exist. With Bitcoin, this limit exists at 21 million. Now, after this, no more Bitcoins will be produced. You can easily verify the transfer of funds. Now, the hashing algorithms that Bitcoin uses makes it very easy for users to determine whether a transaction is valid or not. They operate independent of a bank or a central authority. They work in a decentralized manner. Now, new units can be added only after certain conditions are met. For example, for Bitcoin, only after a block has been added to the blockchain will the miner be rewarded with Bitcoins. And this is the only way new Bitcoins can be generated. So what makes cryptocurrency so special? Firstly, there's little to no transaction costs. Now, if you use the digital wallet, you'll know that if you're transferring money from your wallet to your bank account, you'll lose some amount of money. You have 24/7 access to money. You can't just walk up to your bank at 3 a.m. in the morning and say that you want to withdraw some money. There's no limits on purchases and withdrawals. There's freedom for anyone to use. For example, if you're setting up an account in your bank, you need to do some amount of paperwork and documentation. With cryptocurrencies, all of that can be avoided. International transactions are faster. Now, wire transfers take about half a day to transfer money from one place to another, but with cryptocurrencies, it only takes a matter of minutes or seconds. What's the crypto in cryptocurrencies? Crypto refers to cryptography. It's a method of using encryption and decryption to secure communication in the presence of third parties with ill intent. Now, this refers to third parties who want to steal your data or want to eavesdrop on your conversation. Cryptography uses computational algorithms like SHA-256, which is the hashing algorithm that Bitcoin uses, a public key, which is like a digital identity of the user, which he shares with everyone, and a private key, which is the digital signature of the user, which he keeps hidden. Now let's talk about a normal Bitcoin transaction. First, you have the transaction details. Now this details who you want to send it to and how much Bitcoins you want to send them. Then it's passed through a hashing algorithm. For Bitcoin, we use the SHA-256 algorithm. The output that you obtain is passed through a signature algorithm with the user's private key. Now this is used to uniquely identify the user. This output is then distributed across the network for people to verify. This is done by using the sender's public key. The people who verify the transaction to check whether it's valid or not are known as miners. Now after this is done, the transaction and several others are added to the blockchain where it cannot be changed again. If the concepts of hashing seem a little difficult to you, I would suggest you click on the top right corner and watch the blockchain explain video so that you can understand better. Now the SHA-256 algorithm, like I told you earlier, looks something like this. Now seeing how complicated it looks, I'm sure it's safe to say that the encryption is very difficult to hack. Today we'll be focusing on two major cryptocurrencies, Bitcoin and Ether. Now Bitcoin is a digital currency that is decentralized and works on the blockchain technology. It uses a peer-to-peer network to perform transactions. Let's talk about Ether. Ether is a currency that's accepted in the Ethereum network. Now, the Ethereum network uses blockchain technology to create an open source platform for building and deploying decentralized applications. Now, let's talk about the similarities between Bitcoin and Ether. They're the biggest and most valuable cryptocurrencies in the market right now. Both of them use blockchain technology, but there's nothing but a technology that involves transactions being added to a container called block and creating a chain of blocks in which data cannot be altered. Currency is mined using a method called proof of work, which is a form of mathematical puzzle that needs to be solved before a block can be added to the blockchain. Finally, these are widely used across the world. Now, let's talk about the differences. With Bitcoin, it is used to send money to someone. This is very similar to how real-life currency works. With Ether, it is used as a currency within the Ethereum network, although it can be used for real-life transactions as well. Bitcoin transactions are manual, which means you have to personally perform these transactions. With Ether, you have the option to make these transactions manual or automatic or programmable, which means that these transactions will take place when a certain condition has been met. For Bitcoin, it takes 10 minutes to perform a transaction, which is the amount of time it takes for a block to be added to the blockchain. With Ether, it takes about 20 seconds to do a transaction. Now, blockchain is used like money for real-world transactions, and Ether is used to power the Ethereum network and power real-life transactions as well. Ether is used as fuel within the Ethereum network to power both of these things. Now, there's a limit to how many Bitcoins can exist, which is 21 million. We're supposed to hit this number by the year 2140. Ether is expected to be around for a while, but not to exceed 100 million units. Now, Bitcoin is used for transactions involving goods and services, and Ether uses blockchain technology to create a ledger to trigger a transaction when a certain condition is met. For Bitcoin, we use an algorithm called SHA-256 for hashing, and with Ethereum, we use ETH. As of July 23, 2018, 1 Bitcoin equals $7,668. For Ether, it costs $464. Now, what's the future of cryptocurrencies? The whole world is clearly divided when it comes to cryptocurrencies. On one side, you have supporters like Bill Gates, Al Gore, and Richard Branson who say that cryptocurrencies are better than regular currencies. On the other side, we have people completely against it. People like Warren Buffett, Paul Krugman, and Richard Schiller, who are both Nobel Prize winners in the field of economics. They call it a Ponzi scheme and means for criminal activities. In the future, there's going to be a conflict between regulation and anonymity. Since several cryptocurrencies have been linked with terrorist attacks, governments would want to regulate how cryptocurrencies would work. On the other hand, the main emphasis of cryptocurrencies is to ensure that their users are kept anonymous. By the year 2030, cryptocurrencies would occupy 25% of national currencies, which means a significant chunk of the world would start believing in cryptocurrency as a mode of transaction. It's going to be increasingly accepted by merchants and customers, and it will continue to have a volatile nature, which means prices will continue to fluctuate like they have been for the last few years.
Quickly go through the agenda slide. So first we will have a quick introduction to what is cryptocurrency. Following that, we will have a crisp comparison between coin and token. Then we will look into the types of cryptocurrency. And at the end of the video, we will explore why do we need to have so many types of cryptocurrency. So let's start the video. So the first thing that we are going to understand is what is cryptocurrency. Now, a digital payment system known as cryptocurrency doesn't rely on banks to validate transactions. Peer-to-peer technology makes it possible for anybody, anywhere to send and receive payments. Payments made using cryptocurrencies do not exist as actual physical coins that can be transported and exchanged. Rather, they only exist as digital entries to an online database that details individual transactions. Now, a public ledger keeps track of all these cryptocurrency transactions that involve money transfers. Digital wallets are where cryptocurrency is actually stored. So now that we know what cryptocurrency is, let's break it down and compare the two most basic forms of cryptocurrency, that is, coin and token. Now, coin and token are phrases that are regularly used while talking about cryptocurrencies, but there is a distinction even if they may sound similar. So maintaining their integrity is crucial. So now let's have a quick look at the differences. So the first one is a digital coin functions similarly to traditional currency and is created on its own blockchain. It can be used as a means of trade between two parties conducting business together and a way to store value. Bitcoins and Litecoin are a few examples of coins. On the other hand, tokens are much more versatile than merely digital currency. Tokens can be used as a software application component, such as to allow access to an app, confirm identification, or track goods as they move through a supply chain. They are generated on top of an existing blockchain like NFTs. They can represent digital art. Second is, coins require significant resources and skills to create themselves. whereas tokens are relatively easy to create. Third, coins are mostly distributed using the mining process, and tokens are distributed using ICOs. Coming to the next one, coins are used to store and transfer money. On the other hand, tokens are used for various purposes like security and asset representation. And the fifth is coins can be validated by any merchant who uses them, and one merchant validates tokens. So now that we have reached the most crucial part of this video, the types of cryptocurrency, let's discuss them one by one. So despite being used to describe all varieties of digital or cryptocurrency, the term cryptocurrencies is frequently used interchangeably with coins. They are frequently considered as such, even though most of them, aside from Bitcoin, does not function as a unit of account or a store of value or a medium of exchange. So technically, there are 8 types of cryptocurrencies: security tokens, utility tokens, payment tokens, exchange tokens, non-fungible tokens, DeFi tokens or decentralized finance tokens, stablecoins, asset-backed tokens, and privacy tokens. So let's start with the security tokens. Now these cryptocurrencies are securitized and derive their value from an external asset that can be sold as security by financial regulations. As a result, they are utilized to securitize the tokenization of real estate, bonds, stocks, real estate, and other currencies from the real world. To protect user investments, financial regulators must therefore supervise and regulate the exchange, issuance, dealings, values, tokenization, backing, and trading of transactions due to their nature. Now, security tokens basically stand in for an interest, a share of stock or equity, voting rights, and a dividend right in the asset they represent. Owners or holders share in the profits made by the issuers or managerial choices. Through security token offerings, they are distributed. Now, they can be used when investors require immediate settlement, open management, asset division, or etc. Now, security tokens are further divided into equity tokens and asset-backed tokens. Now, equity tokens resemble conventional stocks in appearance and operation, except that ownership and transfer are carried out digitally. Dividends from managerial and issuer choices and actions are due to investors. Debt tokens represent short-term loans with fixed interest rates. Now, coming to asset-backed token, these have an underlying worth that is supported by actual real estate, works of art, carbon credits, or commodities. They possess qualities similar to those of gold, silver, oil, etc. They can be exchanged, etc. Examples of security tokens are SIA funds, BCAP, and Science blockchain. Now, following security tokens, we have utility tokens. Now, utility tokens are simply digital units that reflect a value on the blockchain and are sometimes thought of as a coupon or vouchers. To put it another way, the token grants specific access to a good or service offered by the token issuer. By purchasing the token, a person can acquire access to the product or service and exchange it for a specified access value. Now, the holder does not get ownership, but rather the right to a good or service with an equivalent value to the token. For instance, as long as they own the token, they can access the good or service for a reduced cost or for free. In some jurisdictions, a cryptocurrency classified as a utility token is exempt from financial regulations. Now, some of the examples of utility tokens are Funfair, Basic Attention Token, BrickBlock, Timmycoin, Shirin Lab Token, and Golem. So, following this comes payment tokens. Now, payment tokens are used to transact directly between buyers and sellers. So, the products and services on digital marketplaces as opposed to via middlemen, as is common in traditional banking and finance. Of course, the bulk of cryptocurrencies and tokens fit within this category. whether they are security or utility tokens. Not all the utility tokens can also function as payment tokens. Now, payment tokens are not securitized and cannot be purchased as such. As a result, they're not considered asset securities subject to financial regulations. They might or might not ensure holders access to any present or future goods or services. Example of payment tokens: Monero, Ethereum, and Bitcoin. Next is non-fungible tokens. Now, a non-fungible token is a blockchain-based digital certificate of ownership for a singular non-replaceable item or one that cannot be traded with another asset. It is created using the same technology as other types of tokens. Still, it is primarily used to represent a work of art, images, audio, video, collectibles, real estate, virtual words, memes, GIFs, digital content like posts and tweets. Now, NFT marketplaces like OpenSea, Rarible, Foundation, and Decentraland are where you may buy and sell them. Popularity, monetizing goods, royalty payments. Whenever their work is sold to a new user, partial ownership of expensive assets, auctioneering to raise money, creating memorable moments, or preserving histories for market motives like trading and celebrity issuing are all included in this application. Now, some of the examples of NFTs are Logan Paul's videos clips, Twitter founder Jack Dorsey's first tweets NFT, every day is the first 5,000 days drawing by Mike Winkelmann, better known as Beeple, and several crypto kitties. Now, following that, we have DeFi tokens, or we can call decentralized finance tokens. Now, decentralized finance refers to the financial applications or dApps built on the blockchain or distributed ledger, which makes them distributed, and those that render financial and money control directly to the user while allowing them to transact globally with peer-to-peer methods and access to global markets. Now, anyone with internet access can access these DeFi apps. Each DeFi app runs on a token economy that is supported by a native token. These tokens are a programmable currency where developer may add logic to how transaction and payments are made. Aave, Chainlink, Uniswap, Polkadot, and Solana are just a few examples of popular decentralized finance tokens. Now, decentralized exchanges, storage sharing, and apps for lending are some examples of DeFi application types. Following this, we have stablecoins. Now, these tokens are of stable value in nature, as their nature implies, meaning that their value is reasonably predictable, in that it essentially never changes. Stable tokens or stable coins, as they are more commonly known, are backed by an asset with a relatively consistent value, such as cash. So we have stable coins that are pegged to the dollar and the euro, as well as tokens backed by commodities like oil, gold, and other precious metals. Stablecoins assist in eradicating assets or even other digital currency instability. Stablecoins include Paxos and Tether, which are all backed by USD cash in a 1-to-1 ratio, along with TrueSD, Gemini Dollar, and USD Coin as stablecoins backed by gold, Keto Gold, Tether Gold, DGX Global, and Gold Coin. Then comes asset-backed tokens. Now, the term asset-backed tokens refers to a class of cryptocurrency whose underlying value is supported by a real-world asset, such as cash, stocks, bonds, property, gold, and precious metals. On blockchain, they are utilized to represent and trade the value of these underlying assets digitally. So, due to the way the underlying assets are used in transactions, most of these are provided as security tokens. The equity token offer is the primary method of issuing them. Examples of asset-backed tokens are oil coin, which tokenizes barrels of oil held in reserve, petroleum coin, ZN Inc. oil token, etc. The energy web token, tokenized energy, green energy token by WVPP, etc. are some of its examples. And now comes the last but not the least, that is privacy tokens. Now, these cryptocurrencies are used for privacy applications, as their name implies, because they have superior privacy promoting programming to Bitcoin and other popular cryptocurrencies. Better anonymity in crypto transaction is necessary for various reasons, including the right to privacy, security investigations, and extremely sensitive transactions, yet they are also utilized in fraud and crime. These cryptocurrencies use a variety of strategies like currency mixing, offline transactions, and anonymity mechanisms like CoinJoin to ensure transaction privacy. Some of the examples of privacy tokens are Monero, Zcash, Dash, Horizon, Beam, and Verge. So now that we have covered all the necessary types of cryptocurrencies, now let's understand why we need so many types of cryptocurrency. So since the source code for blockchain technology is available to everyone, any software developer can utilize it to build new things. Developers have done just that. At the time of this writing, there are reportedly more than 10,000 different cryptocurrencies in use, and the number keeps rising. For comparison, just 4 years ago, more than 1,000 cryptocurrencies existed. There are so many cryptocurrencies now because of the underlying blockchain technology. It allows programmers to design various coins with a range of features. In this video, we are going to cover all important concepts and components related to proof of work. First, we will have a quick introduction of blockchain. Then, we will understand what is proof of work. Then, we will look into how does it works. And after that, we will explore why is it actually needed. What are the issues faced by proof of work? And at last, we will look into the blockchains working with proof of work. So without further delay, let's get started with the video. But before that, let's have a quick introduction to blockchain. The term blockchain refers to a decentralized database that is made up of sequential blocks that contain recorded data. The database is backed up by a network of self-contained participants known as nodes. Now, let's understand what is proof of work. Proof of work is a decentralized consensus method that requires network participants to spend time solving an arbitrary mathematical puzzle in order to prevent the system from being hacked. It is widely used in cryptocurrency mining for validating transactions and mining new tokens. It helps in the processing of peer-to-peer transactions securely without the need of a trusted third party. It also requires huge amount of energy at scale, which only increases as more miners join the network. Now, let's have a look at how proof of work works. The right to add new blocks to a proof of work blockchain is provided to individuals who are willing to expend computational resources to solve cryptographic issues. The participants competing to add new blocks are referred to as miners, and the process is referred to as mining. Miners are the ones who execute proof of work. Miners use their computational power to locate a valid block when a piece of information such as a transaction needs to be added to the blockchain. This is accomplished by locating a hash that meets the network protocol specific requirements. In cryptography, a hash is the outcome of a hash function. It converts any format or size of data into fixed size numbers. The protocol established a level of mining difficulty that is algorithmically adjusted so that the time it takes to obtain a proper hash averages 10 minutes. Miners can sometimes locate multiple blocks that satisfy the protocol's requirements at the same time and split the chain n in two. Because there can be only one accurate chain, the protocol must account for these circumstances. Miners will initially continue to mine on both chains. But once another block is discovered on top of one of the two prior blocks, that chain becomes the canonical chain, and miners are economically incentivized to discard the other block. One of the advantages of proof of work blockchain in terms of security is their resilience to Sybil attacks. The Sybil attacks occurs when one player in the network generates many false identities in order to get an unfair edge. over other network participants who only have one identity. 51% attacks occur when a single user takes control of more than 51% of the network's resources and hence has control over the adding of new blocks. Now we know how proof of work works. Let's dive down deeper and explore why do we need proof of work. Majorly, proof of work is required for security and fraud prevention as well as trust. Proof of work is intended to prevent users from printing coins they didn't earn or from double spending. If users could spend their coins more than once, the currency would effectively become worthless. Proof of work ensures that independent data processors or miners can't lie about a transaction. Linking a block with the proof of work hash of its predecessor results in tamper resistance, because the hash of each block is an ingredient in the hash of the following block. Any changes in the chain will affect the final proof of work hash as well as all block hashes in between. So the deeper the altered block, the more computational effort needed for tampering. The first miner who discovers the proof of work answers publishes their solution to the rest of the network. When a new block is discovered, all nodes are notified. They check the answer twice before moving on to the next block. PS, if correct, the block miners earn the transaction fees and the block reward. The protocol only accepts the longest chain as valid and authentic. A fake chain is impractical in the long run since a miner's chances of receiving the block reward are minimal. Other miners will continue to extend the valid chain quicker than the tampered chain over time. Moving on, let's have a look at the other side of the coin, as well as understand some of the major issues with proof of work. First is, it has a negative impact on the environment. Second, the 51% attack can be used against it. If miners gain control of 51% of the hashing power, they will be able to determine what is true. Aside from the enormous cost of tries, there is no mechanism in place to punish any malicious miners. And fourth, because every node must process every transaction, it does not scale properly. While sharding the network may boost efficiency, it also reduces security. This was all about proof of work. Let's explore the best blockchain networks working with proof of work. Bitcoin is the largest and the very first blockchain to adopt proof of work and work with it. Ethereum is next working with proof of work, though it is aiming to switch to proof of stake, which we will talk about in a coming video. Then comes Bitcoin Cash, which is an extension of Bitcoin and follows the same structure, thus it also works on proof of work. Then comes Litecoin, which is also an altcoin of Bitcoin. And then comes Monero, another cryptocurrency serving similar purpose as other cryptos.
What's in it for us today? Let's understand why do we need a smart contract? What is a smart contract? Usage of Solidity for building smart contract, advantages of smart contract, blockchain implementation of smart contracts. We'll look at certain examples of voting and digital token. And also we will take another use case of how smart contract help us do crowdfunding. Now, why smart contract? Now, let's take a look traditionally how contracts used to happen. If suppose two parties, A and B, have to get into a contract, they will utilize the services of a third party whom they have to trust and get the contract executed. Now, with the introduction of smart contracts and the technology which is evolving, removes the dependency on such third parties and automates the execution of such smart contracts. So, if we compare traditional versus the new smart contract, in traditional we used to have governments, lawyers or any other third party on which we can trust. In smart contracts we don't need any third party, we don't need any intermediate. Execution time, definitely there's higher execution time in traditional contracts because as many number of middlemen and their intermediary layers, that many number of days and time it takes. Smart contract is just a matter of minutes, it gets executed because it is automated, programmable, running on a computer, and it has some predefined condition. Remittance. If any remittance of either of the parties have to happen, then it's a manual process. Approvals, workflows, processes and these manual processes take time under traditional contracting system. But in a smart contract, as the conditions are predefined, pre-embedded, as soon as a condition is met, the remittance happens automatically. Either of the parties who have to be credited with an amount is credited automatically, and that is the primary advantage of using a smart contract. Transparency is not available 100% in traditional contracts. The transparency is bound, peripheral between the parties and the entities and the intermediaries involved. As compared to smart contract, transparency is 100% available 24/7 online. Anyone can go and review, audit and validate the transactions executed by the smart contracts. Archiving is a big difficult problem for traditional contracts, as most of the transactions are paper based or the records are maintained offline. It becomes very difficult to maintain and identify the traceability, provenance of all the transactions which have happened in a traditional contract, whereby in a smart contract it becomes easy, as all the transactions have happened through the smart contract. There's 100% traceability available. From the provenance point of view, you can trace the transaction from its day one, the point of origin, till present day, and archiving is automatically happening. The log, the audit, the transaction history is automatically getting generated. Security definitely is a concern in traditional contracts, as the intermediaries are involved, manual processes are involved. Security can be compromised at any level, at any stage. But in a smart contract, the security is maintained through cryptography, mainly through public key infrastructure, the public and private key infrastructure. It is a very secure way of maintaining security and cryptography of the transactions using a smart contract. Cost, yes, traditional contracts are expensive. The cost of transaction is high as compared to smart contracts, as the middlemen are involved. Smart contract, the cost is low, as we don't have any intermediaries, and only the cost of transaction is charged by the underlying infrastructure of the blockchain network which is running the smart contract. Signatures, it's a manual process. All the transactions are signed manually and verified manually, but here in the smart contracts, all the transactions are digitally signed using the private key of the entities and can only be decoded by the public key shared by the parties involved in the smart contract. So in a nutshell, smart contracts give us n number of advantages. The primary advantages are listed here, and these are the advantages which enforce us to move towards an economy and to a system where we start using smart contracts for our transactions to avoid any disputes, to keep the transaction cost low, thereby giving the advantage to the end consumer. Now, what is a smart contract? Let's consider a real life example where you are taking out a chocolate from a vending machine. You deposit a $2 note in a vending machine. After that, you hit A1 button, which is mapped against the chocolate bar that you want to buy. As a result, a lever in the vending machine moves and pushes out the chocolate. So basically, A1 button is programmed to the lever in order to move the chocolate out. Now, a smart contract is very similar to a vending machine. It eliminates the need of an intermediary. In case of the vending machine, is replacing a direct seller and allowing you to make a purchase without a middleman, and it eliminates the need of escrow services. Now, smart contracts are self-executing contract which contain the terms and conditions of an agreement between the parties and the peers who are involved in that agreement. So the terms and conditions of an agreement are written in a piece of code, and it is executed on a blockchain based decentralized platform. Now these agreements facilitates exchange of any digital asset. It could be digital currency, it could be shares, it could be property, or it could be anything which you want to transact. So a blockchain based decentralized platform gives you a democratic system where the transactions are authorized by the majority of the participants, and the identity of the participants is also kept anonymous. Now let's consider an example where Rachel is at the airport and her flight is delayed. But this inconvenience could have been beneficial to Rachel, as smart contract insurance would ensure she is given a compensation for the flight's delay instantly. So just imagine there is a smart contract which the insurance company has already deployed, and it's monitoring the flight's delay. Rachel has already taken that insurance for delay in flights. So as soon as that condition is met for a delay of flight above X amount of hours, for example 2 hours, then in that case the insurance company will automatically get that trigger and Rachel will be credited with that amount for which she is insured in her account. So let's see how smart contract can be helpful here. So AXA flight delay insurance is one of the examples of Ethereum smart contract. AXA is an insurance company. The smart contract is linked to the databases that record flight status. So that smart contract is connected to the databases. It is fetching that information and evaluating the delay. It enables automatic compensation when there is a delay for 2 hours or more. So that is the condition. When the flight delay is beyond 2 hours, then the insurance contract will get executed and Rachel will get paid. So a smart contract is created based on the terms and conditions. So condition compensation is equal to flight delay is less than 2 hours. Based on the code, smart contract holds the company's money until a certain condition is satisfied. This smart contract is submitted to the nodes on the blockchain network to their EVMs for evaluation. So EVM is a runtime compiler to execute smart contracts code. It is the brain. It is the electronic virtual machine which executes the smart contract. All nodes on the network executing the code using the EVM must come to the same result because all the EVMs would have the same copy of the smart contract deployed. So if the flight is delayed 2 or more hours, smart contract will be self-executed and the compensation amount will be given to Rachel, and that is the objective of the smart contract without involvement of any middleman, paperwork which Rachel has to do to submit, and then the insurance company going through the manual process. All that has been bypassed and Rachel has been compensated directly. Now let's understand why do we need Solidity for developing our smart contracts. Now here comes the important question. Which programming language does a smart contract use? There are two widely used programming languages for writing Ethereum smart contracts: Solidity and Serpent. However, on blockchain platform, Solidity is widely used for implementing smart contracts, and this is what we are going to talk about in our subsequent slides. Now, Solidity is a high-level programming language used for implementing smart contracts. It enables to check the program at runtime rather than compile time. Solidity is a Turing complete language. It has all the conditions, all the while loops, for loop, operators, etc. which are there in any matured programming language in order to write your code, in order to write your conditions, if you have certain loop, if you have while conditions, etc. Now, what are the advantages of smart contract? As we have already discussed, there are no intermediaries involved. The process executes without the need of a third party. It's an automated process. They are automated with the code which eliminates manual effort for execution. It's a high speed, highly computive smart contracts which runs on programming code. The speed of its execution is higher than a traditional contract. As the data is stored in the decentralized system, the chances of modifying the data is difficult, and I would say more than impossible. Accuracy based on the requirements, terms and condition of a contract is recorded accurately. So as soon as any transaction is recorded, it is registered on a blockchain network and it is immutable transaction. No one can modify or make changes in any record which has been added onto a blockchain network through a smart contract. Now let's take a look at certain blockchain implementation of a smart contract. Using blockchain in voting process can eliminate voting malpractices. A centralized voting system faces a lot of problems when it comes to tracking votes. There could be manipulated identities, there could be manipulation in counting, there could be biased decision making. A smart contract is introduced to eliminate all these malpractices. There are certain predefined terms and conditions which are already set in the contract. No voter can vote from a digital identity of any other voter. The counting is foolproof. Every vote is registered on a blockchain network and the counting is happening automatically without any interference from a third party or dependency on a manual process. So terms and condition, each ID should be attributed to just one vote. The validation is done by the users on the blockchain network itself. So the voting process can be in a public blockchain or it could be in a decentralized autonomous organization based blockchain setup. All also, but it is 100% transparent and every voting transaction is recorded. Result, every voter's vote get recorded on the ledger and that information cannot be modified. It is transparently publicly available for audit and verification. Now let's take a look at one of the examples of our voting solidity contract. So here we have our voting solidity contract. It is built in Solidity, and I'll just give you a brief overview of what are the primary functions in this. So if we look at this particular contract, this contract gives you certain basic parameters like what should be the minimum number of participants or proposals which are required for voting, then what should be the minimum amount of time for debate that needs to pass before the vote can be executed, then the margin of votes for majority A proposal passes if there are more than 50% of the votes plus the margin. So basically we are defining what is the winning condition, what is the majority margin for any vote to be accepted. Then you have data structures where you are accepting the proposals, right? And then subsequently we are defining data structures for members who are participating in the proposals, who are submitting the proposals. We are fetching the addresses of the members. Basically this is the digital identity of the members who are submitting the proposals, and etc. So the smart contracts basically allows you to create a voting system where you can add members, we can remove the members, you can change certain voting rules based on certain conditions, like if you want to increase the minimum quorum, if you want to change the debating period minutes or the majority rule changes, then this is the function for submitting a new proposal for which the voting has to happen. So basically this example is about if I have to take a vote within a decentralized autonomous organization for a particular decision. So rather than a central authority taking a decision, you can have a voting mechanism within your organization to give a majority to your proposal. If you get the majority, the proposal is accepted, otherwise rejected. Then there are peripheral functions like check proposal code. Then there is a voting function. The actual vote happens, and for a particular proposal, you start increasing or decreasing the number of votes. Then you execute the proposal if the majority has been achieved. Now let's take a look on how to deploy a smart contract. So here we have our voting smart contract. Now we will take a look on how to deploy our voting smart contract on the Ethereum test network called Ropsten. This is our voting smart contract. Now, when you open Remix, you should also have MetaMask, which is a Chrome plugin installed. This is a utility in order to connect to the Ropsten testnet, which is an Ethereum test network. So basically you say ropsten.etherscan.io, and this is the Ethereum test network on which we will deploy our contract. So once you log in into the MetaMask, you will have an account created, and in that account you should have some test ethers already so that you can use them to deploy a contract. So when you create an account on Ropsten, you can buy certain ethers using the Ropsten test faucet. So when you reach this site, the Ropsten test faucet has already taken the address for the account for which you are raising the request, and you can raise request of 1 ether. Now whenever this transaction will get processed, your account balance will get incremented by 1. So as I already have ethers in it, I can utilize it to deploy my contract. Now in order to compile and deploy my contract, I have copy pasted it here, and if I go to my run, my Remix has already communicated via injected web3 to the MetaMask and taken my account, which has 7.83 ether. Now I need to do some settings. Now, as my contract is compiled, you can see it has taken all the contracts. You can see the drop down, and Congress is my major contract. Now, I will deploy my contract. So on the run section, you will be able to see in the drop down the name of the contracts which are there in my smart contract. Like I had owned, token recipient, then there's an interface, and there is a Congress. So I need to deploy my Congress contract. Now in order to deploy this contract, there is a constructor which requires certain inputs. So I can give certain values like what minimum number of proposals I need, 100, then minimum number of debates, 10, and margin of votes for majority. So I say deploy. Now as soon as I'll click deploy, it is going to request me for gas, because when the contract gets deployed, it will deduct certain ethers from my account. So when I'll say submit, if you notice, now this transaction has got initiated on the Robston etherscan.io. I click on it. So this is the transaction on which the contract is getting deployed. It is taking time and the contract is getting processed on the Ethereum network. Now once it will get deployed, we will be able to see the address at which the contract has got created and deployed. Now as you can see, my contract has got deployed at the address 0xcc. I can load it. Now this is the contract address and this is the amount of actual ether which was spent from my account in order to deploy the contract. Now there are certain attributes on the Robston Etherscan which you can go and check. You can verify and publish your smart contract over here so that others can also view the code and utilize your smart contract. And if you go and check your MetaMask, this is the transaction which has just been done in your account, and if you click, it will take you to the same transaction which we opened here. Now after you have deployed the contract, you can interact with your contract directly through Remix. Just to test your contract, all the pink members are the ones which make changes onto the blockchain, and all the blue ones are the ones which are only performing read operations. So in order to do any read operation, you will not be requested to spend any gas. So there will be no pop-ups for MetaMask requesting for gas spending. But if you do any of these pink actions, then you will be required to spend gas, as it will be requiring to make some changes onto the blockchain. So this was a example of a voting smart contract, and this will be available as a link for you to take a look. Now all our other contracts which we will be covering subsequently will be deployed in a similar fashion on the Robston testnet. Now let's take another example. If you want to use smart contract to issue your own cryptocurrency or called digital token, you can use Ethereum based smart contract to create your own digital tokens for performing transactions. Design and issue your own digital currency, create a tradable computerized token that can be utilized as a currency, share, or any asset which you want to transact. These tokens use a standard coin API, like in case of Ethereum, we have standardizations of ERC20, etc., which allows contract to automatically access any wallet for exchange. As a result, you build a tradable token with a fixed supply, and this particular platform becomes like a central bank issuing a digital money. Your smart contract becomes the bank issuing the money. So let's take this example here. So this is a implementation of a ERC20 token, which is a specification by Ethereum, and the primary attribute for this token is that you need to provide a name of your token, a symbol, the decimals to which you support, and the most primary is the predefined supply. So just like in an economy you have limited supply of money, here also you have to define what will be the supply of your tokens, and it will be capped. That will be the supply. So you need to predefine these parameters, and then you create certain data structures within Solidity to keep a tab on the balances of the entities to which you are giving the tokens and how much allowance you want to keep per address. Then there are certain methods which you have to implement as per the ERC20 specification, like transfer, transfer from, approve and call, etc. So all these methods in a typical token allows you to do the transaction, send and receive your custom token among multiple parties. So this would also be available as a link for you to take a look. Now let's take another example of a use case for crowdfunding, using smart contracts to crowdfund your project. So suppose you want to start a business, and for a business you need a lot of funding which is required, but who would lend that money to someone whom they don't trust? How will you generate that money? For such problems, smart contract plays a major role. With Ethereum, you can build a smart contract that will hold a contributor's funds unless a given date or a goal is met. Based on the result, the funds will be released to the contract owners or will be sent back to the contributors. So basically you can create a crowdfunding project for yourself if you want to raise certain amount of money, and the contributors or the investors will give you the money, but the amount will be kept on hold till the time your project goal or date has been met, and accordingly the investor will get the token which you have developed for crowdfunding in hers or his account accordingly. Now, centralized crowdfunding system has plenty of issues with management systems. So therefore, a DAO, a decentralized autonomous organization, is utilized for crowdfunding. The terms and conditions are transparently set in the contract. Every individual participating in the crowdfunding is given a token, and the token is credited to their Ethereum based account. Now, every contribution gets recorded on the blockchain, because when the token transfer has happened from the DAO to the individual investor, that transaction gets recorded on the blockchain network. So let's quickly take a look at the contract for a crowd sale also. So a crowd sale contract provides you the basic attributes like what is the goal of the funding, how much money you need to raise, what is the amount raised real time, you can keep a track, what is the deadline, right, and what is the price of the token in Ethereum, basically what is your token amount in Ethereum. Then there could be that you might give certain tokens in reward, then you can have attributes for your reward, and then you have your methods in order to keep a check that once you have received the funds, you can withdraw the funds, you can check whether you have reached the goal for funding, and then you have the methods for transferring tokens from the sender to your own account. This particular kind of contract allows you to maintain and keep a check on amount of funding you have received or you want to receive. Have you achieved your target? Who are the investors in your token? How much percentage share belongs to your account and how much percentage share has been already been distributed amongst the investors, etc. So everything can be tracked. So the smart contract can build in such a fashion that there are methods and utilities available in order to run your entire crowdfunding. So this contract is also available in the link and you can take a look.
So why wait? Let's embark on this exhilarating adventure together. But before we dive in, if you're looking to take your career to new heights and become a true expert in the realm of blockchain and cryptocurrency, consider checking out our professional certificate program in blockchain in collaboration with IIT Kanpur. It's an excellent opportunity to master key architectural principles and develop the skills needed to excel in this rapidly growing field.
Ria is a phenomenal baker who runs a bakery in New York. On seeing the great success of her business, she thought of growing it even bigger and launching a new franchise of her bakery in LA. So for the funds, she applied for a loan of $50,000 from the central bank. After completing her documentation for the loan, she comes to know that the bank is rejecting her loan application due to her loan borrowing limit of the amount decided by the central financial system. Furious with this situation, she talked to a friend Lisa, a finance expert, to understand how this whole centralized financial system of banks works. And why did her loan get rejected? Lisa explained to her that in centralized finance, banks and businesses use the money that you invest or lend to make profits, and their overriding objective is to make money. Third parties or merchants like debit, credit card providers control money transfers between the two end parties in the financial system, each charging a fee for their services. And that is why her loan got rejected, because the loan amount exceeded the limit decided by the bank or third parties for her. Ria was upset with the thought of not being able to grow her business, and that is when Lisa suggested Ria to opt for decentralized finance, or DeFi. Ria got a little confused by the term and asked, "What is decentralized finance?" Lisa answered that decentralized finance is a piece of code that eliminates middlemen or banks by allowing individuals, business merchants, and corporations to perform financial transactions using developing technologies. Peer-to-peer financial networks that provide security protocols and connectivity to the transactions are used to accomplish this. Stablecoin is a cryptocurrency backed by an asset or tied to a fiat currency like the dollar, is at the concept's core. Ria was fascinated and asked how it works and how exactly DeFi could help her get her loan approved. Lisa further added that DeFi uses the consensus mechanism to eliminate centralized finance models by allowing anyone or everyone to utilize financial services, regardless of who they are or where they are. A consensus mechanism refers to the methods used to achieve agreement, trust, and security across a decentralized computer network. Now, this DeFi mechanism runs in a decentralized environment. And this is where blockchain comes into the picture. It provides the environment where you can simply create your decentralized programs, or DApps, according to your requirement. In the blockchain network, transactions are stored in blocks, and other users in that network can verify them. If a transaction is verified by all its verifiers, the block is closed and encrypted, and a new block is created containing information from the previous block, thus creating a chain of blocks. And these transactions are handled by decentralized applications, or say, DApps. Lisa further explained that Ria's loan got rejected due to the lower limit by the centralized financial system. But in DeFi, she can submit her loan requirements into a decentralized finance application, DApp, and an algorithm would match her up with peers who could help her. After that, she'll have to agree to the lender's terms to get her loan. The transaction is then recorded in the blockchain, where it will be securely stored in a ledger that will make it impossible to hack, or any kind of malicious intervention. And after that, she'll receive her required amount of money once it is verified by the consensus mechanism. The lender can also then begin collecting their payments at the agreed upon intervals from her. When she makes the payment using her DApp, it goes through the same blockchain process, and the money is transferred to the lender. Ria was impressed and relieved that she now could grow her business in a much more secure and cheaper way, all thanks to DeFi. DeFi is meant to conduct transactions using cryptocurrency. Because technology is still evolving, it's difficult to say how, if at all, existing cryptocurrencies will be applied. Finn is part of the management team in an MNC, and he has come up with some profitable investment policies for his company and his employees. Before its implementation, he needs to pitch his idea in front of the board of directors. But the board of directors didn't approve of his idea, and that too without any explanation for their decision. Disappointed by this, he started browsing the internet, looking for a solution that could benefit everyone and where every member gets to have their say. And that is when he came across the concept of DAO, which is a decentralized organization that is collectively owned by its members, and wherein decisions are voted upon by themselves, which runs on blockchain technology. But to understand its concept in depth, we went to his friend Sam, who is a blockchain expert. Finn explained to him his situation, how he came across the DAO, and why he wants to know more about it. On realizing his excitement and curiosity, Sam decided to take him through the DAO and how it functions. He explained that before understanding what DAO is, let's understand a bit about what blockchain is. Blockchain is a system of storing data that makes it difficult or impossible to change, hack, or manipulate the data. It's basically a digital log of transactions that are duplicated and spread across the blockchain's whole network of computers. And the DAO is something that makes use of its rules and policies for its proper functioning. He further added a DAO, or decentralized autonomous organization, is a blockchain-based organization that is collectively owned and controlled by its members. They have built-in resources that no one can access without the group's permission. All proposals are implemented using voting processes to make decisions upon its rules and policies, ensuring that everyone in the organization gets a say. And this whole system majorly runs on Ethereum blockchain. Sam further added that back in 2016, the developers of the DAO believe that by putting decision-making power in the hands of automated technology, that will eliminate the decision-making power driven by an individual or by body. It was created to allow investors to send money anonymously from anywhere globally, and they would issue tokens to those owners, letting them vote on potential initiatives or proposals. Finn was fascinated and asked Sam how exactly it works and how this can be the solution for his situation. Sam explained, basically, smart contracts are the backbone of DAO. Smart contracts are programs that run when certain conditions are met and are stored on a blockchain. Let's understand this stepwise. Step 1 is when the documentation of the idea takes place in the similar way in DAO. A group of people write these smart contracts to administer the organization. Once the contract goes live on the Ethereum network, changes to its rules can be proposed only by voting. The contract automatically fails if the rules are violated. Then comes step 2, which is a funding period, in which pitching of ideas takes place in front of the selected members and investors of the organization. Similarly, people in the DAO organization contribute money to the DAO by purchasing tokens that signify their membership in the organization. And when the funding period ends, it proceeds to step 3. That is when the approval and implementation process of the idea takes place, or say the DAO starts to operate. People can now make proposals to the DAO on how to spend the money and how the members can vote to approve those proposals. This is how the first ever DAO was launched by Slockit. Now the question arises, what led the DAO towards criticism? This is due to the infamous DAO hack. Back in June 2016, hackers used DAO's vulnerabilities to assault its treasury. The hackers were able to gain access to 3.6 million Ethereum, valued around $50 million. This sparked a divisive debate among DAO investors, with some demanding for the DAO to be permanently dismantled. Initially, Vitalik Buterin, the founder of Ethereum, advocated a soft fork of the Ethereum network, which included a piece of code that would effectively blacklist the attacker and prohibit them from moving the stolen cash. But soon after, a problem was detected in its code, putting it vulnerable to assault. After great debate, a second alternative, a hard fork, was suggested and subsequently implemented. The hard fork effectively reset the Ethereum network's history and moved the DAO's Ether to a different smart contract, allowing investors to withdraw their assets. And as a result of the hard fork, two competing and now distinct Ethereum blockchains emerged. Those who opposed the hard fork, which wiped back the blockchain's history, backed the soft fork version, which is now known as Ethereum Classic, ETC. The Ethereum blockchain is the blockchain that implemented the hard fork, changing the blockchain's history.
So what's in it for you today? We're going to understand why do we need blockchain wallet, what is a blockchain wallet, how do these wallets work, what are the different types of blockchain wallets, their comparisons, and a demo on the usage of these blockchain wallets, and we will try to do certain transactions using these wallets. Now, before these blockchain wallets came into existence, what were the means in order for us to do the transactions, and what were the drawbacks? In the old days, the transactions with whatever medium and channels we had, the problems were that the transactions were slow and banks were the central point of failure. Basically, any transaction which has to go through some intermediary channels and has to pass through certain intermediaries like bank, which makes them a single point of failure. Also, there are issues in keeping track of all accounts and balances. Data get jeopardized, manipulated, or even get corrupted across multiple systems where the accounts and balances are maintained. Now here comes into existence what is called as blockchain wallet. Now what is blockchain wallet? A blockchain wallet is a cryptocurrency wallet that allows users to manage different kind of cryptocurrencies, for example, Bitcoin, Ethereum, etc. Now, a blockchain wallet helps exchanging of funds easily. Transactions are secure as they are cryptographically signed. The wallet is accessible from web or mobile devices, and the privacy and identity of the user is maintained. So therefore, a blockchain wallet provides all the features which are necessary for a safe and secure transfer and exchange of funds between different parties. A blockchain wallet is a typical cryptocurrency wallet that allows users to manage cryptocurrencies. It is very similar to the process of sending or receiving money through PayPal or any other gateway which you use today. But now you can use cryptocurrency instead, similar to PayPal, which you're using for making transactions with your fiat currency. Now let's take a look at the ecosystem of blockchain wallets. Here are certain examples like Electrum, Blockchain.info, Jax, Mycelium, Samurai, and Bitcoin Paper Wallet. These are just to name a few blockchain wallets which are existing in the market, but there are many more based on the requirement you have, based on the security you require, and based on the kind of wallet which suffices your need. So we will see what are the categorizations of these kind of wallets are. Now, how do blockchain wallets work? Let's take a look. So before we move on to how blockchain wallets work, let's understand what a private and a public key is and how are these keys related to a blockchain wallet. Now, whenever you create a blockchain wallet, you are also provided a private and a public key which is associated with your wallet. Now, let's take an example in order to understand this. Imagine a person knowing your email address is sending you an email. So in our regular day-to-day activity, if we want to receive an email from someone, we give him or her our email ID and expect an email from them. Now, what if an unknown person is able to send emails through my account? So I am giving my email address for receiving emails, but when I am disclosing my email ID, I'm not assuming that someone will be able to send emails through my account, because then for that he has to be aware of my email account password. So knowing your email address will not give a person the ability to send an email from your account. You are not giving your password to the person to send an email. You're just giving the email address. To send an email from a particular email address, an individual has to be aware of the password associated with it. Now, blockchain wallet follows a similar process using public key and private key both together. Public key is similar to your email address. So basically, whenever your wallet is generated, a public key is generated, you can share that public key with anyone in order to receive funds. Private key is top secret. It's similar to your password. It should not get hacked or you should not disclose it to anyone. And you use this private key to spend your funds. So now, instead of sending an email, imagine you want to transfer money to your friend. This transfer process is done through your blockchain wallet. With blockchain wallets, you can now send and receive cryptocurrencies. So as I said, a blockchain wallet has two keys, a public key and a private key. Public key is shared with everyone, just like an email address. Private key is just like your password, which should be kept secret with the sender. So with blockchain wallet, no one will be able to send crypto coins just like emails through your public key until they know your private key. But if someone gets access to your private key, there is a high possibility that your account is hacked and you might end up losing all the cryptocurrency deposits in your account. Now let's take a look. What are the typical features of a blockchain wallet? It's easy to use. It's just like any other software or a wallet which you use for your day-to-day transactions. It is highly secure. It is just a matter of you securing your private key, and it allows instant transactions across geographies, barrier-free, without intermediaries, and also these transactions charges you low-cost fee. And these wallets help you do transactions across multiple cryptocurrencies, so you can make payments across cryptocurrencies, which helps you do easy currency conversions. Now let's talk about what are the different types of blockchain wallets. Now basically there are two types of blockchain wallets based on the private keys. One is hot wallet and another is the cold wallet. Hot wallets are like normal wallets which we carry for day-to-day transactions, and these wallets are user-friendly. Cold wallets are similar to a vault where cryptocurrencies are stored with a high level of security. Now let's take a look at the differences. Hot wallets are online wallets through which cryptocurrencies can be transferred quickly. They are available online on internet. Example, Coinbase, blockchain.info. Cold wallets, they are digital offline wallets where the transactions are signed offline and then later disclosed online. So they are not maintained on the cloud on the internet. They are maintained offline to have high security. And the examples of cold wallet are Trezor and Ledger. Now, in case of hot wallets, private keys are stored in the cloud for faster transfer. In case of cold wallets, private keys are stored in a separate hardware which are disconnected from the internet or the cloud, or are stored in a paper-based document. Hot wallets, they are easy to access, available online 24/7. It can be accessed through desktop or mobile, but has a risk of unrecoverable theft when hacked. Cold wallet, this method of transaction helps in protecting the wallet from unauthorized access, from hacking and other online vulnerabilities. Now, the wallet can be further distinguished on these criteria. There can be software wallets, there can be hardware wallets, which are like kind of USB driven and you plug into your USB drive and your hardware wallet can be used, or they are a typical paper-based wallet where you print your public key and a private key on a paper and keep it in a secure place. So let's talk about software wallet. A software wallet is an application that is downloaded on a device. Either it could be a desktop or a mobile, or it could be a web-based wallet which can be accessed online. Now, here are certain examples. DAX, Bread Wallet, and Copay are the popular software wallets. So software wallet can be further categorized into desktop wallet, online, or we can call it web wallets or mobile wallets. Now desktop wallets are like cold wallets in which the private keys are stored in cold servers. Basically, the desktop wallets, the private keys are stored in your desktop. You can unplug it from the internet, do some offline transactions, and then bring it back online. Now, in case the main server is lost, then a cold server, basically your desktop, is used as a backup server. These wallets can be downloaded on any computer but can only be accessed from the system they are installed on. So you make sure the desktop or the machine on which you have downloaded the desktop wallet is safe, has a backup, you're maintaining the hardware, you're not letting the machine go anywhere, and it is on a secure location. Now, these wallets are definitely cost efficient, and one of the examples is Electrum and is one of the most popular desktop wallet. Online wallets are the other kind of hot wallets that run on the cloud, that are available on the internet. Now here users have the benefit of accessing these wallets across any device. It could be tablet, desktop, or you can use it from your mobile browser. The private keys are stored online and are managed by a third party. You have to be dependent on a third party service. Now, for example, Green Address is a Bitcoin wallet which is available on the web, has an Android app, is available on a desktop, and also is available on iOS, Apple. Mobile wallets. Mobile wallets are like similar to online wallets, except that they're built only for mobile phone usage and accessibility. These wallets are also user-friendly and they have a user-friendly interface for which helps you in doing transactions easily. The example is Mycelium, which is the best available mobile wallet. Hardware wallets. Hardware wallet is a type of a cold storage device, typically like a USB, which stores the user's private key in a protected hardware device. These wallets are similar to portable devices that can be connected to the computer, can be plugged in. As I said earlier, it is less prone to malware attacks, malicious attacks, and it is hack proof. Examples are NanoLedger, Trezor, and KeyKey are the top hardware wallets available in the market. To make a transaction from your hardware wallet, you have to ensure the hardware wallet is plugged into your computer system before you can do a transaction from your hardware wallet. Paper wallet. A paper wallet is an offline process for storing cryptocurrencies. This wallet is a printed paper consisting of both your private key and a public key, which are accessed using a QR code. Now, since these wallets are safe, they are widely used for storing large amounts of cryptocurrencies. Now, examples are Bitcoin paper wallet and MyEther wallet are one of the widely used paper wallets. But the question arises, how do I add cryptocurrency in my paper wallet? In order to make a transaction with your paper wallet works with your software wallets, the online wallets, to transfer funds from your software wallet to the public address shown on your paper wallet. So basically, first you park your funds in a software wallet, then you transfer the funds from your software wallet to the public address printed on your paper wallet. Now let's do the comparison. Blockchain Info. Blockchain Info is a cryptocurrency wallet which supports Bitcoin and Ethereum. It is easy to use and has a low transaction fee. It has its APIs exposed. You can easily use them in order to make your own custom wallets also. Ledger Nano. Ledger Nano is a hardware wallet which offers a high security to your account. It is available for Bitcoin, Ethereum, and Litecoin users. It is also possible to maintain multiple accounts and access them anytime. Bitcoin Paper Wallet. Paper Wallet helps you to print your own tamper-resistant Bitcoin wallet. It minimizes the threat of hacking. Jaxx Jax is a software wallet which enables a user to exchange currencies within the wallet. It is available for Bitcoin, Ethereum, Litecoin, and many other cryptocurrencies. With Jax, a user can view his updated balance as soon as the processing is complete. Now let's take a look at certain demos for the different kind of wallets we have talked about. So let's first take an example of paper wallet. So bitaddress.org provides you a paper wallet. It uses the client-side JavaScript in order to generate a random hash for your wallet. So you keep moving your mouse and it will generate a hash, public and private key. It is recommended that when you are doing this process, you should be disconnected from the internet, and once these keys are generated, you can print it and keep it secure and clear the cache of your browser. So as you can see on the screen, this is my public key for receiving my Bitcoins, and this is the private key for me to spend it. I can print it and keep it handy with me. But of course, the safety of these physical documents cannot be entirely guaranteed. If a hacker discovers the location of your paper wallet and physically steals it, then they can access your Bitcoin holdings. So basically, it is of high importance that you keep the paper wallet in a very secure location. Some users hide or disguise the paper wallet. It should be protected from physical damage. If the keys fade or can no longer be scanned, then the user will never again be able to access the Bitcoin which are parked in that address. Also take care if you are using an incorrect type of printer, that also may damage the paper wallet. Now let's take a look for our second example of online wallet. Here we are taking an example of BitPay. So you can download BitPay online and create your account over here. You can create a personal wallet, you can create a shared wallet or a joint share wallet. Once you create a wallet, like if you see the example over here, this is my personal wallet and I have 3.645 test Bitcoins over here. Now, in order to receive test Bitcoins in my account, you can receive these test Bitcoins from testnet.coinfaucet.eu-in. Now, in order to receive it, you just need to copy your Bitcoin address in the testnet address. So the test net has given me 0.87 Bitcoin. So now my balance has increased from 3.5 to 3.64 and I can see this transaction. See, 3 minutes ago, I just received 0.872287 Bitcoin. The transaction is still in process, but in a while, as this transaction is getting mined on the testnet, I will receive it. Now, as I have received it, I can even make a transaction and send it to someone. So from my personal account, I can send Bitcoin to someone whose Bitcoin address I have, and I have to just paste it over here. Transfer to Bitcoin wallet. Either I can select one of my own wallets or I can search for any other Bitcoin address which someone has shared with me and I can send it to that particular address. Now let's take an example of our hardware wallet. How does hardware wallet works with the online wallets? So here we have MetaMask, which has a feature of connecting with hardware wallet. So once you have MetaMask installed, you will see this option of connect hardware wallet. Now MetaMask has provided support for Trezor. So now once you connect your hardware wallet, the USB with your computer, you can select an account you want to view on that particular hardware wallet and you can only choose one at a time, and then you can start using that particular wallet for your decentralized apps. So basically, once you have your hardware connected, it is integrated with your MetaMask, and then you can start running your decentralized apps so that they can start using the tokens or the currency in the particular hardware wallet. So use your hardware account like you would with any Ethereum account. Log into DApps and send Ethereum's buy and store ERC20 tokens and non-fungible tokens like CryptoKitties. So if you click connect to Trezor over here, MetaMask will start looking out for the connected Trezor device.
So first, let's have a look at what we're going to explore in this video. First, you will get an idea about what is decentralized finance, or DeFi. Then you will understand what a liquidity pool is. Following that, you will understand the difference between the liquidity pool and ordered books. Then you will get a broader perspective on how exactly liquidity pools work, and what are the regulations of the liquidity pool. And in the end, you'll get a gist of the pros and cons of liquidity pools. So let me take you through decentralized finance first. Decentralized finance, or DeFi, is a new financial system that is built on safely distributed ledgers, much like the ones used by cryptocurrencies. DeFi reduces the service charges that banks and other financial institutions impose. Anyone with an internet connection can use DeFi, and users can hold their money in a safe digital wallet and transfer money quickly. Basically, by giving people access to peer-to-peer digital trades, DeFi threatens the centralized financial system. And crypto assets are locked into the contracts, referred to as liquidity pools, by users of DeFi protocols so that others can use them. Well, now that I've mentioned liquidity pools, let me explain what exactly a liquidity pool is. A liquidity pool is technically a pool of crypto tokens secured under a smart contract, and these tokens provide decentralized exchanges with the necessary liquidity they require. Basically, the term liquidity refers to the ease with which one can swap a crypto token for another. Because so many financial transactions occur within the DeFi ecosystem, such simplicity is crucial. But this raises the question of how liquidity pools differ from ordered books. To understand how liquidity pools differ from ordered books, let's look at the fundamental building block of electronic trading, which is the ordered book. Simply put, the open orders for a certain market are gathered in the ordered book. The system that matches orders with each other is called the matching engine. The ordered book and the matching engine are the primary components of any centralized exchange, or CEX. This concept made it possible to communicate information efficiently and enabled the development of intricate financial markets. DeFi trading, however, carries out deals directly on the blockchain without needing a central entity to retain the funds. In terms of ordered books, this creates a challenge. Gas fees are incurred for each interaction with the ordered book, making the cost of executing transactions significantly higher. Additionally, it makes it very expensive for traders who act as market makers and supply liquidity for trading pairs. Above all else, however, most blockchains cannot handle the throughput needed for the daily trading of billions of dollars. But liquidity pools solve each of these problems with ease. So, now that the definition and purpose of the liquidity pool are all clear, let me walk you through the working of liquidity pools. As discussed before, in a normal liquidity pool, users are encouraged and rewarded for staking their digital assets in the pool. Rewards may take the form of cryptocurrency or a portion of the trading commissions paid by the exchanges where they pool their assets. And here's an example of how it operates. A trader using SushiSwap to invest in a BTC to USDT liquidity pool. Step 1, go to SushiSwap. Step 2, find the BTC USDT liquidity pool. Step 3, deposit a split of BTC and USDT to the BTC USDT liquidity pool. Step 4, receive BTC USDT liquidity provider tokens. Step 5, LPTs should be deposited to the BTC USDT staking pool. After the agreed upon amount of time has passed, you'll be given the Sushi token you pledged to keep it safe. It can be for a set period of time, like a week or 3 months. The original BTC USDT pair would be compensated with a percentage of the commissions received from exchanges on that liquidity pool. In addition, by staking your LPTs, you would receive sushi tokens. Now that the working of the liquidity pool is in front of you, let me give you a gist of the regulations of liquidity pools for your investments. The investment fund manager needs a license to build a pool. In addition, regardless of the jurisdiction, an investment fund license is required whenever the pool is actively sold or promoted to clients. Some cryptocurrency liquidity pools circumvent the issue by presenting themselves as community-owned and distributing governance tokens. The entire community holds the ownership. Thus, regulators won't be able to go after the owners in court. However, there is a significant amount of risk associated with joining such pools. Well, now that the concepts of the liquidity pool are all clear, let me give you a look over the pros and cons of the liquidity pool to give you a better understanding. The liquidity pool makes trading on the DEX simpler since transactions are carried out at current market prices. Whereas it goes against the idea of decentralization that a small group controls the pool of funds. People can use it to lend money and get paid in prizes, interest, or an annual percentage yield in return for their cryptocurrency. On the other hand, due to lax security measures, there is a risk of hacker exploits, which could cost liquidity providers money. It uses publicly accessible smart contracts to maintain the transparency of security audit information. But on the contrary, there is an exposure to temporary loss. This occurs when a change in the price of your assets that are held in a liquidity pool results in an unrealized loss, as opposed to if you had just kept the assets in your wallet. Well, this was all about liquidity pool and its related concepts.
Jordan, a fresh graduate, is working as a sophomore engineer at a big firm, saving money for higher studies. One day, he came to know that the bank where he was saving money got bankrupt, and all his money was now gone with the bank. Jordan was confused. How come if the bank had gone bankrupt, his money was also gone? When his friend Jack learned about this, he explained that banks are basically a centralized system for storing the data of all transactions. Banks rotate money to ensure the existence of the money of their customers. For instance, the amount of money appearing on your account is just a number or value. So if they go through any crisis, your money also comes at risk. A real-life example of this was the bankruptcy of Lehman Brothers, when they caused a global recession. In a nutshell, by giving your money to the bank, you are giving control of your money to someone else, and this causes the problem of transparency. And this doesn't stop there. Due to the irrational ratio of banks and data present, technical failures and double spending, where due to internal server issues, the amount gets deducted twice, became prominent issues. Jordan was shocked to know such an in-depth mechanism of banks and how they negatively affect their money, and wondered if these issues are so prominent, what is a solution? And that's when Jack replied, well, there is a solution, and it's Bitcoin. Jordan was confused and asked what Bitcoin is. Jack explained that Bitcoin is a cryptocurrency that came into existence in 2008. A white paper was published by a guy named Satoshi Nakamoto, suggesting a way of creating a system for a decentralized currency called Bitcoin. Its motive was to show the world that a decentralized control structure can work with the institutional government. Bitcoin claimed to create a digital solution that would solve all these problems, like double spending, corruption, and low transparency, without the need for a central authority. Jordan was excited to know about Bitcoin, but needed clarification about how Bitcoin can solve such issues that large institutions like banks cannot. Jack further explained that Bitcoin is a transparent ledger without a central authority and works on blockchain technology. Blockchain is a system for storing data in a way that makes it challenging or impossible to alter, hack, or defraud the system. A blockchain is simply a network of computer systems that maintains duplicate copies of all transactions in a digital ledger disseminated throughout the network. And BTC is the currency used to make those transactions successful. And as there are no middlemen, the transaction cost is way cheaper, as each system in the network carries a copy of the ledger or transaction stored in it, making it impossible to hack or manipulate. Because to do so, you will have to take down or hack every system or node participating in the network. Bitcoin is completely digital. Jordan, after knowing this, asked how it could solve his problem and how he could get access to Bitcoin if it's completely digital. Jack explained that one can always buy Bitcoins. Once you own Bitcoin, it gives you a specific ID, which gives you full control over your money. Using that ID, you can send or receive funds in your Bitcoin account that can be later converted into any currency anytime you want. So, if he would have invested that same amount in Bitcoin years ago, he could have easily accessed it. And it would have been worth much more than they were years ago. Another reference is of Vignesh Sundaresan, famously known as Metakovan, who became a billionaire with just $5,000 investment, all because of Bitcoin. So these examples are powerful enough to establish the fact that Bitcoin is the best alternative for today's financial establishment, and also how bright its future is going to be.
So let's get started and let's talk about what is Bitcoin mining. So what is Bitcoin? So let's take an example. So there is someone who wants to send 5 Bitcoins to Rachel. Now we will see how this transaction can happen. Now Bitcoin is based on the concept of digital currency. Anyone across the globe can transfer amount in Bitcoin irrespective of the geography from anyone to anyone. So basically you need to just open an account on the Bitcoin network, have some Bitcoins in it, and you can transfer it. Either you can purchase the Bitcoins online through some exchanges, or you can mine it. So once you have Bitcoins in your account, you can transfer it to someone you want whose address you have. Now, do you want to know how this transaction works? Well, this transaction is done by Bitcoin mining. So we will go deep and understand that how the Bitcoin transaction works, what all entities are involved behind the scenes in order to maintain the sanity of the Bitcoin network and make sure that whomever you wanted the Bitcoin to reach to has reached, and there is no loss of Bitcoin in the network, and it is a successful transaction. So let's understand certain basics. So what's in it for us today? We need to know what is Bitcoin. We will understand the underlying technology, blockchain. So we will talk about that. Then we will see what are the advantages of Bitcoin as compared to other digital currencies and other digital technologies. Then we will go into the concepts of Bitcoin mining, then what is Bitcoin mining, and we will do a demo on certain aspects of Bitcoin mining. Now, what is Bitcoin? Bitcoin is the first decentralized digital currency that allows users to transfer money peer-to-peer without any intermediaries like banks, governments, agents, brokers. Nothing is involved, and all this is done using blockchain technology. So as we saw in our previous example, two parties wants to exchange money, transfer money, they don't need an intermediary. Now Bitcoin can be used for online purchases, e-commerce transactions, it can be used as an investment instrument, and it can be primarily used for payments to buy goods and services. Now it was created in 2009. It came into existence by a person or a group of people called Satoshi Nakamoto. Now Bitcoin helps transferring of assets faster than regular fiat currencies. It has definitely lower transaction fees because as it has removed the intermediaries from between, the cost of transaction also goes down, and it is cryptographically secure. It uses cryptography infrastructure, and thereby the identities of the sender and the receiver are also secure, and the entire transaction is cryptographically signed. And the users' information who are doing the transactions or are part of the network is also hidden and secure. Now, what are the advantages of Bitcoin? So it allows fast and quick peer-to-peer transactions. It is impossible to counterfeit or hack the transactions which are running on a Bitcoin network. And it's an overall decentralized process. There is no centralized body which is controlling the transactions or charging a fees in order to validate the transaction. It is the participants in the decentralized network who are taking care of the sanity of the network, thereby making sure that the overall transaction cost is low. All the information is accessible to public. It is available publicly on a public ledger. Anyone can go and view the transactions and the volume of the transactions happening on the Bitcoin network, and it It is a low fee transaction. It is comparatively low to other mediums and channels through which today digital transactions are made. Now, what is blockchain? So Bitcoin runs on the underlying technology of blockchain. Blockchain is a public distributed ledger in which transactions made in Bitcoins or any other digital currency are recorded in a chronological order. So let's see certain features. It is cryptographically secure, signed using your private key and then shared on the network with the public key. It is immutable. Any record or any transaction added on the blockchain cannot be modified or altered. It is run by a decentralized system. There is no centralized authority or the body, and the transactions are stored in containers, aggregated in containers called blocks. So a block is the smallest unit of a blockchain which records all the transaction. A basic structure of a block is something like this. It has 4 fields. These are the primary attributes of a block. It has something called as previous hash. So the previous hash attribute stores the value of the hash of the previous block, and that's how the blocks are linked to each other. Data, this is the aggregated set of transactions which are included in this block. So these are the set of transactions which were mined and validated and included in the block. Nonce. So in proof of work consensus algorithm, which is used in Bitcoin, nonce is a random value which is used to vary the output of the hash value. So every block is supposed to generate a hash value, and nonce is the parameter which is used to generate that hash value. And the proof of work is the process of transaction verification done in blockchain. Now, hash is the resultant hash value obtained by passing the previous hash value, the data, and the nonce through the SHA-256 algorithm to generate the hash of this block. So this is the digital signature of the block which is generated, and this is the basically identity of this block. Now, SHA-256 is a cryptographic hash algorithm which produces a unique 256-bit alphanumeric hash value for any given input, and that is the unique feature of this cryptographic algorithm. Whatever input you give, it will always produce a 256-bit hash. Now let's understand the concepts of Bitcoin mining. What is Bitcoin mining? Bitcoin mining is the process of verifying Bitcoin transactions and recording them onto the public blockchain ledger. In blockchain, the transactions are verified by Bitcoin users. So basically, the transactions have to be verified by none other than the participants of the network, those who have the required hardware and computing power, and those entities are called miners, so we will be talking about them later. But the point to be highlighted is that there is nothing like a centralized body as in case of legacy transactions where we used to be dependent on a regulatory or governing body or a bank to make our transactions go through. Now in Bitcoin, here any user with mining hardware and internet access can take a part. That kind of computer can be a participant and contribute to the mining community. Process is solved based on a difficult mathematical puzzle called proof of work. So every miner's job is to solve the mathematical puzzle which is called proof of work in order to validate the transaction and earn the reward. And all the miners, as they are competing amongst themselves to mine a particular transaction, the miner who first solves the puzzle gets the reward. Now users trying to solve the puzzle, as I said, are called miners. They are the participants in the network who have the necessary hardware and computing power to do all the transactions, to validate the transactions and validate it. They are called as miners. Now in order to understand Bitcoin mining, we need to understand 3 major concepts of blockchain. It is based on distributed public ledger. It uses SHA-256 encryption algorithm, and proof of work is the underlying consensus algorithm for Bitcoin mining. So distributed public ledger. A distributed ledger is a record of all transactions maintained in the blockchain network across the globe. In the network, the validations of transaction is done by Bitcoin users called as miners, SHA-256. Now, blockchain prevents unauthorized access by using a hash function called SHA-256 to ensure that the blocks are kept secure. They are digitally signed. Their hash value once generated cannot be altered. Now, SHA-256, it takes an input string of any size and returns a fixed length 256-bit output value, and that is the primary feature of SHA-256 encryption algorithm. You give any input, it will always give you a 256-bit output, and it is a one-way function. You cannot derive the input reversely from the output what you have generated. And third is the proof of work. In blockchain, mining is a process to validate transactions by solving a difficult mathematical puzzle called proof of work. Now, in order to do that, the primary objective of the miner is to determine the nonce value, and that nonce value is that mathematical puzzle that miners require to solve in order to generate a hash which is less than the target defined by the network for a particular block. Now, in the Bitcoin network, users trying to solve mathematical puzzle are called as miners. Now, the puzzle is solved by varying a nonce which produces a hash value lower than a predefined condition which is called as the target. Miners verify the transactions and add the block to the blockchain when confirmed and verified. As of today, the miners who solve the puzzle gets a reward of 12.5 bitcoins. Now, once a block is added to the blockchain, the bitcoins associated with the transactions can be spent. So once the block is validated, then the transfer of bitcoins associated with the transactions aggregated in the block, the transfers are made then from one account to the another. Now, in order to generate the hash, let's see, you use the SHA-256 hashing algorithm. You define the hash value. If it is less than the defined condition, the target, then the puzzle is deemed to be solved. And if not, then you keep on incrementing nonce value and you repeat the SHA-256 hashing function, passing on to the nonce value, and you generate the hash value again, and you keep doing this process till the time you get the hash value which is less than the target. Now let's take an example. So for example, Beyonce wants to share 10 Bitcoin with Jennifer. Now in order to do that, what will be the steps? So Beyonce's transaction data is shared with Bitcoin users, the miners, from the memory pool. The transaction goes and sits in a memory pool of unmined transactions. So in a memory pool, set of unmined or unconfirmed transactions wait until they are verified and included in a new block. They remain in that unconfirmed transaction pool. Now, miners competing to validate the transaction using proof of work, they keep on continuously polling the unconfirmed transaction pool. They pick up those transactions and start validating those transactions. They aggregate in a data block and start validating. They start solving the puzzle. The miner who solves the puzzle first shares his result across the other nodes, the other set of miners. Now, once the block is being verified, the nonce has been generated, then the nodes will start granting their approval. If maximum nodes grant their approval, the block becomes valid and is added to the blockchain. Now simultaneously, the miner who has solved the puzzle will also receive the reward in the meanwhile, which will be of 12.5 Bitcoin, which as of today stands at 98k around dollars. Now the bitcoins, the 10 BTC for which the transaction was initiated, now will get triggered and will get transferred from Beyonce to Jennifer. Now let's take a look at certain facts. In proof of work, a predefined condition, the target, is adjusted for every 2016 block, which is approximately every 14 days. And an average time to mine a block is 10 minutes. So basically, the target keeps automatically adjusting itself to keep the block generation within the 10-minute time frame. So this is the representation. So in order to keep the time frame for block generation within 10 minutes, the target keeps on adjusting itself. Now, the difficulty of the puzzle changes, the target changes depending on the time it takes to mine a block. So this is how a difficulty of a block is being generated. It is the hash target of the first block divided by the hash target of the current block. So this is the difficulty which is being changed after every 2016 blocks. So basically, it is very hard to generate the proof of work, but it is very easy to verify by the miners. So once you have solved the puzzle and you have broadcasted that yes, you have earned, you have validated a record, you have determined the puzzle, for other miners it is very easy to verify what you have done. And once they give their consensus, the majority, then the block gets validated and gets added to the blockchain. Now, since the difficulty depends on the hash target, its value keep on changing after every 2016 block. as I said. And as you can see, in due course, from the day of inception of Bitcoin in 2009 till today, difficulty has increased exponentially, and it has been increasing, and thereby the entire effort of mining and the computing power is also increasing. So as of what was the resources which were required to do mining in 2009, you require more hashing power, more computing power in order to do the mining today. Now, what if someone tries to hack the data? So let's see. Blockchain is a chain of blocks, ABC. Now, each block has solved a puzzle and generated a hash value of its own, which is its identifier. Now, suppose a person tries to tamper a block, the block B, and tries to change the data, which is aggregated in the block. So if the data of the block will change, the hash value, which is the digital signature of the block, will also change. Thereby, it will corrupt the chain which is subsequent to it. Basically, the blocks ahead of block B will all get delinked because the previous hash value of block C will not remain valid. So in order for the hacker to make the entire blockchain valid for the block B which he has changed, he has to change the hash value of all the blocks ahead of block B, which will require huge amount of computing power, which will be next to impossible. So as you see, the results in the following block being invalid. So with this whole thing, the blockchain is making sure that the entire sequence remains non-hackable and prevent data modification. Now let's see what are the underlying hardware requirements for Bitcoin mining and how the hardware has evolved. So in the early days, miners used to solve the puzzles using regular processors, the controlling processor unit CPUs. Now, but it used to take a lot of time for mining, though the difficulty levels were low, but still it used to take a lot of time. Now, as I said, the difficulties level keep on changing and growing. So the miners also had to increase the processing power. So they discovered that graphical processing units, GPUs, proved to be more efficient than regular CPUs. So, but this also had a drawback of consumption of electricity. So any miner who has to calculate the return on investment on the hardware, he also has to accommodate the cost of electricity and other resources which are going in order to do the mining. So finally, as of today, they are using a hardware called ASIC, Application Specific Integrated Circuit, which was specifically introduced for mining, which consumes less power and has a higher computing power and a better hardware for mining. So miners are profitable when their cost of resources to mine one block is less than the price of the reward they receive. So definitely they have to have the investment less than the reward what they earn. So as of today in blockchain, miners use their resources to verify a transaction. Each time a block is mined, new bitcoins are created in the network. So the Bitcoin total supply is limited. It is at $21 million. Approximately 21 million Bitcoin are in supply. 17 to 18 million Bitcoins have already been mined. So only 3 to 4 million are left. As of today, a reward of 12.5 Bitcoin is given to the miner on doing the transaction verification, but the Bitcoin mining reward goes by the halving principle. The reward given to a miner is halved every 210,000 blocks, which is approximately every 4 years. So then after that threshold is reached, the Bitcoin reward will go down to 6.25 Bitcoins. So let's take an example of a lottery ticket where your chances of winning is difficult. So we are talking about what is Bitcoin mining pool. Your chances of winning the lottery is difficult, but in a community, if individuals buy multiple lottery tickets and pool their tickets together, then this will increase their probability and chances of winning more. So suppose you won the lottery, then based on the contribution, the reward is distributed amongst all the participants. Bitcoin mining pool is a similar thing. It's a process where multiple nodes share their resources together to mine a block. Now, when a block is solved, the miners split the reward equally based on the amount of processing power they have invested. So it takes the pool members to generate a final hash value. Then it checks how much amount of work was contributed by each pool member. And as a result, the Bitcoin reward gets distributed proportionally amongst the participants. Now let's take a look at a demo on how can you see what is the Bitcoin reward. Now this is an actual block of the Bitcoin network. As you can see, this is a block, and this is the block reward, 12.5 Bitcoin. So this was a block which was mined. This is the block number, and These are the set of transactions which were part of this block. Now, once this block was mined by the miner, all these transactions then be done. These are the transfers of Bitcoin from one account to the other. This is the nonce which was generated by the miner or the mining pool in order to mine the block. And these are the other attributes. And if you take a look at this URL, this is an example of a mining pool. It's a demo account where the participants have shared their mining resources and they are mining it in a pool. And see, this is the reward for which they are mining. This is the unconfirmed reward. This is the confirmed reward. This is what they have already validated, and this is what they have earned so far. So these are the hash, these are the block numbers which they have mined.
So why wait? Let's embark on this exhilarating adventure together. But before we dive in, if you're looking to take your career to new heights and become a true expert in the realm of blockchain and cryptocurrency, consider checking out our professional certificate program in blockchain in collaboration with IIT Kanpur. It's an excellent opportunity to master key architectural principles and develop the skills needed to excel in this rapidly growing field.
Ethereum and its concepts. Ethereum. Simply put, while Bitcoin is defined as digital money, Ethereum is a decentralized platform that runs the smart contracts exactly the way they are programmed, without any downtime, fraud, and third-party interference, and also has its own cryptocurrency called Ether. Ethereum aims to enable innovations in 3 key areas: currency assurance through Ether, which serves as an innate currency for the Ethereum blockchain; decentralized autonomous organization; smart contracts. Features of Ethereum. The first feature of Ethereum is that it is secure because it is almost impossible to tamper with the transactions in the block or to add any fraudulent blocks in the network. The second feature of Ethereum is its community following. Ethereum has attracted a lot of attention from people all over the world. The third feature of Ethereum is its corporate-friendly structure. The platform is being leveraged by a number of corporates to test and build various applications. The fourth feature that we will take a look at is the possibility of creating new assets on Ethereum blockchain that can be used as currency, a representation of an asset, a virtual share, a proof of membership, or anything at all. The next feature is the ability of Ethereum to process the transactions fast. While Bitcoin requires a block time of 10 minutes, in Ethereum, it's only a few seconds. The last feature that we will discuss is the fact that Ethereum is uncensored. Ethereum's open source network allows complete transparency to view every transaction. All right, that's all about the features of Ethereum. Let me tell you about an important concept in Ethereum called gas. Gas in Ethereum. Gas is the fundamental block of Ethereum ecosystem that is paid for every operation performed on the Ethereum blockchain. It is the crypto fuel for Ethereum. It can be considered a transaction fee which has to be paid when one party sends ethers to another party. Even when a person deploys a smart contract on the Ethereum blockchain, a transaction fee needs to be paid for that as well. This payment has to be made regardless of whether the transaction succeeds or fails. Gas price is expressed in Ether, and the miner decides whether to refuse the transaction process or not based on the expected gas price. One can see their transaction fee in ETH or USD when searching for the transaction on etherscan.io. When somebody refers to gas, they are either talking about gas price or gas limit. The total cost of a transaction is the product of gas limit and gas price. The gas limit is defined as a limit since it's the maximum amount of units of gas one is willing to spend on a single transaction. This avoids situations where there is an error somewhere in the contract and you end up spending a very high amount of gas. However, the units of gas required for a transaction are defined by the amount of code executed on the blockchain. Lowering the gas limit below the amount required will not help much. If enough gas to cover the computational resources of the network is not supplied with the transaction will fail due to an out-of-gas error. So, gas is a commodity which is essentially a cost of using the system. Like Bitcoins, Ethereum also has its currency, which is called Ether. Ether. It is an incentive that the client of the platform pays to execute requested operations. It ensures that the developers write error-free codes because unnecessary codes will increase the cost. Ethereum is a blockchain-based platform, and Ether is the cryptocurrency that fuels the platform. It is commonly denoted as ETH. Let's have a look at the differences between Bitcoin and Ether. Bitcoin versus Ether. The first difference is in the hashtag algorithm used by these cryptocurrencies. While Bitcoin uses SHA-256 to encrypt blocks of blockchain, Ethereum uses Ethash to encrypt blocks. Technically, both are one-way cryptographic hash functions. The second difference is in the use of Bitcoin and Ether. As we have discussed earlier, Bitcoin is only used for financial transactions like purchase and sale of goods and services. However, Ethereum, being a Turing-complete platform, also supports smart contracts and decentralized applications. The third difference is in the price of the two cryptocurrencies. Currently, the price of BTC is approximately $3,500 while that of ETH is approximately $100. The market cap of BTC is almost 6 times greater than that of BTC, even though ETH has a higher circulating supply. The fourth difference is in the vision behind creation of these two cryptocurrencies. BTC is a currency created to compete against the gold and fiat currencies by acting as an alternative. However, ETH is created as a token to facilitate smart contract deployment and operations. Lastly, the transaction speed of BTC is much slower than ETH. While BTC's transaction speed is measured in minutes, ETH is just a few seconds. Like Bitcoins, Ethers are also stored in cryptocurrency wallets. Let's understand what are wallets in Ethereum. Ethereum Virtual Machine, Ethereum Wallets. A wallet is the place to securely store ethers and other cryptocurrencies. Basically, a wallet stores the means of accessing your currency using the private key. Now that I have told you about the Ethereum and its currency, it will only be fair that I explain EVM now. EVM. Ethereum Virtual Machine, abbreviated as EVM, is an engine which executes translation code. Smart contracts are compiled into bytecode, which an EVM can read and execute. The Ethereum Virtual Machine can be regarded as a quasi-Turing complete machine. It possesses its own programming language, known as the EVM bytecode. Once the code is written in higher-level programming languages, the code can be compiled to an EVM bytecode. The Ethereum Virtual Machine uses a set of instructions called opcodes to execute specific tasks. Thus, if a user triggers a transaction of 5 ETH using his desktop wallet, the wallet sends the message to the EVM, which connects with the wallet address on the Ethereum network to process the transaction and send it to the receiver. Smart contracts are written in Ethereum-specific programming languages. Let's learn more about these languages. Ethereum languages. Every contract written for Ethereum is compiled into the EVM bytecode and deployed to Ethereum blockchain for execution. Ethereum uses the following languages. The first language is Solidity. Solidity is an object-oriented, high-level language used for implementation of smart contracts on the Ethereum blockchain. Solidity was influenced by Python, C++, and JavaScript. It is designed to target the EVM. The second language is a low-level Lisp-like language. Abbreviated as L, it is one of the original Ethereum smart contract programming languages and is similar to assembly. It is meant to be a very simple and minimalistic language, essentially serving as a tiny wrapper over coding in EVM directly. The third language is Viper, which is a contract-oriented programming language influenced by Python. The fourth language is Serpent, which is an assembly language that compiles to EVM code that is extended with various high-level features. The next language is Muton. Muton is similar to C-like language and supports a dynamic, full higher-level language. It compiles to native Ethereum assembler. However, Muton is now deprecated. The last language is Julia. It is an intermediate language that can compile to various different backends like EVM 1.0, EVM 1.5, and EWASM. Let me now tell you about the accounts handled by Ethereum. Types of Ethereum accounts. Externally owned accounts. EOA is an account controlled by a private key that has the ability to send ethers and messages from it. Following are some of the properties of an externally owned account. Firstly, it has an ether balance. Secondly, it can send transactions. Thirdly, it is controlled by private keys. And fourthly, it has no associated code. Smart contract. Smart contract is a code running on top of the blockchain, containing a set of rules for the nodes to agree upon so that they can interact with each other. As an account, it has the following properties. Firstly, it has an ether balance. Secondly, it has an associated code. Thirdly, a code execution is triggered by transactions or messages received from other contracts. And fourthly, when executed, it performs operations of arbitrary complexity. Some of the advantages of smart contracts are as follows. First, smart contract is the simplest way of implementing decentralization. Second, it provides a high degree of security. Third, it eliminates the need for a third party. Fourth, it provides automatic agreement enforcement. Fifth, it turns legal obligations into an automated processes. And lastly, it lowers the transaction cost. Characteristics of smart contracts. Smart contracts are self-verifying and self-executing. They operate autonomously to execute the terms of the contract and verify the transactions without the need of a third-party intervention. The elimination of third parties reduces the cost of operations and further makes the contracts tamper-resistant. Process of smart contracts. In this slide, we will understand how the smart contract works. First, an optional contract between the parties is written as a code into the blockchain. The individuals involved are anonymous, but the contact is made through a public ledger. Then, a trigger event like an expiration date or a strike price is hit, and the contract executes itself according to the coded terms. Next, regulators can use the blockchain to understand the activities in the market while maintaining the privacy of an individual's position. Let me show you the implementation of smart contract in a simple use case. Smart contract example. Here we have an example showing the purchase and sale of a house. Thus, once a buyer is matched with a seller, all assets are sent into the contract. The contract then distributes the assets based on certain predetermined conditions agreed between both parties and coded into the smart contract. Thus, the settlement is automated and the ownership becomes undisputed due to the transparency of blockchain. EOA versus smart contract. In this slide, we will understand the difference between an EOA and a smart contract based on 4 critical properties. Nonce. In an externally owned account, nonce represents the number of transactions sent from the account's address. However, in a contract account, the nonce is the number of contracts created by the account. The next property is balance. This number shows the amount of WEI owned by the address, whether the EOA or the contract account. Each ether is divided into 1E plus 18 WEI. The next property is code hash. It is the hash of the Ethereum virtual machine code of an account. This is the code that gets executed if this address receives a message call. It is immutable and thus it cannot be changed once the construction is done. For externally owned accounts, the code hash field is the hash of the empty string. For contract accounts, this is the code that gets hashed and is stored as the code hash. The last property is storage root. It is a 256-bit hash of the root node of a Merkle tree that encodes the storage contents of the account encoded into the tree as a mapping from the keycac 256-bit hash of the 256-bit integer keys to the RLP encoded 256-bit integer values. This tree encodes the hash of the storage contents of this account and is empty by default. That was all about the Ethereum concepts and accounts. Let's understand the process of mining now. Ethereum mining. Ethereum mining. Ethereum makes use of proof-of-work mechanism to ensure security. The algorithm used in Ethereum is called Ethash. Each time an Ethereum transaction is made, a miner is responsible for ensuring the authenticity of information and updating the blockchain with the transaction. Let's consider an example where Bob wants to send 1 ETH to Alice. Now we will take a look at the step-by-step process that is followed in order to confirm this transaction through mining. First, Bob attempts to send Alice 1 ETH. Once Bob's transaction is initiated, it is combined with other transactions that have occurred in the last block. The miners will then validate the block with a new set of instructions. Once validated, the miner creates a new block and is rewarded for it. Thus, Alice receives 1 ETH after the transaction is validated. Ethereum mining. The term transaction is used in Ethereum to refer to the signed data package that contains a message to be sent from an EOA to another account on the blockchain. Ethereum blocks contain 2 things, a transaction list and a recent state of the ledger that comprises these transactions. In the example shown on the screen, we can see a transaction where one wallet sends 20 ETH to another wallet. The diagram shows the previous state and the next state for the transaction. State storage. The states are assembled into a state tree that is linked to the account and the block. The Ethereum includes state roots that store the root hash of the hash tree, which represents the system state when the block was created. Now we will take a look at the step-by-step process to see how Ethereum stores transactions. First, a hash is generated for each transaction. Then pairs are selected and a hash is generated for each pair. This way, the last remaining hash becomes the root. The block header as seen in the image on the screen contains the previous block hash and 3 Merkle trees. These trees are to maintain the state, to maintain the transactions, and to maintain the receipts. Also, each block always refers to its previous block's hash. Ethereum ecosystem. Types of Ethereum tools. The Ethereum ecosystem consists of 8 major tools. They are Geth, Ganache, Parity, MetaMask, Mist Wallet, Swarm, IPFS, Whisper. Now, let's move forward and take a look at each of these in detail. Geth. Geth is a multi-purpose command line tool that runs an Ethereum node implemented in Go. It is the official Golang implementation of the Ethereum protocol and is commonly used to interact with the Ethereum network. Though there are several ways to download Geth, the fastest one is to get it from the ethereum.org website. Next, we have Ganache CLI. Ganache CLI. Ganache CLI is a customizable and fast emulator for blockchain, which permits making calls to blockchain without the need for running an actual Ethereum node. Following are some of the properties of Ganache. Firstly, transactions are mined instantly. Secondly, no transaction cost. Thirdly, accounts can be recycled, reset, and instantiated with a fixed number of Ether without the need for faucets or mining. Fourthly, gas price and mining speed can be modified. Fifthly, a convenient GUI gives you an overview of your test chain events. Parity. Parity is the fastest, lightest, and most secure Ethereum client that provides the core infrastructure essentials for quick and reliable services. Parity is written in Rust language. It offers better reliability, code clarity, and performance. It is an Ethereum client that is integrated directly into your web browser. Apart from allowing the users to access the functions of basic Ether and token wallet, it also serves as an Ethereum GUI browser. It provides access to a diverse range of Ethereum features, including DApps. MetaMask. MetaMask turns Google Chrome into a browser that allows the users to send and receive transactions and also fetch data from the blockchain. It is a browser-based wallet which can be added as a plugin to your Chrome browser. It permits you to run Ethereum DApps directly from your browser without the need for running a full Ethereum node. MetaMask accounts. Practically, it is unrealistic for everyone in the world to run a node to interact with the Ethereum blockchain. To overcome this, MetaMask hosts a number of nodes so you don't have to. A user simply needs to install MetaMask and can automatically get connected to the nodes. Thus, you can use the Ethereum blockchain seamlessly. Let's talk Mist, which is another important tool of the blockchain ecosystem. Mist Wallet. Mist Wallet is the end user interface for Ethereum that is developed for browsing and using DApps. Mist is an official Ethereum wallet. It was developed and distributed by the team which is responsible for the management of Ethereum ecosystem. It is usually used by developers who want to create, deploy, and use smart contracts. It is a full node wallet, which means you'll have to download the entire Ethereum blockchain onto your computer. Some of the applications of Mist Wallet is as follows. First, sending and receiving transactions. Second, storing Ether. Third, creating multi-signature wallets. And fourth, deploying smart contracts. Swarm. Swarm is a platform which supports distributed storage and provides content distribution services. It acts as a native base layer service of the Ethereum Web3 stack. It provides sufficient decentralization and redundant storage of Ethereum records to distribute blockchain data as well as DApp codes. It leverages the underlying Ethereum infrastructure through the use of contracts and ethers to encourage cooperation among nodes. The files are split into pieces and are stored in the nodes of the network. An accounting protocol is used by peers to keep track of these chunks delivered and received and resulting micropayments associated with it. IPFS. IPFS is a decentralized storage system that is not related directly to Ethereum, but can be integrated with it. IPFS stores data by use of a distributed hash table, or DHT. Once we know the hash, we request the peer network, who has a copy of the content located at the corresponding hash, and then we download the content from the node who has the desired data which we need. The data transfer between the nodes in the network uses a mechanism which is similar to the one used in BitTorrent. It also provides a versioned file system capable of storing files and tracking versions over time. Thus, it defines how files move across a network, making it a distributed file system. By combining all of these properties, IPFS is enabling a new permanent web and augmenting the way we use existing internet protocols like HTTP. Whisper. Whisper is an identity-based communication protocol for DApps to interact with each other. DApps that need to publish small amounts of information to each other and have the publication last some substantial amount of time prefer using Whisper. For instance, a DApp running a currency exchange may use Whisper to record an offer to buy a currency at a pre-agreed price on the exchange platform. Some of the drawbacks of Whisper are as follows. It has low-level API which is only exposed to DApps and never to users. Second, it has low bandwidth and is not designed for large data transfers. Third, it has uncertain latency. And lastly, it has no reliable methods for tracing packets. Ethereum frameworks. We'll look at two types of Ethereum frameworks. Web3.js. Web3.js is a set of libraries which permit one to interact with a remote or local Ethereum node. It can be done with the use of IPC or an HTTP connection. The key connection between Ethereum network and DApp that allows you to compile, deploy, and interact with smart contracts is called Web3.js. It gives us a way to build a website or client that can talk to the Ethereum blockchain. Let's take an example of traditional development. When you develop a website, it talks to APIs using JSON or jQuery to make AJAX calls. A website talks to blockchain using Web3 using JSON.RPC, which is similar to making a remote procedure call. Ethereum comprises of a large number of nodes which talk to each other. We use JSON RPC to make a request to a particular node, which is like an API call. Thus, if we want to talk to a smart contract or read an account, we do it through Web3. ETH.js. It is a highly optimized, lightweight JS utility for Ethereum based on web.js. In this, all the unnecessary characters are removed from the source code and the code is reduced to 160 kilobytes. Ethereum Development Environment. The three commonly used Ethereum development environments include Remix IDE, Truffle, and Embark. Let's understand these environments in a little more detail. Remix IDE. Remix IDE is a browser-based compiler and IDE that enables users to debug transactions and build Ethereum contracts with Solidity language. You can simply log on to the web-based editor, write the code, and compile the same to create the bytecode in order to test your code. The next slide shows how Remix looks. Another popular environment is Truffle. Truffle is a development environment testing framework and asset pipeline for blockchains using the Ethereum Virtual Machine, or EVM. It helps users in developing smart contracts, publish the contracts, and test them. Then we have Embark. Embark is an environment that allows you to easily develop and deploy decentralized applications. It performs the following functions. First, automatic deployment of contracts. Second, keeping track of deployed contracts. Third, managing the complex systems of interdependent contracts. Fourth, performing test-driven deployment with contracts using JavaScript. Fifth, managing different chains like testnet, privatenet, and livenet. And lastly, redeploy the contracts if any changes are done. Let's talk about Ethereum networks. Ethereum network. The basis for decentralized consensus is the peer-to-peer network of participating nodes which maintain and secure the blockchain. A node is defined as a device or a program that can communicate with the Ethereum blockchain network. They are also referred to as clients. They provide wallet functionality and allow users to perform transactions on the blockchain. Thus, a node serves as a machine running as an Ethereum client. It is used to store the data and transfer money. It is formed by combining one or more nodes, and each node contains a copy of the blockchain. Types of network. There are three main types of networks: the testnet, the mainnet, and the private network. Ethereum DApps and DAOs. DApp. Decentralized application is an application that is used on networks with trustless protocols to avoid a single point of failure. They run on a peer-to-peer computer network. All the activity which takes place on an Ethereum decentralized application is cryptographically secured on the blockchain. DApps are open source, which means that everyone can verify the contents of the software. Some properties of DApps are as follows. It uses Ethereum as a development platform. It uses cryptographically encoded blocks. It is not governed by a central server, and there is no master copy of DApp. Let's talk about the advantages of DApps now. Advantages of DApp. Ethereum DApps have the following advantages: improved stability due to a distributed network, higher reliability, automatic credentials assigned through smart contracts, no downtime, no third-party intervention, and high security. Example of DApps. Some of the known examples of DApps include WeFund, Storage, KYC Chain, and 4G Capital. These companies have developed different applications using blockchain. Next, we have the DAOs. DAO. DAOs are organizations designed to hold assets and use the voting system to distribute them. They exist entirely on blockchain and are governed by the consensus protocols. They show the potential of blockchain to revolutionize human social institutions called DAOs. It is an organization run by rules agreed through a consensus process among its members and written in a set of contracts run via a blockchain. It is an open source software capable of modification by its members. Process of a DAO. Now, let's take an example and see how this works. Let's consider that a country is holding elections and wants to prevent fraud in the voting system. A DAO is created to keep transparency in the voting. This is ensured by embedding predefined conditions in the code. People eligible to vote are assigned voting tokens and the voting starts. Every vote is processed on the Ethereum blockchain, and it ensures transparency by allowing everything to run in a decentralized way.
So now let's take a look what's in it for all of us today. We will be talking about what is Ethereum, the features of Ethereum like cryptocurrency, smart contracts, Ethereum virtual machine, decentralized application and its uses, and decentralized autonomous organization. We'll be also looking at applications of Ethereum and a demo on smart contract deployment on a locally running Ethereum client. Now, what is Ethereum? Ethereum is a blockchain-based computing platform that enables developers to build and deploy decentralized applications. So basically, Ethereum is a platform where we can build applications which are not run by a centralized authority. You can create a decentralized application where the participants of that particular application are the decision-making authority. So here we can see Ethereum allows us to build and deploy DApp applications. Now, what are the typical features of Ethereum? Ethereum allows you to use its own cryptocurrency called ETH. It allows development and deployment of smart contracts. It provides you the underlying technology, the architecture, the software which understands smart contracts and allow you to interact with it, which is called Ethereum Virtual Machine. Then it allows eventually to create consolidated applications called decentralized applications, and also it allows you to create decentralized autonomous organization. Now let's talk about Ethereum cryptocurrency. ETH is a cryptocurrency that runs on Ethereum network. Basically, it is the fuel which is running the Ethereum network. It is used to pay for the computational resources and the transaction fees for any transaction to be executed on a Ethereum network. Like Bitcoin, Ether is also a peer-to-peer currency. Apart from paying for transaction, Ether is also used to buy gas, which is used to pay for computation of any transaction you make on a Ethereum network. Also, if you have to deploy a contract on Ethereum network, you will need gas and you would have to pay for that gas in ethers. So gas is the execution fee paid by a user for running a transaction in Ethereum. Ether can be utilized for building decentralized applications, for building your smart contracts, and making standard peer-to-peer payments. Now, what is a smart contract? A smart contract is a simple computer program that facilitates the exchange of any valuable asset between two parties. It could be money, it could be shares, it could be property, or it could be any other digital asset which you want to exchange. These contracts can be created by anyone on the Ethereum network, and primarily the contract consists of the terms and conditions mutually agreed between the parties, between the peers. And the primary feature of a smart contract is that once it is executed, it cannot be altered, and any transaction done on top of a smart contract is registered permanently. It is immutable. So even in future you modify the smart contract, the transactions correlated with the original contract does not get altered, or you cannot modify them. So for the verification process, smart contract is carried out amongst the anonymous parties of the network without the need of a centralized authority. And that's what makes any smart contract execution on Ethereum a decentralized execution. It provides the transfer of any asset or currency in a transparent and a trustworthy manner. As the two entities are totally unaware, their identity is secure on the Ethereum network. Though the transactions once successfully done, the accounts of the sender and receiver are updated accordingly, and thereby it generates a trust between the parties who are transacting using the Ethereum network. Now, what happens in traditional system of contract? In traditional systems of contract, you sign an agreement, then you trust a third party, hire a third party for execution. Now, the problem is that in such an engagement, the data tampering is possible. Now, if we talk about the new smart contract, the agreement is coded in a program. Now, result is not verified by a centralized authority. It is verified by the participants on Ethereum based blockchain network. Now, once a contract is executed, the transaction is registered and it cannot be altered or tampered. So it removes the risk of any data manipulation or alteration. Now, let's take another example where Jack has given a contract of $500 to Elsa for developing his company's website. Now, the developers code the agreement of smart contract using Ethereum's programming language. Now, the smart contract has all the conditions, the requirements for building the website. Once the code is written, it is uploaded and deployed on the Ethereum EVM virtual machine. EVM is a runtime compiler to execute your smart contract. Once the code is deployed on the EVM, every participant on the network has a copy of the contract now. Now, when Elsa ELSA submits the work on Ethereum for evaluation. Each node on the Ethereum network will evaluate and confirm whether the result given by ELSA is done as per the coding requirements. And once approved and verified, the contract worth $500 will be self-executed and the payment will be paid to ELSA in Ethers. So John's account, the person who had gone into a contract, his account will be automatically debited and ELSA will be credited with $500 in Ether denomination. Here we will now take a look. We will do a demo, small demo on a deployment of a smart contract. So in order to execute our smart contract, we will need two set of softwares, Ganache and Truffle, and we will show you in the demo how to install these two softwares on your machine. Now we will be giving a demo on the following smart contract. This is a smart contract where we are writing a simple contract of a greeter. We have a variable called greeting, which we will be initializing using a constructor, and then in our demo we will be showing how you can change the value of the variable greeting using the setGreeting method and read the value using the greet method. This is the other contract where we will be defining that whoever is deploying the contract on the blockchain network is always the owner of the contract. And then we have defined certain mandatory functions in order to kill the contract on the Ethereum network. So only the owner of the contract can kill it. Now let's talk about what is an Ethereum virtual machine. Ethereum virtual machine is designed to operate as a runtime environment for compiling and deploying Ethereum based smart contracts. Basically, EVM is the engine which understands the language of smart contracts which are written in Solidity language for Ethereum. EVM is operated in a sandbox environment. Basically, you can deploy your own standalone environment which can act as a testing and a development environment, and you can n number of times test your smart contract, deploy it, verify it, and then once you are satisfied with the performance and the functionality of the smart contract, you can deploy it on the Ethereum mainnet. Now, any programming language in the smart contract is compiled into the bytecode which the EVM understands. This bytecode can be read and executed using an Ethereum feature called Ethereum virtual machine. So basically, EVM machine understands the bytecode. So one of the most popular languages for writing a smart contract is Solidity. So once you write your smart contract on Solidity, that contract gets converted into the bytecode and gets deployed on the EVM. And thereby, EVM guarantees security from cyber attack. Now, how does EVM work? So suppose A wants to pay B 10 ethers. The transaction will be sent to the EVM using a smart contract for a funds transfer from A to B. Now, in order to validate the transaction, the Ethereum network will perform the proof of work consensus algorithm. The miner nodes on the Ethereum will validate this transaction, whether the identity of A exists or not. A has the relevant amount of balance to transfer 10 ether to B, and will validate the transaction. Once validated, the ether will be debited from A's wallet and will be credited to B's wallet. And during this course, the miners will charge a fees in order to validate this transaction and will earn a reward. Now, all the nodes on Ethereum network execute smart contract using their respective EVMs. Now, how does proof of work works? Every node in the Ethereum network has the entire history of all the transactions, the entire chain. It has the history of smart contract, basically the address at which the smart contract is deployed, the transactions associated with the smart contract, and also it has the handle to the current state of the smart contract. Now, the goal of the miners on the Ethereum blockchain network is to validate the block. For each block of transaction, miners use the computational power and resources to get the appropriate hash value by varying the nonce. Now, the miners will vary the nonce and pass it through a hashing algorithm. In case of Ethereum, it is the @hash algorithm. This produces a hash value which should be lesser than the predefined target as per the proof of work consensus. If the hash value generated is less than the target value, then only the block is considered to be verified and the miner gets rewarded only then. Now, when the proof of work is solved, result is broadcasted and shared with all the other nodes in order to update their ledger. If other nodes accept the hash block as valid, then the block gets added to the Ethereum mainnet blockchain. And as a result, the miner receives a reward which as of today stands at 3 Ether, plus the miner receives the transaction fees which has been generated for verifying the block. All the transactions which are aggregated in the block, the cumulative transaction fees associated with all the transactions is also rewarded to the miner. Now, do you know, in Ethereum, a process called proof of stake is also under development, and it is an alternative to proof of work. It is meant to be a solution to minimize the use of expensive resources spent for mining using proof of work. Now, in proof of stake, the miner is actually the validator, can validate the transactions based on the amount of crypto coins he or she holds before he or she can start the mining. So based on the accumulation or the repository of crypto coins with the miner beforehand will give him the higher probability of mining the block. Now, however, proof of stake is not widely adopted as of now as compared to proof of work algorithm. Now let's understand the concept of gas. Now, Ethereum virtual machine has a concept of gas, and why do we need it? So like we need fuel to run car, in the same way, in order to run application on Ethereum network, we need gas. Now, what is gas? To perform any transaction on Ethereum network, a user has to make a payment, has to shell out ethers in order to get the execution done, the transaction done, and the intermediary monetary value is called as gas. On Ethereum network, gas is a unit that measures the computational power required to run a smart contract or a transaction. So if you have to do a transaction which is updating the blockchain, you would have to shell out gas, and that gas will come with a price in ethers. Now, how is the gas fees calculated? In Ethereum, the transaction fees is calculated in Ethereum using the below formula. For every transaction, there is a gas and the correlated gas price. So the amount of gas required to execute a transaction multiplied by the gas price, you generate the transaction fees. So gas limit on Ethereum network refers to the amount of gas which is used for the computation and the amount of ether a user is required to pay for the gas. Now here we have a screenshot from the Ethereum mainnet where the cost of transaction is being shown. So if you see, for this particular example transaction, the gas limit was 21,000, the gas used by the transaction was 21,000, and the gas price was 21 GUI, which is the lowest denomination. So 21 GUI into 21,000 gave you the actual transaction fees, which is 0.000441 ether, which is approximately 0.21 cents as of today's ether market value. Now this transaction fee goes to the miner who has validated the transaction. To understand the gas limit and the gas price in a better way, let's consider an example of a car. Suppose your car has a mileage of 10 kilometers and the price of petrol is $1 per liter. Then driving a car for 50 kilometers will cost you 5 liters of petrol, which will be worth $5. Similarly, to perform an operation or to run a code on Ethereum, you need to spend certain amount of gas like the petrol, where each gas has a per unit price called gas price. Now, if a user provides less amount of gas to run a particular operation, then the process will fail and the user will be given a message of out of gas. And GUI is the lowest denomination of ether, which is used for measuring unit of a gas price. Now, how is Ethereum's mining different from Bitcoin mining? The hashing algorithm is the primary difference. The Bitcoin uses SHA-256, Ethereum uses ithash. The average time taken on Bitcoin for mining a block is 10 minutes, whereas in Ethereum it is 12 to 15 seconds. As of today, the mining reward for Bitcoin is 12.5 BTC, but for Ethereum it is 3 ethers plus the transaction fee, the accumulated transaction fee for all the transactions for a block. Now, as of 23rd July, the Bitcoin value was $7,667, whereas 1 ether stands at $466. Now here we have a screenshot of an Ethereum reward which has been given to the miner of the block. Now, as you can see, here is the breakup of the reward: 3 ethers plus the total accumulated transaction fee of all the underlying transactions in this block, which is 0.0666 ethers. Now, what is a decentralized application? Now let's compare it with our traditional applications, our traditional websites which are currently running. So for example, when you log into Twitter, a web application gets displayed which is rendered using an HTML page. Now the page will call an API to access your personal data, your information, which is centrally hosted. Now it's a simple process. The front end executes a backend API and the API goes and fetches the information from a centralized DB. Now if we transform this application into a decentralized application, then now when you will log in, the same web application will get rendered, but it will be calling a smart contract based API to fetch the information from the blockchain network. So the API gets replaced with the smart contract interface, and the smart contract will fetch the information from the blockchain network, which is its backend. And that blockchain network is not a centralized DB, it's a decentralized network where the participants of the network, the miners of the network, are validating, verifying all the transactions which are happening using the smart contract on the blockchain network. So thereby any transaction or any action happening on a Twitter kind of application which has been transformed will now cannot be claimed as a centralized transaction. It will be a decentralized transaction. A DApp, a decentralized application, consists of backend code that runs on a distributed peer-to-peer network. It is a software designed to work on an Ethereum network without being controlled by a centralized system, and that is the primary difference. It provides the direct interaction between the end users and the decentralized application providers. Now, an application qualifies as DApp when it is open sourced, its code is there on GitHub, and it uses a public blockchain based token in order to run the application. A token acts as a fuel for the decentralized application to run. DApp allows the backend code and data to be decentralized, and that is the primary architecture of any DApp. Now let's discuss what are decentralized autonomous organizations. DAOs is a digital organization that wants to operate without any need of a hierarchical management. It wants to operate in a decentralized and a democratized fashion. So basically a DAO is an organization where the decision making should not be in the hands of a centralized authority, but it should be in the hands of certain designated authorities or a group of designated people as a part of authority. It exists on a blockchain network where it is governed by the protocols embedded in a smart contract, and thereby they rely on a smart contract for decision making. All the business decisions are driven by the smart contracts, or we can say a decentralized voting system within the organization. So any organizational decision before being taken has to go through the voting system which is running on a decentralized application. So how it works? People add funds to the DAO because DAO requires funding in order to execute and take decisions. Based on that, each member is given a token on a percentage basis which represents the percentage of shares of that particular member in the DAO. Now those tokens are used to vote in the DAO where the proposal status is decided based on the maximum votes. So every decision within the organization has to go through this voting process. Now let's take a look what are the applications of Ethereum in real world and where it is getting used. So as we have seen with DAO, voting systems are adopting it. The results of the polls are publicly available where it ensures a transparent and fair democracy by eliminating voting malpractices. It is getting adopted widely in a banking scenarios and banking systems. With Ethereum's decentralized system, it is becoming very difficult for hackers to have unauthorized access, and it also allows payments on a Ethereum based network. So banks are also using Ethereum as a channel to make remittances and payments. Shipping. Deploying Ethereum in shipping helps tracking of cargo and prevents goods from being misplaced or counterfeited. So basically Ethereum is providing you the provenance and tracking framework for any kind of asset required in a typical supply chain. Now with Ethereum's smart contract, agreements can be maintained and executed without any alteration. So any industry which has fragmented participants is subject to disputes and which requires and digital contracts to be present, then Ethereum can definitely be used as a technology for developing your smart contract and digitally recording the agreements and the transactions based on those agreements.
So let's get started for a demo on how to deploy an Ethereum smart contract locally. So in order to deploy a smart contract, we will be first installing Ganache client, which allows you to host a local Ethereum client on which you can deploy your smart contract. So as we are working on the Windows environment, when we are downloading the Ganache setup, we can also download Node in order to install Truffle on our machines. Now as the node has been downloaded, we will install Node. So now Node is successfully installed. Now we are going to install Ganache locally. Now we will run Ganache a little later. Before that, we will perform certain steps, or we can run Ganache and see. So once Ganache is up and running, I'll show you the interface, how it looks. So when Ganache is brought up, it automatically creates 10 accounts with pre-funded balance of 100 ethers. It is running on localhost port number 7545. Now as you see, there is no transaction or anything which has currently happened. So the current block is 0, which is the Genesis block. There are no transactions and there are no blocks as of now. So there are no transactions in block which have been generated. So using this Ganache client, now we will be deploying our Greeter contract. Now as we have installed Node, we will be installing Truffle. Truffle is the utility which allows us to compile and deploy Ethereum contracts. Okay, now once Truffle is installed, we need to create a directory called Greeter. Now we need to run the command truffle. Now once we run this command, Truffle by default creates a package structure which has 3 folders called contracts, migrations, test, truffle.js and truffle config. Now we will be writing our smart contract called greeter.sol and we will compile and deploy. Basically our greeter.sol will be under contracts folder and we can our contract is created and it is lying under contracts folder. Now we need to add another file under migrations folder called as deploy contract.js. So we will name it as deploy contract. Now in this deploy contract, we need to put line of code. Now in this file, we are asking Truffle to deploy our newly created greeter.sol file. Now in the greeter contract, we have a constructor. We are initializing the greeter contract with a value hi hello and we are passing a gas value. So this gas is currently at a higher limit and we know that this gas value, the contract will get executed. But otherwise, you can also evaluate the gas value of a contract using Remix. Now once this file is being saved, you go to the truffle.js and make the following entry. Now here we are telling Truffle that our localhost Ganache client is running on localhost at port number 7545 and network ID can be anything, though the current Ganache client is running on port network ID 5777, but we have kept it open that we can connect to any network ID. Now after this step, I need to go back to my command prompt and say truffle compile. Now, if you get this error, if we are getting this kind of error in Windows, then need to do one quick fix. We need to go to the users directory and rename truffle.cmd to truff. So I'll go to my C drive, users, update, roaming him, just now here now instead of truffle I have to say truff. Now there might be certain compilation warnings, we can ignore that. Now my contract is being compiled. Now I need to run the next command, truff migrate. At this stage, my smart contract is deployed, and now you can see this is the place where the contract has been called, and this is the transaction where the default value of my variable greeter has been set to hi hello. So we will see. Now I need to run command truff console to interact with my contract. Now as on my truff console, I can check at what address is my contract deployed. So my contract is deployed at address 0x37, which matches with the address 0x373. Now I need to check the default value which I had set while deploying my contract. So this is my value, hi hello. Now I can change the value to something else, because in my greeter contract I have a method called set greeting. Now when I'll be performing this action, a new block will get generated and the block count will increase from 4 to 5 because I'm making a change on the blockchain. As you can see now, a new transaction has been created. This was the gas used. This is the default gas price in Ganache, and block number 5 is being mined. Now I can reread the value of the variable. Now it will return me the latest value, which is change greet value. So this demonstrates how to use a Solidity contract, how to compile it, deploy it on a locally running blockchain network. You can connect multiple nodes to this Ganache client, and all the nodes should be running on the same network ID, should have the same network ID, but they can be running on a different machine. So here we can see all the other details, the block, the transactions which have happened. If I perform the action again, block number 6 has been generated, has another transaction associated with it, and I can get the latest value.
So why wait? Let's embark on this exhilarating adventure together. But before we dive in, if you're looking to take your career to new heights and become a true expert in the realm of blockchain and cryptocurrency, consider checking out our professional certificate program in blockchain in collaboration with IIT Kanpur. It's an excellent opportunity to master key architectural principles and develop the skills needed to excel in this rapidly growing field.
In this video, we will explore Ethereum mining and will go through some of the fascinating concepts and components revolving around it. First, we will have an introduction to Ethereum. Then, we will understand what is Ethereum mining. Then we will explore why should we mine Ethereum. We will look into the types of Ethereum mining. And then we will understand how the Ethereum mining process works. Then we will explore how exactly to mine Ethereum. Then we will discuss, will the proof of stake transaction kill proof of work? And then finally, we will find out, is mining Ethereum profitable? So without doing much ado, let's get started with the video. Let's bring you up to speed on Ethereum. Ethereum is defined as a blockchain-based computing platform that enables its developers to build and deploy decentralized applications and make sure all the transactions are cryptographically secure in the network. Ether is the cryptocurrency of Ethereum, used to build decentralized applications, smart contracts, and make standard peer-to-peer payments. Ether basically acts as fuel for the Ethereum network. It tracks and facilitates all the transactions. So that brings us to what is Ethereum mining. In simple words, Ethereum mining is a process of creating and adding a block of transaction to the blockchain network of Ethereum. It uses the proof of work consensus mechanism for mining Ethereum. All transactions taking place in the Ethereum network needs to get approved by the miners. Miners is a community of people using a hashing script eThash to solve computationally hard puzzles for successfully mining the blocks of transactions in the Ethereum blockchain network, which helps secure the network from attacks like hacking or manipulation of identity. Now let's understand why we need to mine Ethereum. The primary goal for mining Ethereum is to make money. Ethereum mining turns the act of securing the network into a relatively complex but profitable business. Also, miners receive a certain amount as a reward for mining each block of the Ethereum blockchain network, including the transaction fees paid by the users. Thus, Ethereum mining benefits each and everyone participating in Ethereum blockchain network. So, what are the types of Ethereum mining? Ethereum mining can be performed in three ways: Ethereum solo mining, Ethereum pool mining, and Ethereum cloud mining. In Ethereum solo mining, you will get rewarded only if you solve the puzzle and mine the Ethereum block first. Since here you are competing with many people and companies, you have to be very good at your work. Also, solo mining is only profitable when you have plenty of resources with you, like 100 plus graphics cards. And in solo mining, having so much equipment may use a lot of electricity and space, leading to high electricity bills, and not everyone has a considerable amount of area needed. Ethereum pool mining is the easiest and fastest way to get started with Ethereum mining. In this, you work along with other people together in a single pool, and if someone from the pool gets the hash code correctly, they share the reward among everyone in the pool. We should consider a few important factors before joining a pool, like pool size, minimum payout, and pool fee. Pool size determines the number of blocks you find in the Ethereum network, and it shares rewards. As the number of miners increases, the chances to get rewards also increase. Minimum payout is the minimum amount of Ethereum you need to mine before it gets credited to your wallet. And pool fee is the amount you need to pay to continue using the pool. This amount is percentage based on the amount of Ethereum you're mining. Ethereum cloud mining, you pay someone else with the equipment to mine Ethereum for you. You pay some amount of money as fees to them for investing their time and resources. And in return, they provide you with the reward they gain by the mining Ethereum. But this technique of mining Ethereum has some pros and cons too. Pros, you're not responsible for any equipment damage. You don't have to acquire all the necessary equipment and look for ample space to store it. You can sit back, observe the market, and enjoy the reward for your investment in Ethereum mining. Cons, if the Ethereum price drops, then there is no way you are getting your money back. The money you invested or the fees paid to the miner is lost. And you can't ask the other person to change the equipment according to your concern. Ethereum cloud mining is considered a safer way for mining service providers to guarantee a profit for the resource they have purchased. Now let's understand how the Ethereum mining process works. Ethereum mining follows a specific set of steps to function. Step 1. A user requests a transaction with the help of the private key of his digital wallet account. Then the request is shared worldwide with the Ethereum network. Next, the requested transaction is added to a list of pending transactions that needs to be added to the Ethereum blockchain network. Step 4. The miner then verifies and validates the requested transaction and perform a complex mathematical puzzle on the transaction data. Step 5. Once the request transaction is verified and it stores a copy of it in Ethereum, The process of proof of work begins for the respective block. Step 6. When the nodes of the Ethereum network verify that the checksum of the state of the miner's block matches the checksum of the updated state of the EVM after execution of all transactions. Step 7. Only after that the block is added to the Ethereum blockchain network. Step 8. On successfully mining the block, it rewards the miner with some amount of Ether in their wallet. The block reward of Ethereum is 3 Ether. At step 9, the requested transaction is approved and credited to the respective wallet or wallets. Each transaction is mined only once, but every participant of the Ethereum network verifies it. This makes me curious about how to mine Ethereum. Tools you will need to be an efficient miner for Ethereum on your personal computer are an Ethereum wallet to store all your currency earned, GPU drivers or graphics card with a minimum of 3 GB RAM, a mining software suitable according to your hardware like GPU, and a compatible operating system, Windows 7 or 10 with 64-bit. Before getting started with mining Ethereum, you need to create an Ethereum wallet to store all your Ether. Trezor Model T and Ledger Nano are the most reliable and secure wallets in the market of cryptocurrency. Installing GPU drivers or graphics card after creating your digital wallet, you need to update all the hardware, that is, drives in your system. You can use two types of graphics card. They are AMD graphics card and NVIDIA graphics card. Claymore is considered the best software for mining Ethereum on GPU drivers. Now, we need to follow a few set of steps to get started with mining. Step 1. Download the latest version of Claymore Dual Miner for your operating system. The latest version is Claymore 11.0. Step 2. Click on the latest version for Windows and download the zip file. Step 3. Extract the files of Claymore 11.0 to a folder on the desktop for easy access. Open the folder to have a look at the files. Step 5. Right-click on Start and then on the Edit option. Step 6. Edit the start.txt file and add these lines. Step 7. Choose your desired pool from these recommendations. You can also find better search results than these according to your region. Step 8. Type in your pool address instead of mining pool address. Step 9. Save your start.txt file with your new updates. Remember, while saving, select Type as all files. And step 10. Once you save, click on the clay.bat file to begin mining Ethereum. Now let's explore will the proof of stake transition fail proof of work. The newly introduced concept of Ethereum 2.0 roadmaps plans to upgrade to proof of stake consensus algorithm in which it will provide all existing miners of Ethereum network with a limited time to earn a return for their investment. This is expected to be launched by the end of 2021 or the starting of 2022. It was supposed to be launched by October 2020, but the history of delays regarding this upgrade is worth talking about. Nobody truly knows when Ethereum 2.0 will be completed and introduced to the crypto mining world. Now, when we know all about Ethereum mining, this makes me wonder if Ethereum mining is profitable. The profit of any crypto mining majorly depends on the cost of electricity in that particular area. As a rule, anything below $0.12 per kilowatt consumed in an hour is considered profitable. You can mine Ether and turn it into a vital source of income by analyzing these figures like hash rate of Ethereum, block reward, number of blocks per day, and the coin price of Ethereum. You can also use an Ethereum calculator to figure out the daily revenue, basing it on these factors. Or you can use this formula too. The predictions are made that the Ethereum price can rise and become more stable in the coming few years. So it is an excellent opportunity to invest in and save in Ethereum.
In this video, I will take you through various important concepts and components of Ethereum Classic. First, we will look into the origin of Ethereum Classic. Then, we will understand what is Ethereum Classic, followed by why is Ethereum Classic used, what are the goals of Ethereum Classic, and after that we will see the difference between Ethereum Classic and Ethereum. After that, we will look at some of the limitations of the Ethereum Classic, and at the end we will explore what is the future of Ethereum Classic. So, without any further ado, let's get started with the video. So, let's start with the origin of Ethereum Classic. Slock.it, a German business, created the DAO, a decentralized autonomous organization or DAO initiative on Ethereum in 2016. While the project earned over $150 million through crowdfunding, hackers took advantage of a flaw in its smart contract and stole $50 million. Most Ethereum users, including creators Vitalik Buterin and Gavin Wood, favored a hard fork, or a major modification in the blockchain's underlying protocol, to recover the assets, resulting in the formation of the new Ethereum chain. However, certain members of the community opposed to the fork, preferring to follow the principle of code is law, and remained on the old chain, renaming it Ethereum Classic. They commonly refer to Ethereum Classic as the original Ethereum coin, since it preserves the ancient core of the Ethereum blockchain as it existed before the DAO assault. That brings us to the next concern, which is to understand what is Ethereum Classic. Ethereum Classic is a blockchain-based open source, decentralized distributed cryptocurrency platform that runs smart contracts. Ethereum Classic is a decentralized governance platform that leverages smart contracts embedded within a distributed ledger or blockchain network. It splits the original Ethereum blockchain into two parts, with Ethereum Classic being the older of the two and Ethereum being the newer one. Now let's proceed further and have a look at the uses of Ethereum Classic. Ethereum Classic has three major uses. The ETC, or Ethereum Classic, like other cryptocurrencies, is primarily used to pay for decentralized computations on the Ethereum network. ETC is used to pay for executing transactions and smart contract functions on the Ethereum blockchain. This is referred to as gas, and the fee associated with these actions are known as gas costs. ETC is also a native token with a monetary policy that creates a predictable disinflationary emission schedule with a fixed market supply cap. Now, let's move ahead and have a look at the goals of Ethereum Classic. The Ethereum Classic project has seen several modifications and additions since the split. The project's purpose is to develop a global payment network based on smart contracts that can operate with no centralized authority. Ethereum Classic, like other cryptocurrencies, will most likely aspire to be a digital store of value, meaning you can save and exchange it while maintaining its worth. A crypto's digital store of value includes its purchasing power, which may be swiftly converted to cash or used to purchase another asset, just like money.
If getting your learning started is half the battle, what if you could do that for free? Visit SkillUp by Simplilearn. Click on the link in the description to know more.
Now that we know all the major components of Ethereum Classic, let's dive down and have a look at how Ethereum Classic differs from Ethereum. ETC, or Ethereum Classic, is a speculative digital asset that investors may trade. But the Ethereum token, or ETH, is the more genuine and extensively traded of the two. With a market capitalization of $3.9 billion, ETC has 116.3 million coins in circulation, while ETH, on the other hand, has a market capitalization of more than $304.9 billion and around 115.6 million coins in circulation. ETC trades at $33.65, whereas ETH trades for more than $2,600 per coin. Now let's have a look at the limitations of Ethereum Classic. Although Ethereum Classic, like Ethereum, enables smart contracts and targets the same market, Ethereum has grown in popularity as the more trustworthy of the two networks. Despite numerous software upgrades, the scalability of Ethereum Classic's payment mechanism remains one of the project's largest concerns in the future. Furthermore, security is likely to be an issue with smart contracts, especially because Ethereum Classic has already been hacked and millions of dollars stolen. So this brings us to the very important question, that is, what future Ethereum Classic holds for itself. Because Ethereum is considered the more authentic of the two networks, Ethereum Classic's future appears to be less bright than Ethereum, especially given Ethereum Classic's security concerns. Ethereum Classic may have difficulties until it can modify its code and software to prevent future hacks. Well, this was all about Ethereum Classic. In this video, we will explore Ethereum 2.0 and will go through some of the fascinating concepts and components revolving around it. First, we will have a quick introduction of what is Ethereum network. Then, we will look into what Ethereum 2.0 is. Then, we will understand what led to the origin of Ethereum 2.0. Then, we will understand the changes in Ethereum 2.0. Then we will look into the current status of Ethereum 2.0 research. And at last, what future we expect for Ethereum 2.0. So without doing much ado, let's get started with the video. So what is the Ethereum network? Ethereum is defined as a blockchain-based computing platform that enables its developers to build and deploy decentralized applications. Ether is the cryptocurrency for Ethereum, used to build decentralized applications, smart contracts, and make standard peer-to-peer payments. It tracks and facilitates all the transactions and makes sure they are cryptographically secure in the network. Ether basically acts as a fuel for the Ethereum network. So what is Ethereum 2.0? Ethereum 2.0 is a set of interrelated upgrades that will make the Ethereum network more secure, scalable, and sustainable. Multiple teams from across the Ethereum ecosystem have come together to work on these upgrades in Ethereum 2.0. Then, what led to the origin of Ethereum 2.0? With growing popularity, Ether and the Ethereum network has gotten more blocked by transactions. Currently, it is capable of handling 15 to 45 transactions per second, which is comparatively impressive, but it is not enough to handle all of Ethereum's users worldwide. Also, the high demand is affecting the driving up of transaction fees. Nodes power the Ethereum blockchain network, but currently its nodes are experiencing too much volume. Although the programmers working on the upgrade have claimed that making its nodes bigger wouldn't be practical. Ethereum 2.0 intends to make the network more scalable to handle all of the activities on the Ethereum network. That makes us wonder, what are the changes in Ethereum 2.0? The two significant changes that will come with the upgrade are adopting proof of stake and sharding. Adopting proof of stake, Ethereum blockchain implementations suffer from performance issues because they rely on a processing power intensive process known as proof of work to record and validate their transactions. The problem with proof of work's design is that it's very inefficient. Ethereum 2.0 will solve these issues by transitioning its blockchain to a more efficient proof of stake system. It will decrease the complexities faced by the network, leading to massive throughput gains for the whole network. Sharding is a process that intends to enhance Ethereum's efficiency and ability to scale. In the current version of Ethereum blockchain, all data that is added to the chain undergoes verification by all participating nodes. That means that the speed of its slowest participant limits the processing speed of the entire network.
Sharding will increase the efficiency of the network resources by breaking data verification tasks among its set of nodes. And each of them will be responsible for validating and verifying just the data allotted to them. This will increase the network's overall capacity and make it much faster and efficient than its outdated version. So what is the current status of Ethereum 2.0 research? While Ethereum 2.0 has been in research and development since 2014, it has actually been making some progress. The Beacon chain went live in December 2020, introducing the staking concept, but still there is no official claim for the completion of this transition. The next phase is mainnet, merging the Beacon chain into the current Ethereum network. Mining Ethereum tokens will officially end in this phase, and staking will become the primary way to create new tokens in the Ethereum network. The last part of the transition is expected to unfold in multiple phases, like adding the shard chains to give the Ethereum blockchain network more capacity and efficiency to handle all of the demand and increase transactions per second. Although it has been a long road and there is still a good deal of uncertainty around the timing, the Ethereum developers do seem to be motivated and on their way to completing the whole transition. So, what is the future of Ethereum 2.0? If executed properly, this transition to Ethereum 2.0 could be a total game changer. It will create a modified network that could potentially process 1 lakh transactions per second, and a much more sustainable network without the energy-intensive mining process. And it will introduce smart contracts worldwide, increasing the Ethereum's network utility. Furthermore, Ethereum co-founder Vitalik Buterin once said that the issuance of new token should be highly reduced under Ethereum 2.0, which could increase its demand. Given all these factors, Ethereum 2.0 seems to hold a bright future for Ethereum blockchain network. Let's proceed further and have a look at how they both differ from each other. Did you know there are more than 1600 cryptocurrencies worldwide? And among them, Bitcoin and Ethereum have always been the top 2 most popular cryptocurrencies in the world by market cap. Also, recently, Ethereum as well as Bitcoin reached its all-time peak in worldwide trading. According to Decrypt.co, every day new companies like Me2 and PayPal are coming forward to invest in Bitcoin and Ethereum. On March 7, 2021, Me2 confirmed that it had purchased 40 million in Bitcoin and Ethereum. On the other hand, PayPal is about to launch a scheme where the public can purchase and sell cryptocurrencies, initially featuring Bitcoin and Ethereum via PayPal digital wallet. But have you all ever wondered how they compare based on their similarities and differences in various aspects? Well, before moving any further, let's have a quick look at how Bitcoin and Ethereum originated and made a benchmark in the economic system worldwide. Bitcoin was first introduced in 2009 by Satoshi Nakamoto to resolve cyber attacks, double spending, and eliminate the middleman between the transaction. It led the first revolution of digital money, which enables transparent and decentralized peer-to-peer transaction. On the other hand, Ethereum came into the picture years after Bitcoin. It was first introduced in the late 2013 by Vitalik Buterin. After that, it was very quickly and widely adopted because it offered a platform to build and run applications without any downtime, fraud, or interference of any third party. Ethereum serves as a computing platform that enables its developers to build and deploy their decentralized application. Now, let's move ahead and see the difference between them which make them compete with each other in this economy. This video will cover individual aspects for comparing Ethereum and Bitcoin's performance in that particular field. First, we will look into the introduction of Ethereum and Bitcoin. Then the algorithm they follow, the programming language, mining process of Ethereum and Bitcoin, monetary policy, transaction, and availability of these two cryptocurrencies. By time, Bitcoin has proved itself as a well-known cryptocurrency. However, Ethereum with different functionalities is giving a quite tough competition to Bitcoin.
But before moving ahead, let's have an introduction to Ethereum and Bitcoin. Ethereum is a platform that builds immutable smart contracts, an application for its users without any centralized interference. For Bitcoin, it is an alternative to fiat money or physical currency. The main function of Ethereum is to provide its users or developers with a platform to build smart contracts using dApps or decentralized application. On the other side, Bitcoin only intends to be a medium of exchange of money and value stored in its blockchain network. Now let's get started and move towards the first comparison, which is algorithm. Ethereum uses the Ethash cryptographic algorithm for mining blocks in the Ethereum network. On the other hand, Bitcoin uses the SHA-256 hashing algorithm for mining blocks in the Bitcoin network. Ethash algorithm is mainly used during the proof of work function. Proof of work is a small piece of data that is difficult to generate but easy to validate and satisfies certain network requirements. SHA-256 algorithm helps Bitcoin users to protect all their sensitive data like private keys. Moving on, the programming language of Ethereum and Bitcoin. Ethereum uses Solidity. Solidity is a high-level programming language used by Ethereum for implementing smart contracts. But in terms of programming language, Bitcoin keeps it simple. Bitcoin uses C++ as its programming language. It is a stack-based programming language used to give Bitcoin software instructions on how to make transactions. As we have covered the algorithm and programming language of both cryptocurrencies, now let's take a look at the mining process of both. Mining is a process in which transactions made are validated and added to blockchain public ledger in blocks, and the people mining these blocks are called miners. Ethereum miners mine the unvalidated transaction using the proof of work method, but it aims to switch to proof of stake because it will make its network more immune to centralization, energy efficient, and stronger support for its shared chain. On the other hand, similar to Ethereum, Bitcoin miners also use the proof of work method to mine unvalidated transactions. This method is enough to function in Bitcoin network worldwide. Now let's proceed towards the monetary policy of both cryptocurrencies. But let's first understand what monetary policy is. Monetary policy is known as the process of drafting, announcing, and implementing the plan of actions taken by the competent monetary authority to control the money supply and achieve goals that promote sustainable economic growth. So, Ethereum's policy is defined by the reward paid out by its protocol. Ethereum's monetary policies are best described as minimum issuance to secure the network. Therefore, there is a constant trade-off between the transaction speed and security. But Bitcoin's monetary policy comprises of two parts, halving and block frequency. Halving event is when the reward of mining Bitcoin is cut in half, and it also cuts the inflation rate. And the block reward is the number of Bitcoins you get if you successfully mine a blockchain block. The current block reward for Ethereum is 2 Ether per block, and for Bitcoin, the block reward is 12.5 Bitcoins per block. Also, every 14 seconds, a block of Ethereum is generated, and one block of Bitcoin takes 10 minutes to generate. Monetary policies are considered to be fixed and non-inflationary. Due to this, over time, mining blocks will become more difficult. Next is transactions. Ethereum is a little bit faster than Bitcoin, with 30 transactions per second, and it takes just a few minutes to confirm it. On the other side, Bitcoin's transaction speed is 5 transactions per second, and it can take up to 60 minutes or more to confirm. Ether, the currency of Ethereum, acts as the fuel for Ethereum networks, and Bitcoin is only used as the value for real-world transactions. To compete with already present electronic cash like credit cards and Google Pay, Ethereum and Bitcoin require higher productivity to attain widespread adoption. Now talking about the availability of both cryptocurrencies, Ethereum is not limited, but it can occasionally reduce due to large network upgrades. However, Bitcoin is limited to 21 million coins, and as of today, 18 million Bitcoin is already used. But in the end, both Bitcoin and Ethereum, being the top cryptocurrencies, share a few similarities. Like both are decentralized and can be used to have a peer-to-peer transaction, proof of work, also both have a large network of independent nodes.
Choose from over 300 in-demand skills and get access to 1,000 plus hours of video content for free. Visit SkillUp by Simplilearn. Click on the link in the description to know more.
Now, let's have a demo. Now, let's have a look at the media outlet website CoinDesk, where we will see all stats related to Bitcoin and Ethereum in detail. CoinDesk is a site specialized in digital currencies. It is used to explore the news and price data related to cryptocurrencies, and also explains how cryptocurrencies contribute to the evolution of financial system worldwide. Now, see this graph. This graph shows the change in Bitcoin price in 24 hours duration. This graph shows the gradual change in the price of Bitcoin. It started from $64,439.29 on April 14 at 12 p.m. And right now, by April 15 at 6 a.m., it is at $63,189. The rate of change is minus 0.46%, which shows the change in the price of Bitcoin per hour. Let's have a look at this graph of Ethereum too. The value of Ethereum started at $2,388.13 on April 14 at 12 p.m. and the current status on April 15 is positive with a value of $2,442.37 with an increasing rate of 4.67%. Down below, we have a metrics table that shows the change between the starting and ending value of Ethereum, the total supply of a cryptocurrency in 24 hours, the total number of transactions that occur, and the average transaction fee for all these transactions. Now, this graph shows the current status of cryptocurrency in USD dollars. We can also see its value according to any centralized currency like Euro or INR. This graph shows the constant trading change in the value of cryptocurrencies every moment. We can also access the data of trading from an hour to its lifetime. So let me tell you that Dogecoin is an altcoin and an almost sarcastic meme coin that serves as a peer-to-peer open source cryptocurrency. Well, that's not enough. So let's dive down and understand the concept of Dogecoin more precisely. Hey everyone, I'm Shamli and I welcome you all to this new video of Simplilearn on what is Dogecoin. But before starting, let's have a look at why is it in the news. Since the beginning of the year 2021, Dogecoin has surged more than 950% from less than half a penny to more than 5 cents per Dogecoin. Then Elon Musk, CEO of Tesla Incorporation, took his interest in it and tweeted, "Too much concentration is the only real issue for cryptocurrency, making the owner of the Dogecoin wallet a subject of attention." Later on, other celebs like Snoop Dogg also started taking an interest in Dogecoin and started tweeting and promoting it on social platforms, which made Dogecoin climb to a peak of 8.2 US cents and market capitalization of $10 billion. In this video, we will come across the following topics. First, we will see the origin of Dogecoin, and then we will understand what is Dogecoin, how does it exactly works, and then we will see what led to the growth of Dogecoin. What are the areas of uses of Dogecoin? Then we will figure out what is the current value of Dogecoin today. And lastly, how can we buy it? Let's start with the origin of Dogecoin. Dogecoin was invented by two software engineers, IBM engineer Billy Marcus and Adobe engineer Jackson Palmer. Did you know that they never even met before combining the two most significant phenomena of the year 2013, Bitcoin and Doge? Well, now let's move ahead and see what is Dogecoin. Dogecoin is a peer-to-peer open source cryptocurrency that provides its user a completely unknown, decentralized, and secure environment free from any third-party interference to make their transaction. Dogecoin was intended to be an altcoin and a meme coin inspired by Shiba Inu's popular meme, aka Doge. Moving ahead, let's have a look at how it works. To understand the workflow, let's take the example of two friends, Mark and Susan. Mark owes some money to Susan, and now he needs to return it. So he thinks of an idea and decides to send her Dogecoin instead of giving her physical money. They both open their digital wallet account. To pay her, he needs two essential pieces of information. First, his private key, and second, her public key.
To get access to Susan's private key, he needs to scan a QR code from his smartphone. Then the application alerts all the Dogecoin miners around the world to proceed further with the process. The Dogecoin miners validate whether Mark has enough Dogecoin to make the payment or not. And after the validation process, they approve the transaction request. Dogecoin miners race with each other to collect all the data of the pending transaction known as the nonce. The miners then apply a mathematical function to produce the correct hash number for that particular nonce of the pending transaction. The miner who successfully produces the correct hash number is rewarded with 25 Dogecoin in his account. After that, Mark and Susan gets a confirmation message that their request for the transaction has been approved, and within 10 minutes the requested amount of Dogecoin is credited into the wallet of Susan. Thus, the transaction is completed. So, what led to the growth of Dogecoin? Dogecoin officially came live in 2013 and became an instant hit within the community of people who just wanted to play around the cryptocurrencies freely. As I said earlier, Dogecoin was intended to be a joke for content creators, but they were very well received it. Users of internet forums like Reddit and Twitter adopted Dogecoin and started tipping their content creators. This usage of Dogecoin made it surpass the trading value of the other cryptocurrencies, specifically Bitcoin, in 2014. It also started doing charity work to introduce and promote themselves in the real world. For example, once they raised a fund of $55,000 for a NASCAR driver, Josh Weiss, and in return he printed the logo and 98 Dogecoin over his race car. Eventually, it almost became the mascot for what crypto should be. Let's have a look at who uses Dogecoin. Today, many companies and firms like restaurants, grocers, web hosting, products retailer, ebook sellers, and travel services uses Dogecoin for transaction. These are a few examples of companies in every sector that uses Dogecoin. Grocers, Hello Pets, GamerHeats.com. For web hosting, Gamer. For products retailer, Meltdown and Nordex. Ebook seller, Cornell. And travel services like Velolio.it. This makes me curious about the current value of Dogecoin. Let's have a look at that too. According to the market cap today, the current value of Dogecoin is 0.059357 USD with a trading volume of $16 billion. The circulating supply of this cryptocurrency is 129 billion Dogecoins, and the max supply of Dogecoin is not available. How can we buy Dogecoin? So to buy Dogecoin, we will have to follow a few steps. Step 1. Open a digital wallet. Buy Your Coin is considered a perfect application for trading cryptocurrencies. Step 2. Register your account. Step 3. Complete your profile KYC by providing your identity and address proof, like Aadhaar card. Step 4. Add your bank account details. Step 5. Secure your account by creating a convenient trading PIN that is only accessible by you. And step 6. There you go. Now you can start trading. That is all about Dogecoin. Did you know that on 20th April 2020, Dogecoin surged its value to $1? Making this day named after itself as Doge Day. The supporters of Dogecoin were trying to amplify the value of it to make it $1. But how is it done in reality? How can we affect the value and availability of cryptocurrency? Well, all this is done by a process called mining. And this is what affected Dogecoin, resulting in the rise of its value. Mining coins of the Dogecoin network is called Dogecoin mining. Hey everyone, I'm Shamli and I welcome you all to this new video of Simplilearn on a very interesting topic of Dogecoin mining. We will cover all the concepts of Dogecoin mining and we will understand how to mine Dogecoin all by yourself. Now, let's move ahead and see what's in this video for you. First, we will have an introduction to what is Dogecoin. Then, we will figure out the net worth of Dogecoin today. We will understand what Dogecoin mining is. Then we will have a comparison of mining process of Dogecoin with a few other cryptocurrencies like Bitcoin.
Then we will dive into how to mine Dogecoin. In this segment, first we will see types of Dogecoin mining like pool and solo. Then we will see what exactly you require to start Dogecoin mining, what hardware and software you need for Dogecoin mining, and then we will understand a new concept of Dogecoin mining, which is Dogecoin cloud mining. And in the end, we will analyze whether Dogecoin mining is profitable or not. So let's get started and have a quick look at what is Dogecoin. Dogecoin is a peer-to-peer open source cryptocurrency that works on blockchain technology. Also, it provides its users a completely unknown, decentralized, and secure environment free from any third-party interference to make their transactions. Dogecoin uses cryptography to secure all its transactions. This makes me curious to know what is the net worth and availability of Dogecoin today. According to market cap, today the current value of Dogecoin is $0.266247 USD. The circulating supply of this cryptocurrency is 127 billion Dogecoin. So that brings us to what is Dogecoin mining. Dogecoin mining is a process of validating the data blocks of transactions by solving a complex mathematical problem and adding them to the Dogecoin network. Each confirmation of transactions adds a new block to the Dogecoin network. Miners perform this process. Dogecoin miners are a community of people who perform complex mathematical solutions on the transactions for mining Dogecoin. That makes me wonder what the difference between Dogecoin mining and other cryptocurrencies mining process. Let's have a comparison between Dogecoin mining and the Bitcoin mining process. We will be comparing these crypto mining based on these factors. First, algorithm. It is a set of rules that every cryptocurrency follows for mining new coins. In the algorithm, Dogecoin mining uses Script. Bitcoin mining uses SHA-256. Script is considered a lot quicker and cheaper than the SHA-256 algorithm, making mining easier for miners of the Dogecoin network. Second is difficulty. This represents the complexities and challenges faced by miners to mine each block of the blockchain of any cryptocurrency. In difficulty, Dogecoin is 2,798,252. Bitcoin is 3,511,60,552,899. Thus, it proves that Dogecoin is easier to mine among other cryptocurrencies. Third is block time. It is the time taken by a new block of transactions to be checked, confirmed, and added to the blockchain. Block time of Dogecoin is 1 minute. For Bitcoin, it is 10 minutes. And at fourth and fifth, we have reward per block and per block USD. It is the amount in USD to the miner for each block added to the network. Block reward for Dogecoin is 10,000 Dogecoins per block, which in USD is 27.36 Dogecoins. For Bitcoin, it is 12.5 Bitcoin per block, and in USD, it is 86,391.63 Bitcoins. Moving on, finally, we have reached the most crucial point of this video. Now we will have a look at how to mine Dogecoin. Dogecoin can be mined in two ways. The first one, Dogecoin pool mining, and the second is solo mining. A Dogecoin pool is a group of people who share their computing power to mine Dogecoin transaction data and get rewarded by equal share after confirming the transaction. Solo mining is when only one person does all the work of mining and confirming transactions. The reward is awarded only to that person after confirming the transaction. Let's have a thorough discussion of the difference between Dogecoin pool mining and solo mining. In Dogecoin pool mining, you have to mine as a part of it and pay fees. In Dogecoin solo mining, you don't need to pay any fees and you mine all by yourself. Also, in pool mining, you will only get a part of the reward earned by the pool. But in solo mining, the total reward earned will be received by you only. As in pool mining, many people work together, so they mine blocks more often. And on the other side, solo mining could take a lot of time before one mine their first block. In pool mining, it takes less time to confirm a transaction as you work as a part of the pool community. On the other hand, in solo mining, it can take much longer to confirm a transaction as you do all the work and there is a lot of competition. So this was all about Dogecoin pool mining and solo mining. Let's proceed further and see what we need to start mining Dogecoin. But before we start mining, we will have to make sure that we have these things with us. A PC with any operating system like Windows, Linux, Ubuntu, etc. A good internet connection, and a digital wallet to store the Dogecoins you mine. Which hardware and software can we use for Dogecoin mining? You will need your PC's CPU, which should be powerful enough to mine Dogecoin. A GPU or graphics card can also be used for mining Dogecoin. For example, Sapphire Pulse Radeon RX 580, Asus RX Vega 64, and many more. Stripped ASIC miner is programmed to mine script-based cryptocurrencies like Dogecoin, like Bitmain Antminer L3, BWL21 script miner, etc. If you are new to Dogecoin mining, then using your PC's CPU will be the right choice and CPU miner is the most appropriate software. If you are thinking of mining using GPU or graphics card, you can have a wide range of software. Some of the best software is CUDA Miner, which works perfectly with NVIDIA products, CG Miner, which works with most GPU hardware, and Easy Miner is considered suitable for beginners. Stripped ASIC miners are considered to be very powerful hardware and multi-miner is excellent with this hardware. Moving ahead, let's understand what Dogecoin cloud mining is. Dogecoin cloud mining is a mechanism to mine Dogecoin using rented data centers without installing any hardware and related softwares. It allows people to take an interest and participate in Dogecoin mining at a very low cost, making Dogecoin mining accessible for a broader range of people worldwide. Since the Dogecoin mining process uses the cloud, it reduces equipment maintenance or direct energy cost. This whole concept of Dogecoin mining brings me in front of one question. Is Dogecoin mining profitable? Dogecoin mining profitability can be analyzed based on power consumptions, hash rate, and cost. The Dogecoin mining calculator is used to make it simple in this calculator. The default value for the latest Dogecoin mining hash rate and latest Dogecoin difficulty target is preloaded for better results. Dogecoin mining's reward is $44,44,412.25 per year, that is 14 million Doge per year. The block time for Dogecoin is 1 minute, which means the supply of Dogecoin will never go down. After deducting mining power costs and mining fees, the final daily Dogecoin mining profit is $22.53 Dogecoin to USD with a profit margin of positive 81.72%. Also, I think Dogecoin mining is fun. So that is all about Dogecoin mining. But before moving any further, let's see what we have for you in this video. First, we will have a quick introduction to what is Dogecoin, followed by how to buy Dogecoin. Then we will understand what a Dogecoin wallet is and what are the types of Dogecoin wallet. Then we will look into how to create a Dogecoin wallet and how to use it. After that, we will figure out why Dogecoin is so popular. And finally, we will go through the top 5 Dogecoin wallets in 2021. So without wasting any time, let's get started. What is Dogecoin? Dogecoin is a peer-to-peer open source cryptocurrency that works on a blockchain technology. Also, it provides its users a completely unknown, decentralized and secure environment free from any third-party interference to make their transactions. Dogecoin uses cryptography to secure all its transactions. Now let's proceed further and have a look at the process of how to buy Dogecoin. You can buy Dogecoin by following
these steps. Step 1. Create a Dogecoin wallet. Step 2. Locate your specific Dogecoin address, which is a long array of characters that starts from capital D followed by any other capital character or any number. And step 3. Find a source that sells Dogecoin. And voila, buy Dogecoins. So that brings us to what is Dogecoin wallet. A Dogecoin wallet is something where you can store, receive or send Dogecoins. Technically, it is very similar to a real live wallet. Dogecoin wallet consists of its public and private key connecting it to the distributed ledger over the Dogecoin network. You can use your wallet's public key, which also functions as your coin address, for your bank account number for Dogecoin, where anyone can track the transactions made by maintaining the anonymity of the users. The private key of your wallet is used to approve transactions in the ledger. Your wallet's public key is used to receive Dogecoins from other users. On the other hand, your wallet's private key is only used to send Dogecoins to other users in the network. So what are the types of Dogecoin wallet? Dogecoin wallet is of two types: digital Dogecoin wallet and physical Dogecoin wallet. Digital Dogecoin wallet is accessible through the web, and you can also download it according to your handset or operating system. On the other hand, physical Dogecoin wallets are pretty expensive and less accessible. So moving on, let's see how to create a Dogecoin wallet. To create a Dogecoin wallet for yourself, you will have to go through the following steps. Step 1. Choose the correct wallet. Dogecoin Core Wallet and Multi-Doge Wallet have been created and are maintained by the developers team of Dogecoin. Here, we will be using the Dogecoin Core Wallet as reference. Step 2. Download and install the Dogecoin wallet in your handset. You can also use the official website of this wallet for your Windows. And step 3. Open the Dogecoin wallet application and verify your Dogecoin wallet address. And that is it. It is this easy to create and have your Dogecoin wallet. Now, when you have your Dogecoin wallet in your hand, let's see how you can use it. On the very bottom of the home page of your wallet, there are two options: Request Coins, where you can request Dogecoins from other users in the Dogecoin network, and Send Coins, where you can send Dogecoins to other users in the Dogecoin network. To receive coins, first click on the Request Coins button. Second, enter the required number of coins you want to request. And third, have the below generated barcode scanned by the user you wish to request the amount. Now to send coins, first type the Dogecoin wallet address to whom you want to send Dogecoins. Enter the required amount you wish to send to that user. And third, click on Send. And there you go. Now you can use your Dogecoin wallet whenever and wherever you want. This makes me wonder, why is Dogecoin so popular? Despite being in tough competition with other strong cryptocurrencies like Bitcoin, Dogecoin has never missed an opportunity to be in the limelight. Dogecoin's popularity is mainly attributed to its vast and dedicated community. Other than that, social platforms like Reddit and Twitter also promoted Dogecoin to a great extent due to its fun factor and the whole joke story behind it. Celebrities like Snoop Dogg, Kevin Jonas, Elon Musk also started taking an interest in Dogecoin and posting pictures and comments on their social media handles, which increased the craze of Dogecoin all around the world.
If getting your learning started is half the battle, what if you could do that for free? Visit SkillUp by Simplilearn. Click on the link in the description to know more.
So this was all about Dogecoin wallet. Now let's have a look at the top 5 Dogecoin wallets of 2021. These are the top 5 Dogecoin wallets of 2021. Ledger Nano X, Trezor Model T, Kipkey, Binance, and Kraken. Kraken is primarily a cryptocurrency exchange platform but can perfectly act as a Dogecoin wallet. All you need to do is to register and then buy some Dogecoins. It is a very secure and reliable cryptocurrency exchange platform. It charges a very low fees for every transaction taking place on it, and it accepts a pretty decent amount of fiat money. But before starting with the comparison, let's look at what we have for you in this video. First, we will have a crisp introduction of Dogecoin, Bitcoin, and Ethereum.
Then we will look into the comparison of Dogecoin, Bitcoin, and Ethereum. And at last, we will look into a few similarities between these cryptocurrencies. So let's get started. Dogecoin was intended to be an altcoin and a meme coin inspired by Shiba Inu's popular meme, aka Doge. But it was very well received by everyone in the crypto world, and today it is the fourth top cryptocurrency. Dogecoin is a peer-to-peer open source cryptocurrency that provides its users with a completely unknown, decentralized, and secure environment to make their transactions. Bitcoin led the first revolution of digital money in 2013. Bitcoin enables transparent and decentralized peer-to-peer transaction. Bitcoin is designed to be an alternative to national currencies and intends only to be a medium of exchange and value storage. It comprises of features like a public ledger, immutability, and high transparency, making it a great platform. Ethereum came into the picture years after Bitcoin. Ethereum offered a platform to build and run applications without any downtime, fraud, or interference of any third party. Ethereum serves as a computing platform that enables its developers to build and deploy their decentralized applications using smart contracts through its currency Ether or ETH. The primary function of Ether is to help developers build smart contracts using DApps or decentralized application. Now, let's move on to the comparison between Dogecoin, Bitcoin, and Ethereum. We will be comparing them based on few major parameters like algorithm, programming language, mining process, monetary policies, transactions, today's value, and availability. So let's move ahead and start with the very first comparison, the algorithm. Dogecoin uses strict cryptography for mining the blocks of the Dogecoin network. In comparison, Bitcoin uses the SHA-256 hashing algorithm for mining its blocks in the blockchain network. Ethereum, on the other hand, uses the E- algorithm for mining its transactions. Strip language is a password-based key derivation function that is mainly used to avoid customized hardware attacks by raising the resource demands of the algorithm. SHA-256 algorithm helps Bitcoin users protect all their sensitive data like private keys or transaction details and help maintain the anonymity of the user for a much secure performance of transactions. E- algorithm is mainly used during the proof of work function. Proof of work is a small piece of data that is difficult to generate but easy to validate and satisfies specific network requirements. Moving on, the following comparison. Programming language. Dogecoin is considered to be an altcoin for Bitcoin. Both Dogecoin and Bitcoin use the same programming language, C++. It is a stack-based programming language used to give Bitcoin and Dogecoin software instructions on how to make transactions. On the other side, Ethereum uses Solidity, which is a high-level programming language used by Ethereum for implementing smart contracts. Now that we have covered programming language and the algorithm of these cryptocurrency, let's get to the following very important parameter, which is mining process. But before getting started with the comparison, first let's understand what mining is. Mining is a process in which transactions are validated and added to the blockchain public ledger in blocks, and the people mining these blocks are called miners. In terms of the mining process also, Dogecoin and Bitcoin use the same method to verify and validate the pending transaction in their networks, and that is proof of work. Although Ethereum miners also mine the unvalidated transactions using the proof of work method, it aims to switch to proof of stake because it will make its network more immune to centralization, energy efficient, and more vital support for shared chains. Now we have come to the following comparison, which is monetary policy. Monetary policy is known as the process of drafting, announcing, and implementing the plan of actions taken by the competent monetary authority to control
the money supply and achieve goals that promote sustainable economic growth. Dogecoin's policy is defined by its block reward paid to its miners, whereas Bitcoin's policy is defined by two processes, halving and block reward. Halving event is when reward of mining Bitcoin is cut in half, and it also cuts the inflation rate. And the block reward is the number of Bitcoins you get if you successfully mine a blockchain block. And Ethereum's policy is defined as minimum issuance to secure the network. That is, there is a constant trade-off between the transaction speed and security. Dogecoin's block reward is 10,000 for mining one block. Bitcoin's block reward is 12.5 for mining each block, and which is set to get reduced to 6.25 by 2024. And Ethereum's block reward is 2 Ether per block. Dogecoin takes 1 minute to generate one block. Bitcoin takes 10 minutes to generate one block. And Ethereum generates one block every 14 seconds. Well, monetary policies are considered to be fixed and non-inflationary. Due to this, over time, mining blocks will become more complex. Now, moving on to the following comparison, which is transactions. Dogecoin is the fastest and can complete 70 transactions in 1 second and takes just 2 to 3 minutes to confirm a transaction. Bitcoin can complete up to 5 transactions in 1 second and takes 10 minutes or more than that to confirm one transaction. And Ethereum can complete 30 transactions per second and it takes just a few minutes to confirm it. Dogecoin is majorly used for tipping content creators on social platforms like Reddit and Twitter. Bitcoin is only used as a superior alternative for fiat money and is used primarily for real-world transactions. On the other hand, Ether, the currency of Ethereum, acts as the fuel for Ethereum networks. Now that we have covered all about transaction process of these cryptocurrency, let's have a look at the value of Dogecoin, Bitcoin and Ethereum in today's date. The value of Dogecoin on today's date is $0.2992. Bitcoin being the highest is 34,857.58. And Ethereum holds a value of $2,356.58. Now we have reached the last comparison of Dogecoin, Bitcoin and Ethereum, which is availability. The circulating supply of Dogecoin is 127 billion. Bitcoin, very low as compared to Dogecoin, is just 21 million in circulation. Ethereum, on the other hand, is said to be unlimited, but till today, the circulation supply of Ethereum is 115.6 million. Till today, 113 billion Dogecoin has already been mined. For Bitcoin, 18 million Bitcoins are already mined. And for Ethereum, roughly 36 million Ethereum has already been mined. In this graph, you can see the red box on the right side of the graph shows the maximum supply of Dogecoin. On the extreme left, you can see first the options that you can use according to your requirements. Like if you want to know about Dogecoin, you can go for the first option, that is www.dogecoin.com, which will lead you to the official website of Dogecoin. If you want to chat with the executives of CoinMarket regarding Dogecoin, then you can go for the fourth option, which is chat. Before that is an address for Binance address, through which you can keep a track of Dogecoin's value on that platform. And you can also change it according to your choice by clicking on more. Right beside the more option, you can see the market cap value of Dogecoin, which is 38,349,469,098. It is the total value of Dogecoin in circulation. Beside the market cap option, you can see fully diluted market capitalization, which is 38,700,795,906. It is the capitalization
when max supply of Dogecoin was in circulation. And on the right side, just before total supply, you can see the volume of Dogecoin, 1,779,417,647. It is the value of Dogecoin traded in 24 hours. Next is Bitcoin. Similar to Dogecoin, you can see the red box on the right side of the graph shows the maximum supply of Dogecoin. On the extreme left, you can see first the options that you can use according to your requirement. Like, if you want to know more about Bitcoin, you can go for the first option, that is www.bitcoin.org, which will lead you to the official website of Bitcoin. Right beside the more option, you can see the market cap value of Bitcoin, which is 651,713,010,753. It is the total value of Bitcoin in circulation. Beside the market cap option, you can see fully diluted market capitalization, that is 732,387,262,690. And on the right side, just before the total supply, you can see the volume of Bitcoin, that is 30,249,939,865. Ethereum is no different from Dogecoin and Bitcoin. In this also, you can see the total supply of Ethereum. Also, you can visit the official website of www.ethereum.org to explore more about Ethereum. You can have a look at the market cap value of Ethereum, which is 273,755,586,534. The fully diluted market capitalization is 273,576,987,049. The volume of Ethereum traded in 24 hours is 24,101,779,346. But in the end, all these top cryptocurrencies, Dogecoin, Bitcoin, and Ethereum, share a few similarities. Like, they all are decentralized. All three cryptocurrencies are free from any third-party interference or any centralized authority, and can be used to have secure and independent peer-to-peer transaction, maintaining the anonymity of the user. And proof of work, that is, all their transactions are verified and validated before processing. After complete verification, further transaction process takes place. Also, all of them have a large network of independent nodes. So why wait? Let's embark on this exhilarating adventure together. But before we dive in, if you're looking to take your career to new heights and become a true expert in the realm of blockchain and cryptocurrency, consider checking out our professional certificate program in blockchain in collaboration with IIT Kanpur. It's an excellent opportunity to master key architectural principles and develop the skills needed to excel in this rapidly growing field.
Meet Susan, an aspiring painter. She wishes to conduct an online painting exhibition for all her digital artworks. However, as the exhibition is online, she is worried that her paintings won't be secure, as anyone could easily forge or replicate them. Her friend Mark came to her rescue with an idea of NFT. He suggested that Susan could buy NFTs for all her paintings, as NFTs are trustworthy, easily transferable, and will also maintain her ownership rights on her artworks. Susan had no idea what NFTs were, so Mark stepped ahead and explained it to her. NFTs turn your digital assets into one of a kind by creating a unique digital signature, which defines the ownership of your assets, and that can be bought and sold for real money, cryptocurrency, or any other asset, like a non-fungible token, aka NFT. Non-fungible tokens means that they are not interchangeable, and each of them represents unique assets owned by a specific person. On the other hand, fungible tokens are interchangeable and can be divided into smaller units to form the same value. For example, a $100 bill is fungible, as you can exchange it with 5 $20 bills or 2 $50 bills. But the painting of the Last Supper is non-fungible, as it cannot be generated in bulk. Even if it is copied, it will not be authentic. Each NFT contains distinguishable information like who owns the digital asset and who sold it, making them distinct and easily verifiable. As it is impossible to forge such a certificate, it will secure her painting's originality. After learning what NFT is, Susan was curious to know how exactly NFT works. NFT basically creates a blockchain-based digital certificate for your digital collectibles, including games, music, art, and many more. This certificate gives your artwork a unique identity. The underlying technology and the programming language used by NFTs are the same as other cryptocurrencies, such as blockchain and the programming language Ethash or Script. NFT majorly exists on Ethereum blockchain, a distributed public ledger that records all the transactions. However, NFT is quite different from these cryptocurrencies. Bitcoin and Ethereum are fungible tokens, which means if you trade Bitcoin or Ethereum for one another, you will have the same value or item in return, basically money. On the other hand, NFT is a unique token. Therefore, if you try to trade it, you may end up with something completely different in your hands. CryptoPunks is a remarkable example of NFT. It enables you to buy, sell, and store 10,000 collectibles with the proof of ownership being stored on the Ethereum blockchain. After exploring how NFTs work, Susan was convinced and bought NFTs for all her paintings. Due to this, her artworks were secured from any kind of forgery and also gave her artworks a particular value. This contributed to increased sales too, as everyone was easily able to buy the artwork without any fear. All in all, her exhibition was a complete success. Similarly, NFT has proved itself to be a boon in the lives of many others, like Jack Dorsey, the CEO and co-founder of Twitter with his very first and famous tweet, "Just setting up my Twitter," and Vignesh Sundarasan, famously known as Metakovan, who bought $69.3 million worth of NFT art on Beeple. Owing to its increasing popularity, people are now willing to pay hundreds of thousands of dollars for NFTs. NFT has enhanced media exposure and special perks for aspiring artists like Susan on social media. This popularity of NFT creates new opportunities for new art platforms, motivating people to buy art from internet platforms and promoting copyright or originality of digital assets. Meet Frank and Daniel. One day they decide to go for a trip to Venice. They made a budget list for all their expenses like residence, flight, etc. They thought of making their bookings online from a site that offered discounts to the first 10 visitors on that day. While making their respective flight bookings, Daniel's transaction failed, and he missed the offer going on. On the other hand, Frank paid his share very quickly and easily, and became one of the 3 lucky draw winners. Daniel was surprised and asked Frank how he could make the transaction when Daniel himself could not. To which his response was, "It's simple. I used Bitcoin, a type of cryptocurrency." Daniel was confused, and he asked what cryptocurrency is, and since when has it been in use? Frank stepped up and explained to him. Cryptocurrency is a virtual or digital currency that works on blockchain technology, and is designed to work as a medium of exchange online to buy goods and services and make payments, which was introduced to the world first in 2013 by Satoshi Nakamoto. Daniel felt that it sounds similar to other online payment options. He asked what makes it so different. Frank explained, cryptocurrency is decentralized and free from any third-party interference, which means it is not issued and controlled by any government or central authority, unlike other payment systems that banks or governments are handling. And that's why a cryptocurrency transaction never fails. There could be many reasons for why Daniel's transaction failed, like he may have exceeded his transfer limit, or his account must have been hacked, or there could have been some technical issue with his bank server, or maybe due to high transaction fees imposed by the bank. But on the other hand, cryptocurrency charges almost no or very low transaction cost. There is no limit for making transactions. In fact, you have 24/7 access to your money. There is no extra delay or extra charges on making international transactions. And the best part is that anybody can use cryptocurrency without the hassles of paperwork. All you need to do is create an account on any digital wallet of cryptocurrency. This is what makes cryptocurrency different from other online payment options. Daniel was impressed by cryptocurrency, but he wondered how it works without the control of an external authority. Upon research, he found out that cryptocurrency works on blockchain technology. Blockchain is a set of blocks that record information of transactions, like who made the transaction to whom, the amount of trade in the form of a digital ledger that is distributed across the entire network, meaning the data is replicated and stored on each node across the entire blockchain network, making it more secure and impossible to change, hack, or cheat the system. then it is verified and validated by every node to proceed with the process of making the transactions. The crypto in cryptocurrency stands for cryptography, which is a method of using encryption and decryption to secure the data in the presence of any third party with ulterior motives. Now Daniel was completely aware of the whole technology and concept behind cryptocurrency, and was influenced by Frank to adopt cryptocurrency in his daily lifestyle too. He did that by booking his ticket, but sadly, no discount. Like Daniel, cryptocurrency has influenced and impacted an enormous number of people worldwide. Due to this increasing popularity, new companies like Meitu and PayPal are coming forward and investing in cryptocurrency every day. In 2018, Malta, an island located in the Mediterranean Sea south of Italy, was titled Blockchain Island, as it led to the economic stability of the nation. Many fintech companies like Binance and OKX have already begun to take advantage of Malta's financial incentives and have moved their headquarters to the blockchain island. Cryptocurrency is revolutionizing finance and banking around the world. Thanks to cryptocurrency, now anyone with an internet connection can trade, spend, and borrow money around the world, and nobody can stop them. People like Bill Gates, co-founder of Microsoft Corporation, and Elon Musk, CEO of Tesla, support cryptocurrency, as it is much better and secure than physical money and also holds a great future for the world's economy. And on the other hand, some people think of cryptocurrency as a bane to the world's economy, like Warren Buffett, CEO of Berkshire Hathaway, and Ajay Banga, CEO of Global MasterCard, feel that cryptocurrency is a platform of criminal activities and will destroy the world's economy. Well, one thing is clear, that this conflict is going to stay put for a little longer. Meet Susan, an aspiring painter. She wishes to conduct an online painting exhibition for all her digital artworks. However, as the exhibition is online, she is worried that her paintings won't be secure, as anyone could easily forge or replicate them. Her friend Mark came to her rescue with an idea of NFT. He suggested that Susan could buy NFTs for all her paintings, as NFTs are trustworthy, easily transferable, and will also maintain her ownership rights on her artworks. Susan had no idea what NFTs were, so Mark stepped ahead and explained it to her. NFTs turn your digital assets into one of a kind by creating a unique digital signature, which defines the ownership of your assets, and that can be bought and sold for real money, cryptocurrency, or any other asset, like a non-fungible token, aka NFT. Non-fungible tokens means that they are not interchangeable, and each of them represents unique assets owned by a specific person. On the other hand, fungible tokens are interchangeable and can be divided into smaller units to form the same value. For example, a $100 bill is fungible, as you can exchange it with 5 $20 bills or 2 $50 bills. But the painting of the Last Supper is non-fungible, as it cannot be generated in bulk. Even if it is copied, it will not be authentic. Each NFT contains distinguishable information like who owns the digital asset and who sold it, making them distinct and easily verifiable. As it is impossible to forge such a certificate, it will secure her painting's originality. After learning what NFT is, Susan was curious to know how exactly NFT works. NFT basically creates a blockchain-based digital certificate for your digital collectibles, including games, music, art, and many more. This certificate gives your artwork a unique identity. The underlying technology and the programming language used by NFTs are the same as other cryptocurrencies, such as blockchain and the programming language Ethash or Script. NFT majorly exists on Ethereum blockchain, the distributed public ledger that records all the transactions. However, NFT is quite different from these cryptocurrencies. Bitcoin and Ethereum are fungible tokens, which means if you trade Bitcoin or Ethereum for one another, you will have the same value or item in return, basically money. On the other hand, NFT is a unique token. Therefore, if you try to trade it, you may end up with something completely different in your hands. CryptoPunks is a remarkable example of NFT. It enables you to buy, sell, and store 10,000 collectibles with the proof of ownership being stored on the Ethereum blockchain. After exploring how NFTs work, Susan was convinced and bought NFTs for all her paintings. Due to this, her artworks were secured from any kind of forgery and also gave her artworks a particular value. This contributed to increased sales too, as everyone was easily able to buy the artwork without any fear. All in all, her exhibition was a complete success. Similarly, NFT has proved itself to be a boon in the lives of many others, like Jack Dorsey, the CEO and co-founder of Twitter with his very first and famous tweet, "Just setting up my Twitter," and Vignesh Sundarasan, famously known as Metakovan, who bought $69.3 million worth of NFT art on Beeple. Owing to its increasing popularity, people are now willing to pay hundreds of thousands of dollars for NFTs. NFT has enhanced media exposure and special perks for aspiring artists like Susan on social media. This popularity of NFT creates new opportunities for new art platforms, motivating people to buy art from internet platforms and promoting copyright or originality of digital assets. Many experts in the crypto industry say that around 40% of new crypto users will use NFTs as their entry point. As a result of its growing popularity, NFT could represent a more significant part of the digital economy in the future.
In this video, we will explore about Shiba Inu coin and will go through some of really exciting concepts and components revolving around it. First, we will look into the origin of Shiba Inu coins. Then we will understand what is Shiba Inu coins. Then we will explore how it is different and unique from Dogecoin. Then we will figure out why is it so popular. And at last, we will explore what future Shiba Inu coin holds for itself. So without wasting more time, let's get started with the video. So how did the Shiba Inu coin originate? The Shiba Inu coin was created in August 2020 by an anonymous person calling themselves Ryoshi, an Indian. It was intended as an altcoin of Dogecoin, which itself was created as an altcoin of Bitcoin. And this meme coin has been named after the Japanese dog breed Shiba Inu. It feels like the Shiba Inu coin was willed into existence and is now insanely popular among major crypto exchanges through the power of its following crowd, memes, and a very cute dog. Now we know how it originated, so let's have a look at what is Shiba Inu coin. Shiba Inu coin is a decentralized community building cryptocurrency, or we can say an experiment developed within the Shiba Inu ecosystem and built on top of the Ethereum blockchain network, like many other coins. It is a meme coin launched as a rival of Dogecoin or Doge Killer. Both Dogecoin and Sheepcoin were made in a humorous manner, but Sheepcoin has already taken over some Dogecoin markets, attracting a lot of attention and rising as a popular choice among investors, especially after such market crash of cryptos like Bitcoin and Ethereum. But what is the difference between Shiba Inu coin and Dogecoin? Although both Shiba Inu coin and Dogecoin are meme coins and share the same tree of origin, both of them differ a lot from each other at the same time. And the very first difference between them is the Sheepcoin is a token and Dogecoin is a currency. Let's have a look at more of those major differences like this. First is development. Shiba Inu coins or Sheep coins are built on and powered by the Ethereum network, while Dogecoin has been developed using the same technology as Bitcoin. Then is use cases. Sheepcoin is still working upon price more due to its high popularity than utility. But on the other hand, Dogecoin has already established itself to some extent as a medium of online payments. Then is value. According to CoinMarketCap, the current value of Sheepcoin is $0.000007378 and that of Dogecoin is $0.261711. And at last, availability. The availability of Sheepcoin till today is 394 million and for Dogecoin it is 130 billion. Now this definitely raises a question in my mind. Why is Shiba Inu coin so popular? Shiba Inu coin is majorly popular because of two reasons. Tesla founder Elon Musk has tweeted recently expressing that he would like to own a Shiba pup that hyped the crypto market and its prices rose by 300%. On the other hand, its prices fell by around 40% after the founder of Ethereum blockchain network, Vitalik Buterin, donated 50 trillion Shiba Inu coins to Indian government for COVID relief fund of an Indian crypto entrepreneur, Sandeep Naiwal. So now that we know about Shiba Inu coin and its concepts, let's have a look at what is the future of Shiba Inu coins. Though Shiba coin is only known as a meme coin, its increasing popularity and people's interest in participating in it is pointing towards a different but bright future. According to investingcube.com, the Shiba coin is predicted to rise again. Although there isn't much movement among these tokens and its value, active buyers could help its value rise. The value could rise to 0.00001040 in a more active buyer's market. Although it may not appear to be a significant amount, due to its popularity in future, it can have a significant influence over large investors of the crypto market.
Some are very interesting and important aspects of Solana crypto. First, we will understand what is Solana. Then we will look into what is a SOL token or SOL token. Then we will explore when and how did it originated. After which, we will look into some of the features of Solana. Then we will explore what type of consensus method does Solana use. After which, we will understand how Solana works. Then we will explore the current price and volume of Solana in today's date. After that, we will look into the future of Solana holds for itself. And at last, we will look into real-life uses of Solana. So without doing much ado, let's start the video. Let's explore what is Solana. Solana is a cryptocurrency that is used to pay for transactions on a decentralized computing network. Solana attempts to increase blockchain scalability by combining proof of stake and proof of history consensus. As a result, Solana promises to be capable of processing 50,000 transactions per second while maintaining decentralization. Now the question arises, what is the SOL token or SOL token? Solana's ecosystem uses the SOL token as its native currency. As a result, the token can be transferred between nodes in the Solana cluster in exchange for running on-chain programs or certifying their results. It can also be used to make micropayments known as LAMP ports. Now, when we are talking so much about Solana crypto, let's also dive down and explore how and when exactly it came into existence. Anatoly Yakovenko established the Solana platform in 2017. Before launching Solana, Yakovenko worked at Qualcomm after working as a software engineer at Dropbox. He has a wide spectrum of knowledge with compression methods. He developed a new method of dealing with typical throughput difficulties in the Bitcoin and Ethereum blockchain with the help of Eric Williams and Solana's CTO, Greg Fitzgerald. They intended to develop a trustless distributed protocol with increased scalability. The team now has experience from leading companies around the world, including Apple, Google, Microsoft, Intel, Twitter, Dropbox, and others. Now that we know what Solana is and all about its background, let me ask you a question recently. Solana joined hands with two foundations to raise a fund of $5 million to encourage the next wave of creators and fans onto crypto networks. So comment down your answers in the comment section below. To know the correct answer to this question, watch this video till the end. Moving on, let's talk about its features, which makes it unique and popular. Scalable. Solana uses proof of history and a number of other groundbreaking features to allow the network to scale at the rate of Moore's law. Low cost for applications with billions of users, Solana is designed to keep fees low. So you will never have to worry about rising fees as your user base grows. Composable. The single global state of Solana guarantees project composability. Multiple shards and layer 2 systems should never be dealt with. So we have heard a lot of references to proof of history. But what exactly is it? That we will discuss within the type of consensus method Solana uses. The Solana network, which has 200 physically different nodes, can handle a throughput of more than 50,000 TPS. When using GPUs, is one of the most performant permissionless blockchain. Unlike Bitcoin, which employs the proof of work algorithm as the system's decentralized clock, Solana uses the proof of history technique. You can use proof of history to construct historical records that verify an event occurred at a given point in time. This algorithm is a verifiable delay function with a high frequency. This function requires a specific number of sequential steps to evaluate. Each transaction or event that is examined will be assigned a unique hash, an account that can be verified publicly and effectively. The count serves as a cryptographic timestamp, allowing us to determine when each transaction or event occurred. This provides increased throughput and efficiency within the Solana network. Now that we know about its structure and mechanism, let's explore how Solana works. Now we know Solana has built a one-of-a-kind method for determining the time of a transaction known as proof of history. Let's see the step-by-step procedure of how it works. Step 1. Input the details of transactions performed in the network to its leader. Step 2. Leader will now efficiently sequence and organize the messages so that they can be processed by another nodes. Step 3. The leader then executes the transactions based on the RAM's current state. Step 4. The completed state's transactions and signature will then be published by the leader to the verifiers or replication nodes. Step 5. If the state receives confirmation, the verifiers will perform the same transactions on their copies of the state and publish their signatures. And at last, step 6, the consensus process will then use the published confirmations as votes. Now that we know everything about Solana, let's have a look at the price and volume of Solana according to market capitalization. The Solana network can process more than 50,000 transactions in 1 second, and the current price of it is $30 with a circulating volume of 270 million SOL coins, which is quite impressive considering its time span in market capitalization as well as compared to other cryptocurrencies. Let's see what future does Solana holds for itself. Solana, although being a new project, has delivered on its promises of speed and scalability. Its token price has also done well, attracting investors' attention. Nonetheless, the network acceptance and usage are still in the early stages. We won't know whether Solana's speed make a significant difference in the Bitcoin realm until we witness substantial traffic and more use cases. Having a fast network is beneficial, but the advantages will only occur as more people utilize it and more use cases emerge. Real-life uses of Solana. Serum, Radium, Bonepida, Orca, Oxygen, and Phantom Wallet are some of the recent projects that Solana is working with. Well, this is all about Solana crypto. In this video, I will take you through various important concepts and components of the Cardano. First, we will explore what is Cardano. Then, we will understand what is ADA, followed by what is its max supply and value in today's date. Then we will see why is it so popular. And after that, we will explore various layers of Cardano, followed by consensus algorithm of Cardano. After that, we will look into the difference between Cardano and Ethereum, and at the end, we will look into the uses of Cardano. So without further ado, let's get started with the video. So what is Cardano? Cardano is a third-generation decentralized proof-of-stake blockchain platform that aims to outperform proof-of-work networks. The infrastructure load of escalating expenses, energy utilization, and lengthy transaction time limits, scalability, and sustainability for proof-of-work networks like Ethereum. Foundation, decentralization, smart contracts, scaling, and governance are the 5 stages of Cardano development. The relevance of these issues to blockchain networks were recognized by Charles Hoskinson, co-founder of the proof-of-work blockchain Ethereum, who began creating Cardano and its principal cryptocurrency, ADA, in 2014 and introducing the platform and the ADA token in 2017. The Cardano Foundation, IOHK, and EMURGO are all responsible for Cardano's governance. Now let's move ahead to what is ADA. ADA is the name of Cardano's principal cryptocurrency. It is based on the Cardano blockchain, a first of its kind decentralized network built entirely on scientific and mathematical principles by cryptography and engineering experts. Its purpose is to provide a quick and secure transaction of value and allow users to operate smart contracts and applications. Furthermore, the ability to send and receive funds instantly and for a low fee has numerous applications in the business and financial worlds. It is a proof-of-stake coin used to fuel Cardano ecosystem. Now, let's have a look at the max supply and current value of ADA in today's date. According to market cap, Cardano's current value is 2.1823 USD, and the maximum supply of Cardano can be of 45 billion, out of which till today its supply has reached 31 billion. But the question is, why is it so popular? Currently, ADA, the native coin of the popular altcoin Cardano, has risen to an all-time high, breaking the previous record, despite a big price crash warning. The ADA USD rate of exchange topped $2.56 for the first time on September 17, 2021, capping a 154.54% price surge that began on July 20. Now that we have covered the basics, let's dive down and explore the layers of Cardano network. There are 2 layers to the Cardano blockchain, the settlement layer and the computational layer. The settlement layer, CSL, is responsible for settling transactions made by network peers in ADA, the local currency. The computational layer, CCL, was built with smart contracts and decentralized applications in mind. To maximize the network's capacity for protocol modification and soft fork implementations, we developed a layer protocol. Cardano is written in Haskell, while smart contracts are written in Plutus, a programming language that allows for the creation of more stringent contracts. Now let's understand the working of consensus algorithm of Cardano. As discussed earlier, Haskell, a widely recognized and secure programming language, is used to create the Cardano open source code. Cardano relies on the Ouroboros Consensus Protocol, which is an uniquely built proof-of-stake blockchain technology. This consensus process ensures that ADA may be issued and received quickly and securely, as well as the security of smart contracts on the Cardano blockchain. At the same time as a proof-of-stake consensus mechanism, it rewards token holders who stake their ADA in the network and assist ensure network unanimity. So this is how it works. First, the network chooses few nodes called slot leaders at random to have the opportunity to mine new blocks and control the flow of data. Second, the blockchain is divided into slots, each referred to as an epoch. And at last, slot leaders can mine their own specific epoch. Any person who assists in the mining of an epoch or a portion of it is rewarded. Also, an epoch can be partitioned an infinite number of times. Now that we know both Cardano and Ethereum deal with smart contracts and dApps, let's unveil the difference between them too. Launch date. Cardano was launched in September 2017, while Ethereum was launched way ago in January 2014. Cardano was founded by Charles Hoskinson, while on the other hand, Ethereum was founded by Vitalik Buterin. Consensus algorithm. Cardano follows proof of stake. Although Ethereum also intends to switch to proof of stake, it still follows proof of work. Programming language. Cardano uses Haskell and Ethereum uses Solidity. And architecture. Cardano has two layers, CSL and CCL, but Ethereum just consists of one layer. Now that we have covered all the important aspects of Cardano, let's have a peek at the uses of Cardano. One of the core principles of Cardano is that the ADA is staked to the blockchain as part of the proof of stake blockchain network, which allows stake pool operators to successfully verify transactions on the blockchain. This is where the Cardano cryptocurrency comes into play. Those that stake their ADA on the blockchain are rewarded with extra Cardano. This staking system contributes to the blockchain security. In addition, ADA is used in voting. Unlike other blockchain projects, Cardano token holders vote and decide on protocol updates rather than miners. Unlike other blockchain networks, Cardano token holders vote and decide on protocol modifications, not miners. When a new improvement or enhancement to the Cardano blockchain is suggested, Cardano crypto holders vote with their ADA. As a result, everyone who owns a cryptocurrency has a vote in how it develops. So, well, this is all about Cardano. So, what are your thoughts on Cardano? And will you be investing money in it? I will take you through various important concepts and components of the Matic. First, we will explore what is Polygon, followed by what is Matic. Then we will look into the features of Matic. And after that, we will understand how does Polygon works. Then we will discover why is it important to Ethereum and what is its current value and circulating supply. And at last, we will discuss is it a good investment or not. So without further ado, let's get started with the video. So let's start with what is Polygon. Polygon, formerly known as the Matic network, is a scaling solution that seeks to give several methods to boost the speed of transactions on blockchain networks, while also lowering the cost and complexity. Polygon describes itself as a layer 2 network, which means it is an add-on layer to Ethereum that does not attempt to alter the original blockchain layer. Like its geometric namesake, it has numerous sides, shapes, and applications, and it promises to be a more straightforward framework for creating interconnected networks. Polygon is a scaling solution that seeks to give several methods to boost the speed of transactions on blockchain network, while also lowering their cost and complexity. Now, that brings us to what is Matic. After the rebranding, Polygon retained its Matic cryptocurrency, the digital coin underpinning the network. Matic is the payment and settlement unit for participants who engage within the network and is also utilized to keep tokens safe on the Polygon network. Since then, it has received an incredible cost surge following a tremendous expansion in use. The Matic cryptocurrency is available on a number of well-known decentralized and centralized trading platforms including Binance, OneExchange, and Coinbase Pro. The crypto community is banding together to make it easier to buy Polygon or Matic tokens by making them available in both fiat and crypto. So now that we know what they are, let's have a look at the features of Matic. First is it provides blockchain performance enhancement technologies. Polygon's sidechain was one of the first things they offered. A sidechain is a blockchain that links to it and improves its performance. Transactions are processed faster and fees are significantly lower. Second is its goal to create a foundation of blockchain network. Polygon's future goals are huge. Its purpose is to create a foundation for blockchain networks. Instead of being completely disconnected, users would be able to establish blockchain networks that interconnect. Third comes its Ethereum virtual machine, or EVM compatible. Because Polygon is EVM compatible, developers can easily port their apps to it. Aave and Uniswap are just two of the popular Ethereum apps that have already been deployed on Polygon. Then comes other blockchain networks as well as Ethereum 2.0 could provide challenges. Polygon isn't the only blockchain network initiative in the works. Others such as Polkadot and Avalanche provide interconnected blockchains. Projects like these may coexist, or one may develop a superior solution and abandon the others. Ethereum has also been releasing updates to Ethereum 2.0 in a series of releases. And next is fees, governance, and staking are all handled through the Polygon token. We have discussed the project's objectives, but what about Polygon's cryptocurrency token? It can be utilized in a variety of ways. Now we have almost covered the basic. Let's dive down and understand how it works. Polygon is a multi-level platform that intends to grow Ethereum by using a variety of sidechains to unclog the main platform in a cost-effective and efficient manner. If you're not aware of sidechains, they are separate blockchains that are linked to the main Ethereum blockchain and can support a variety of decentralized finance protocols. As a result, Polygon can be linked to networks like Polkadot, Cosmos, and Avalanche. Now let's have a look at why is it important to Ethereum. Matic is compatible with the EVM. Developers that are accustomed to working with Ethereum can easily transition to Polygon. Polygon has a security layer that may be turned on or off, which enables sovereign platforms to forego additional protection while maintaining their freedom and flexibility. Matic tokens can be used to vote on Polygon improvement proposals and participate in network governance. So now let's have a look at the crypto market value of Matic. According to market cap, Polygon's current price is $1.30 USD. And the maximum supply of Polygon is 10 billion, out of which till today its supply has reached 6.67 billion. Now the question comes, is it a good investment? So if you're thinking about investing in Matic, keep in mind that cryptocurrencies are quite volatile. So you'll need to be prepared for large price swings. So only invest money you can afford to lose and make sure to build up your emergency savings and retirement account first. However, investors should keep an eye on the implementation of Ethereum 2, as well as the activity of Polygon's competitors. There's still a lot to play for in this sector, and it's unclear how it will develop. So moving on, let me give you an overview of all the topics you are going to cover across in this video. First, we will understand the basics and explore what is stablecoins. Following that, we will look into the types of stablecoins. After that, we will have a crisp comparison between stablecoins and other cryptocurrencies. Moving on, we will have a look at some of best stablecoins according to market capitalization. After that, we will dive down deeper and understand why is it so important. And in the end, we will see what can we do with these stablecoins. So now let's get started with the basics. What is stablecoin? A stablecoin is a type of cryptocurrency that is backed by a reserve asset like the US dollar or gold that aims to provide price stability. It started gaining popularity since they try to combine the best of both worlds, the rapid processing and security or privacy of cryptocurrency payments, as well as the volatility, free and stable prices of fiat currencies. So now that we know what stablecoin is, let's explore its types. The first one that we are going to understand is fiat collateralized stablecoins. It uses a fiat currency reserve such as the US dollar to issue a sufficient number of crypto dollar. To other types of collateral include precious metals such as gold and silver, as well as commodities such as oil, but the majority of today's fiat non-collateralized stablecoins use dollar reserves. Now, independent custodians manage such reserves, which are audited on a regular basis to ensure that the essential compliance is met. Tether and True USD are popular cryptocurrencies that are backed by dollar deposits and have the same value as a single US dollar. Now, moving on to the next one, we have crypto-collateralized stablecoins. Stablecoins that are crypto-collateralized are backed by other cryptocurrencies. Because the reserve cryptocurrency may be volatile, such stablecoins are over-collateralized, which means that a larger number of cryptocurrency tokens are kept as a reserve for releasing a smaller number of stablecoins. Now, coming to the last one that we have is non-collateralized or algorithmic stablecoin. Now, these don't have any reserves, but they do have a working mechanism to keep the price stable, similar to that of a central bank. The dollar pegged base coin, for example, employs a consensus method to increase or reduce token production based on demand. Now, such practices can be compared to a central bank producing banknotes to sustain fiat currency valuations. It is possible to achieve this by developing a smart contract on a decentralized platform that can execute independently. So now that we have a fair knowledge of stablecoin, let's have a quick comparison between stablecoin and other cryptocurrencies to understand their functioning even better. So the first one is, it is possible to accurately predict fluctuations in the value of stablecoin. On the other hand, it is difficult to anticipate the trend in the value of other cryptocurrencies. The second one is, stablecoins are centralized as they are maintained by independent custodians. On the other hand, cryptocurrencies are decentralized. The third one we have is, stablecoins values remains constant at $1. Cryptocurrency, on the other hand, has a price range depending on its performance in market capitalization. And the fourth one is, stablecoin price remains constant, making them non-volatile. Cryptocurrencies, on the other hand, have a lot of insecurity, making them extremely unpredictable and highly volatile. Now, let's have a look at some of the best stablecoins according to the market capitalization. First we have is Tether with the market capitalization of $79.5 billion. Then we have USD coin with market capitalization of $53.5 billion. Following that, we have Binance USD with market capitalization of $18.3 billion. Then we have Terra USD with a market capitalization of $13 billion. Then we have DAI with market capitalization of $9.7 billion. Following that, we have True USD with market capitalization of $1.5 billion. Then we have Pax Dollar with market capitalization of $947.4 billion. Following that, we have Neutrino USD with a market capitalization of $493.9 billion. Now, let's understand why stablecoins are so important to people. Stablecoins are devoid of the volatile nature of non-pegged cryptocurrencies while retaining some of their most valuable properties. Like, stablecoins are open, global, and available to everyone on the internet 24/7. They transport data quickly, cheaply, and very securely. And they are programmable and digitally native to the internet. Now that we have covered almost everything about stablecoins and its concepts, now let's see what all can we do with these stablecoins. First is, cryptocurrencies like Bitcoin and Ether have a lot of volatility, sometimes even by the minute. Buyers and sellers can have confidence that the value of their tokens will neither grow nor fall unpredictably in the near future if the asset is linked to a more stable currency, or say stablecoins. The second one is, Stablecoins can be held without a bank account and are simple to transfer. The value of stablecoins may be easily moved around the world, even to countries where the US dollar is difficult to come by or where the local currency is volatile. Coming to the third one is, there are several simple ways to earn income on a stablecoin investment, which is often higher than what a bank would offer. So for the fourth one, we have, with transfer fees of less than $1, people have sent as much as $1 million worth of USDC. And the fifth, the last one is, stablecoins like USDC is a wonderful alternative for transporting money around the world because of their quick processing and cheap transaction fees. So this was all about stablecoins.
Before getting to the comparison of crypto coins and tokens, let me give a quick introduction to what is a digital asset. This will help you understand the difference between crypto coins and tokens better. Broadly speaking, a digital asset is a non-tangible asset that is created, exchanged, and kept in a digital format. By this definition, cryptocurrencies and crypto tokens are considered digital assets in the context of blockchains. Since both cryptocurrencies and tokens are digital assets on blockchains, the terms are frequently used synonymously, but they are not similar. There are multiple parameters where they differ from each other on multiple levels, and that's what we will cover moving forward in this video. So let me take you through the comparison parameters based on which we will compare crypto coins and tokens. First is definition. Cryptocurrencies have their own unique blockchain. BTC is the currency used in the Bitcoin blockchain. Ethereum has ETH on its blockchain. Similar to traditional currencies, the main purpose of these currency coins is to serve as a form of wealth storage and a medium of exchange. For this reason, cryptocurrency is another name for cryptocurrency coins. Although they are created utilizing blockchain technology, unlike cryptocurrency currencies, crypto tokens are not native to a blockchain. While cryptocurrency coins imitate conventional money, crypto tokens behave more like assets or even deeds. A crypto token may serve as a proxy for ownership. The next parameter that will be measured is supply.
If getting your learning started is half the battle, what if you could do that for free? Visit SkillUp by Simplilearn. Click on the link in the description to know more.
The way they are created. Mining is used to create crypto coins. In most cases, cryptocurrencies are either mined using a proof of work, or POW, or a proof of stake, POS, consensus mechanism. Tokens, unlike cryptocurrencies, are generalized and distributed by the project developer rather than being mined. Tokens can be utilized in a plethora of ways once they are in the possession of buyers. Now, talking about fees, or gas. When transferring a cryptocurrency, transaction fees, or gas, are cheaper. However, when transferring tokens, they are more expensive. When transferring tokens, you still require some cryptocurrency in the same account because fees are always paid for in cryptocurrencies. Now, moving on to the next parameter, purpose. What are they used for or what they serve? Crypto coins are designed to work in the same way as paper money and metal coins, meaning they can be used for many of the things normally used with US dollars or euros, including storing value, exchanging for other currencies, paying for goods and services, transferring to others, and so forth. Whereas most crypto tokens are made to be utilized in DApps or blockchain-based projects. Crypto tokens can represent ownership in a DAO, a digital product or NFT, or even a tangible item. Crypto tokens are similar to currencies in that they may be purchased, sold, and exchanged, but are not utilized as a means of exchange. To put it another way, crypto coins are more like dollars and cents, whereas crypto tokens are more like coupons or vouchers. And the last parameter that will be measured is types.
Choose from over 300 in-demand skills and get access to 1,000 plus hours of video content for free. Visit SkillUp by Simplilearn. Click on the link in the description to know more.
The variation of crypto coins or tokens present in the crypto market. Some of the popular crypto coins are Bitcoin, the first and most well-known crypto coin in the world. Ethereum implements smart contracts and is the home to thousands of blockchain projects and NFTs. Cardano, an open source and decentralized blockchain platform that is one of the first to run on a POS consensus, and many more. In crypto tokens, some of the popular tokens are Filecoin and Arweave. Allow users to pay with their utility tokens for the right to store data on their decentralized network, maximizing the potential of cloud storage. Axie Infinity, one of the best-known play-to-earn on the market, and features a utility token called Smooth Love Potions. Chronos, a utility token for the Crypto.com ecosystem, and there are many more tokens available in the crypto ecosystem. Now, the decision of whether to purchase coins or tokens greatly depends upon the holder's intention.
So why wait? Let's embark on this exhilarating adventure together. But before we dive in, if you're looking to take your career to new heights and become a true expert in the realm of blockchain and cryptocurrency, consider checking out our professional certificate program in blockchain in collaboration with IIT Kanpur. It's an excellent opportunity to master key architectural principles and develop the skills needed to excel in this rapidly growing field. So let's have a look at topics that we are going to cover in this topic. First, we will understand what is Ripple, followed by what is XRP. Then we will see the working of Ripple. Then we will learn how to mine XRP. After that, we will have a comparison between Bitcoin and Ripple. Then we will explore the pros and cons of Ripple. After which we will see how you can actually use Ripple. Followed by, we will see how can we buy Ripple. And in the end, we will see if it is a good investment or not. So let's get started with the video. First, let's understand what is Ripple. So the firm behind XRP is Ripple, which is a payment settlement systems and currency network that can handle transactions all across the world. Basically, it acts as a trusted intermediary between two parties in a transaction. As the network can be immediately validated that the transaction was completed successfully, Ripple can ease the exchange of a wide range of fiat currencies and cryptocurrencies, including Bitcoin. So when users utilize the network to make a transaction, the network takes a modest charge in the form of XRP. And Ripple was built from the ground up to be a SWIFT, a leading money transfer network successor, or to otherwise replace the sentimental layer between large financial institutions. So this raises the question of what is XRP. So let's have a look at it. The XRP ledger created by Jade McCaleb, Arthur Brito, and David Schwartz is a blockchain that runs XRP. McCaleb and Brito would go on to form Ripple, which would employ XRP to enable network transactions. You can acquire XRP as an investment, crypto to trade from other cryptocurrencies, or as a way to fund Ripple network transactions. XRP's blockchain in particular differed from that of most other cryptocurrencies. Other cryptocurrencies give anyone who can solve difficult equations quickly access to their transaction ledgers and verification processes. Ripple transactions, on the other hand, are safe since the majority of ledger holders must agree to the verification before they can be added. Also, the Ripple network, which employs XRP, is somewhat centralized and uses a consensus protocol. This means while anyone can download its validation software, it has its own node list that consumers can use to validate transactions, based on which participants they believe are least likely to cheat them. So now that we know the basics of Ripple and XRP, let's have a look at the working of Ripple. To verify transactions, the XRP cryptocurrency employs a consensus protocol. Validators verify that proposed transactions are valid by comparing them to the most recent version of the XRP ledger. Now a transaction must be accepted by the majority of validators in order to be verified. Once it's verified, the transaction is then added to the blockchain. So now that we know it's working, let's have a look at how Ripple can be mined by its users. Ripple's or XRP is created using a crypto ledger that is akin to blockchain technology and is federated by financial institutions and payment processor networks. While it is true that Ripple XRP cannot be mined by miners, it is technically viable to do it using other cryptocurrencies. So one of the most viable techniques for mining XRP is to mine other cryptocurrencies such as Bitcoin and Ethereum and then transfer the mined crypto for Ripple through exchanges. And that's how the mining is done. So as we have discussed all the basics of Ripple, let's dive down deeper and have a look at how it differs from Bitcoin. To verify transactions and distribute new currencies, Bitcoin employs mining. Participants set up mining devices to solve complex mathematical equations, with the first person to solve the equation winning the right to add a block of transaction to Bitcoin's network. Then participants receive Bitcoin rewards for each block they add in the exchange for Bitcoin mining. Whereas the consensus protocol used by XRP then confirms transactions. For a transaction to be accepted, it must receive the approval of a majority of validators who actually review it. Then Bitcoin transaction confirms can take several minutes and are associated with significant transaction charges due to the intricate and expensive nature of mining utilized in the cryptocurrency. But on the other hand, XRP transactions are instantly confirmed and have very cheap transaction fees. The user is charged a small amount of XRP each time a transaction is completed on the Ripple network. Now, the supply of Bitcoin is limited to 21 million, which means there will be never more than 21 million Bitcoin. The artificial scarcity of 12 Bitcoin has sparked investor interest in the currency's potential as a safe haven. But in contrast, at the time of introduction, 1 billion XRP was pre-mined and progressively distributed onto the market by the company's major investors. Next we have when miners discover Bitcoins, they are released and added to the network. They have no set release date and their supply is largely determined by network speeds and the difficulty of the algorithm used to create coins. On the other hand, the release of XRP is controlled by a smart contract. According to an inbuilt smart contract, Ripple is expected to distribute a maximum of 1 billion XRP tokens per month. So the current circulation is 55 billion till now. So this was all about the difference between Bitcoin and Ripple. And I'm pretty sure that till now you have understood all the basic knowledge about Ripple. So let's move ahead and look into some of the pros and cons of Ripple. Though XRP transactions are quick and inexpensive, Ripple's consensus protocol is perhaps less secure than other crypto transaction processing technologies. Next is, even though financial organizations are already using Ripple's payment network, Ripple's financial partners primarily use RippleNet rather than XRP cryptocurrency. Next we have is small company owners and individuals who can utilize XRP to make safe money transactions. Yet because it is administered by a private corporation and because of the SEC litigation, Ripple has sparked the debate. And for foreign currency transfers, XRP can be utilized as a bridge currency. But in the United States, buying XRP is quite challenging. So now that we know its pros and cons also, let's have a look how you can actually use Ripple. XRP can be used in the same way as any digital currency for transaction or as a possible investment. Other sorts of transactions such as currency exchange potentially be processed using the Ripple network. For example, instead of dealing with the currency conversion directly through a bank or money changing exchange, you may first exchange your US dollars for XRP on the Ripple network and then use them to buy euros, rather than paying the hefty cost that banks and money transmission businesses may demand. This can be a lot fast and less expensive option. So now that we know everything about Ripple, let's explore how can we actually buy Ripple. So all you need to do is sign up for an account on an exchange that sells Ripple's XRP cryptocurrency. To buy it, then using any of the exchange's allowed payment methods, buy it. Here are a few places where you can get XRP: KuCoin, Uphold, and CoinMama. Now the question is, Is Ripple a good investment? So, XRP is a risky investment that is not for the faint of heart. However, if you feel Ripple will succeed as a payment system, it may be worthwhile to invest in XRP. So just be sure you're not gambling with money you can't afford to lose. Well, this was all about what is Ripple. So let's start the video. Let's have a look at the topics that we are going to cover in this video. First, we will explore what is Binance Coin. Following that, we will understand how it works. Then we will dive down deeper and explore a very interesting concept followed by Binance, which is BNB burning. Then we will look at the uses of the Binance coin, followed by its benefits. After that, we will come across some important factors to consider before investing in the Binance coin. And at the end, we will see the pricing dynamics of the Binance coin. The first thing that we are going to explore is what is Binance coin. So Binance coin or BNB is a cryptocurrency that may be used on the Binance cryptocurrency exchange to trade and pay fees. As of January 2018, the Binance exchange was the world's largest cryptocurrency exchange, conducting over 1.4 million transactions every second. This coin is limited to 200 million BNB tokens and runs on the Ethereum blockchain using the standard ERC20 protocol. As an incentive, Binance coin users receive a reduction in transaction cost on the Binance exchange. Other cryptocurrencies such as Bitcoin, Ethereum, Litecoin, and others can be exchanged or traded for BNB. Now, let's move on and see how it works. BNB is a crypto asset that fluctuates in value as individuals use and trade it, similar to other digital assets on the market. BNB can be stored in suitable wallets obtained from crypto exchanges and sent directly to others for payments and other purposes. But there is a whole working initiative behind this process. Binance Layer 1 blockchain is merged to form the BNB chain, previously the Binance Smart Chain and the Binance Chain. Binance designed the blockchain for best performance when it comes to trading on-chain when building the BNB chain and Binance DEX. It is also based on this newly developed chain. Furthermore, BNB chain transactions are powered by the BNB gas token, which stands for Build and Build, previously also known as Binance Coin. Now, BNB Beacon Chain and BNB Smart Chain make up the BNB chain. The former is concerned with BNB chain governance, which allows BNB holders to vote and stake their coins. Then, it's a consensus layer that's compatible with the Ethereum virtual machine and has multi-chain hubs. Now, moving on, let's have a look at the BNB burn concept. Binance uses 20% of its profit each quarter to buy back and burn Binance coins, completely destroying them. Binance has consistently performed quarterly burns, the most recent being on October 17, 2020, which was the 13th quarterly burn. Binance will continue to burn BNB coins every quarter until it has purchased and destroyed 100 million Binance coins, or half of the total supply. Binance coins supply is reduced as a result of the procedure, and its rarity is affected, which could affect the asset's value. Binance also has a program called the BNB Pioneer Burn Program, which assesses cases when BNB holders have unrecoverably lost BNB and compensate them by reducing the amount from the next BNB burn. Now, let's have a look at some of the uses of the Binance coin. The Binance coin, like other developing cryptocurrencies, has a variety of applications outside of the Binance exchange, including: first is trading. Binance coin can be exchanged for other cryptocurrencies on a variety of exchanges depending on the exchange's regulations. Next is transaction fees on the Binance exchange. Users can use BNB to pay for transactions on the Binance exchange and earn a hefty discount. Next we have is credit card payments. On crypto.com, BNB can be used to pay for crypto credit card bills. Next is payment processing. Merchants can accept BNB as a form of payments, giving customers more options in terms of payment methods. Next we have is booking travel arrangements. On certain websites, BNB can be used to book hotels, flights as well. Next is entertainment. Now, BNB is used for a variety of purposes in the entertainment industries, from paying for virtual gifts to purchasing lottery tickets as well. Next in the line is investment. Binance Coin can be used to invest in stocks, ETFs, and other assets on a variety of platforms. And at last is loans and transfers. On some platforms, BNB can be used as a collateral for loans. There are also apps that allow users to use Binance Coin to split bills and pay friends and relatives. So now that we have covered the basics of the Binance Coin, let's have a look at some of its benefits that makes it unique. Starting with quick transactions. When you trade on the exchange with BNB, you'll have access to the platform proprietary matching engine, which can handle up to 1.4 million orders per second. Finding the appropriate transaction is always possible, and using BNB makes it even easier and more reliable. Next is secure and trustworthy. Binance already has millions of cryptocurrency users and dealers who rely on the platform and believe in the security and protection aspects of this exchange. To keep your funds safe, the exchange uses a multi-cluster and multi-tier system framework, as well as the secure assets funds for users. Next is trade multiple cryptocurrencies. You can trade more than 150 cryptocurrencies on the exchange with BNB, thanks to a rapid, secure, and low-cost transaction matching technology. Aside from that, BNB has its own trading pair to fulfill your individual trading needs. There's no need to seek elsewhere. Moving ahead is trading discount. You can also get a 50% discount on your trading charge if you use BNB. With traditional payment methods, if you buy $10,000 worth of coins, you'll be charged $10. And if you use BNB, though the trading charge is cut in half, so you will just have to spend $5. Next is spending Binance Coin. You can utilize BNB in a variety of ways in addition to having a smooth experience within the Binance ecosystem and receiving transaction fee discounts. Several service providers, particularly in the travel and hotel industries, accept it. Using BNB, you can purchase dinner or a new phone as well. Now, let's have a look at some of the factors that you should consider before investing in Binance Coin. Now, Binance coins can be used to invest in some ICOs listed on Binance Launchpad program. The Binance exchange will publish new cryptocurrencies, and the use of Binance coins will provide a seamless marketplace for trading a range of virtual tokens. Binance will eventually become the decentralized Binance Exchange's principal currency. The Visa debit card of Monaco, the world's first payment and cryptocurrency platform, and the platform's mobile app also support Binance Coin. Now, as we are talking about investments, let's have a look at the peek at BNB pricing and dynamics. BNB's pricing has traditionally varied in a similar way to the price of other crypto assets traded on the market. Binance Coin's market capitalization has increased over time, topping $70 billion. BNB was also sold for around $0.10 per token during Binance's ICO. Today, the current value of BNB is $286.67 with a market capitalization of $46,801,210,081. BNB has seen a tremendous increase in value since its ICO, reaching a high of more than $600 per coins at time. Is it wise to invest in Binance Coin? Well, if purchased, joined, and sold at the right times, it's conceivable, and its past price growth resulted in profit. However, only time can tell where the price of BNB will go in the future.
Alex, like everybody else in the world, had heard a lot of hype around blockchain and cryptocurrency. Being a techie, he started exploring blockchain and cryptocurrency and understood that blockchain is a distributed digital database that makes recording transactions and managing assets in a corporate network much easier. And cryptocurrency, on the other hand, is a digital currency that acts as a medium of exchange over a blockchain network. It is not supported by any central authority, such as a government or bank. But what intrigued him was how people contribute to blockchain. So he decided to go to a friend, Sarah, who is a blockchain expert. Upon asking how people actually participate in blockchain, Sarah answered this occurs via crypto mining. Cryptocurrency mining is the process by which specialized computers, often known as nodes or mining rigs, validate blockchain transactions for a specific crypto coin in exchange for a mining payout. Listening to this, Alex asked if he could also join this network and be a part of the crypto mining process. Sarah said it's a little difficult because crypto mining requires a huge setup like a high-end processor, GPU, high-performance graphics card, lots of electricity, and an AC. And to set up all this, he needs a huge amount of land. Alex was disappointed, and that is when Sarah said, "But there is one network that you can mine without any hassle. It is Pi Network." Alex got curious and asked what Pi Network is and how it can act differently from other cryptocurrencies. Sarah explained that Pi Network is a digital currency initiative that attempts to make cryptocurrency mining accessible, as first-generation currencies such as Bitcoin have become too centralized for many daily users. Let's understand this in detail. Pi Network came into the picture in 2019 itself. Since then, it has been in testing mode, even though it's not launched yet. It still offers to mine its coins. And here's how. To mine it, users must first safeguard the currency. They also need to expand their network by referring it to others. All you need to do is 1. Every day, log in and click a button to receive digital cash. There is no evidence of labor being done. They simply log in and press a button. Because this currency is not yet exchanged, it has no value. 2. Increase your level by inviting additional people to the site. This allows them to accumulate more digital cash each day. In pyramid schemes and multi-level marketing, this is a common model. She further added that Pi was designed to be halved regularly to protect its scarcity. When a miner receives half as many coins for processing new transactions, this is known as halving. It usually happens when you reach a certain milestone. When Pi hit 100,000 users, its mining rate fell to 1.6 per hour, then to 0.4 per hour, then to 0.2 per hour, and finally to 0.2 per hour when it reached 10 million users. It will continue to have until 1 billion users are reached. On learning about this whole new cryptocurrency transformation in Pi Network, Alex was sure that he definitely wanted to lay his hands on it for once. With branding based on the number pi, the project's first phase began on Pi Day on March 14, 2019, with the free Pi mining app. The network had over 100,000 active users by June 2019. When Phase 2 began a year later, more than 3.5 million users were there. In May 2020, the app began running advertisements in order to raise funds for the project. On March 15, 2022, Pi Network said its user base had grown to 33 million, up from 14 million in March 2021.
It will enable a completely decentralized web where users are in control. Basically, it's designed to link public and permission networks, oracles, private and consortium chains, and yet to be developed future technologies through the Polkadot relay chain. Polkadot enables an internet where separate blockchains can communicate data and transactions in an untrusted manner. Decentralized institutions, services, and apps are now easier to build and link than ever before. Polkadot aims to liberate society from its reliance on a broken web where its powerful institutions cannot betray our confidence by giving entrepreneurs the tools they need to create better solutions. Now, this whole explanation raises a question of who is responsible for building Polkadot. So let me explain you. The Web3 Foundation, a Swiss organization established to promote a fully functional and user-friendly decentralized web, has made Polkadot its flagship project. Now, to build Polkadot and encourage the creation of the services and apps that will run on it, the Web3 Foundation is collaborating with top-tier organizations. A world-class implementation of Web3 with Polkadot at its core is being developed by researchers from INRIA Paris and ETH Zurich, developers from Parity Technologies, and capital partners from cryptocurrency funds like Polychain Capital. In fact, do you know that grants are being offered by the Web3 Foundation for ecosystem growth? Well, so moving on, let me take you through the working of Polkadot. Because so many parachains help the main relay chain with a lot of the heavy lifting, Polkadot is able to analyze all this data. As a result, compared to around 7 for Bitcoin and 30 for Ethereum, the Polkadot network can execute more than 1,000 transactions per second. Now, Polkadot should become much faster if the network expands and more parachains are added, and then the speed can reach 1 million transactions per second as well. Now, let me take you through a very important aspect of Polkadot network, which is very evident in its name itself, and that is DOT. Now, the native token of the Polkadot network is DOT. Transaction fees, staking, governance, purchasing a parachain space, and enabling a number of crucial Polkadot features may all be done with DOT. Now, these dots can be connected in multiple ways, so let's discuss them one by one. First is relay chain. It's Polkadot's core aspect and is in charge of the network's interoperability across chains, consensus, and shared security. Second is parachains. Now, these are independent blockchains that are capable of creating their own coins and tailoring their functionality to particular use cases. Third is parathread, which is similar to parachains but uses a pay-as-you-go payment system. Now, blockchains without a constant connection to the network are more cost-effective. Fourth is bridges. Now, this enables connections and communication between parachains and parathreads and other networks like Ethereum and Bitcoin. So now that I have already discussed about dots, let me give you a quick overview of how one can use these dots. So if you have one dot, it is bare minimum balance needed to maintain an active Polkadot network account. Now your account will be deleted if the amount falls below one dot. So find out more about accounts and the need for existing deposits. Then we have 5 dot. To participate in crowd loans for parachain slot auctions, you must make a minimum contribution of this amount. Then we have 10 dot. It is the bare minimum stake necessary to submit your nomination of validator's purpose. However, in order to receive staking incentives, your stake must be greater than the dynamic minimum stake among active nominators. Find out how to nominate people. And then it's 20 dot. You can cast a council vote or register an on-chain identity. Now the democracy of Polkadot benefits from DOT to make suggestions, to support them, and to vote on them when they become referendums. DOT must be bonded. To submit a treasury proposal, 100 DOT in bonds of 5% of the required funds must be provided. Now you may be able to take part in initiatives like the 1000 Validators programs thanks to DOT. Now moving ahead, let me tell you about why you should consider Polkadot. So Polkadot provides a platform for everyone regardless of whether you are a blockchain developer or just interested in being a part of the community. This wiki provider a location for builders and maintainers to use tools and for new students to explore educational content. Now let me tell you about how staking actually works on Polkadot. So in order to protect the network or validate transactions or generate and distribute new DOT, Polkadot uses a proof of stake consensus process. Depending on how much time, technical expertise, and money they wish to invest, DOT holders can engage with the staking mechanism in a variety of ways, like validators, who do the most work. It's a big commitment and calls for technological expertise. You must maintain a node or one of the computers that makes up the network with little to no downtime and stake a sizable portion of your own DOT in order to become a validator. Now you gain the ability to approve valid transactions and add new blocks of the transaction to the relay chain and potentially establish DOT while also receiving a cut of transaction fees and tips in return. Next we have is nominators. They enable everyday investors to take part in staking covertly. You can trust a validator to follow the rules if you give them part of your DOT. In return, you receive a portion of the DOT that your selected validators earn. Now you risk losing some of your stake if your validators violates the rules, so choose carefully. Any of the jobs mentioned above will allow you to stake and participate in the network in order to be eligible for DOT awards. Holders of DOTs can vote on proposed software changes and have a say in how the network is run. So this was all about Polkadots and its related. Well, let's have a look at what you are going to learn in this video about Litecoin. So first, I will take you through the definition of what is Litecoin, followed by how it works. Then I will let you explore the differences between Litecoin and Bitcoin. Then I will help you understand what are the pros and cons of Litecoin. Then I will explain to you how Litecoin is used. Following that, I will explain to you how Litecoin is traded. And then I will let you explore why trade Litecoin with CMC markets. And then I will take you through the factors that affect Litecoin. And in the end, why should you buy Litecoin? So let's get started with the video. First, let me make you understand what is Litecoin. Now, the native cryptocurrency of the open source blockchain project Litecoin, whose code is a copy of Bitcoin's, is LTC. As the silver to Bitcoin's gold, Litecoin was created to be more scalable and to process transactions considered more quickly than Bitcoin. In October 2011, Charlie Lee, a software engineer who had previously worked at Google and the cryptocurrency exchange Coinbase, announced the creation of the blockchain on the Bitcoin Talk forum. Now that we know what is Litecoin, let me take you through how it actually works. Now, using an open source cryptographic technology, digital coins are created and transferred using Litecoin. It keeps a decentralized public ledger for all transactions using blockchain technology. Now, what is blockchain technology? A shared digital ledger called the blockchain contains a record of every Litecoin transaction. By miners, recent cryptocurrency transactions are compiled into blocks. After that, the blocks are cryptographically protected before being connected to the pre-existing blockchain. Now, Litecoin and Bitcoin, among other cryptocurrencies, also use similar blockchain technology. Now, this raises a question that what is mining? Now, mining is the process of employing miners or mining software to secure each block to the current blockchain. The release of new Litecoin units occur when a block has been secured. These units can be reintroduced into the market by miners. Well, this raises another question that how exactly Litecoin differs from Bitcoin. Now, this comparison will be made on a few parameters. First is coin release date. Litecoin was launched on 7 October 2011, whereas Bitcoin was released on 9 Jan 2009. Second is maximum coin supply. There is a limited supply of coins in circulation for both Bitcoin and Litecoin. Litecoin has 84 million coins accessible, which is almost 4 times as many as Bitcoin's 21 million. Third is average transaction speed. Now, despite requiring more advanced equipment than Bitcoin to mine, which takes almost 10 minutes, blocks in Litecoin are actually generated in 2.5 minutes, up to 4 times faster. Additionally, Litecoin executes financial transactions much more quickly and can handle more of them in the same amount of time. Fourth is halving interval for block rewards. Their range is based on basically market supply only. And the last one is mining algorithm. A cryptocurrency's blockchain can grow by adding new blocks when miners successfully solve hash functions. Now, Litecoin and Bitcoin employ different mining algorithms. Script is the hash function used by Litecoin, and Bitcoin utilizes SHA-256. Now, let me explain to you the pros and cons of Litecoin. Now, the popularity of Litecoin started to soar in 2017. 5 years later, it is still in demand and sells for over $70. It has fared better than many of its rivals during the recent cryptocurrency sell-off, but investments always carry a risk. It's impressive how relative stability has held up for Litecoin throughout time, though it exhibits steadiness but lacks the impressive growth that attracts investors. Although the coins are reasonably priced, they are nonetheless more expensive than most of their rivals. Also, Litecoin's market capitalization is smaller than other cryptocurrency, and it has lost market share as well. Also, Litecoin is less speculative than many of the younger coins, even if all cryptocurrency investments are speculative. The expansion of Litecoin may be constrained by the fact that it is less scalable than competitive blockchain like Stellar Lumens. So now that we have covered the basics of Litecoin, let me take you through how Litecoin is exactly used. Now, due to its strong liquidity, Litecoin is a cryptocurrency with simpler trading. Actually, owners of Litecoin will discover the businesses like Newegg, Sling TV, and even charities like the American Red Cross are glad to take their digital money. To make a payment with LTC, you can alternatively utilize a digital currency app like BitPay or CryptoPay. Now, you can use the Binance app to send money using LTC if you wish to use it for peer-to-peer payments. Now, let's see how Litecoin is exactly traded. Now, the price of one Litecoin is typically indicated against the US dollar when purchasing it on an exchange. In other words, you are selling USD to purchase LTC. If the price of Litecoin increases, you can sell it for a profit because it is now worth more in USD than when you first purchase it. Now, if you opt to sell at a lower price and incur a loss, this is what will happen. Also, you can trade Litecoin with CMC markets using a spread bet or contract for difference or CFD account. This enables you to make price predictions without actually owning the cryptocurrency. Your possession of Litecoin is not transferred. Instead, you are taking a stake whose value will fluctuate with changes in the price of Litecoin relative to the US dollar. Now that you know how Litecoin is traded, let me explain to you why Litecoin should be traded with CMC markets. So the first reason is open a long or short position. Now you can trade on increasing and falling prices with speed betting at CFDs to sell Litecoin, which is not available on cryptocurrency exchanges, and you do not need to hold any. Second is efficient use of capital. Now, when you trade using leverage, you merely put up a small portion of the total trade value to begin a position. With well-known cryptocurrency exchanges, you must deposit the entire contract's value. Remember that both gains and losses will be amplified, and you risk losing more money than you initially invested. Third is no exchange account or wallet. There's no requirement to open an exchange account or wallet to store the purchased Litecoin. In contrast to trading the underlying cryptocurrency, this eliminates the need to wait for exchange approval, worry about keeping your wallet secure, and pay fees if you decide to withdraw money later. Fourth is trade with an established provider. CMC Markets is a licensed provider with 29 years in the business. We provide assistance to all of our customers anytime the markets are open. And fifth is trade responsibility. For most people, cryptocurrencies are still rather new and can be very unstable. They want our clients to fully access comprehensive instructions, resources to support their trade. Now, let's have a look at the factors that actually affect the LTC coin. Now, similar to Bitcoin, Litecoin's volatility is likely influenced by the following factors. First is regulation. Governments and central banks presented do not control cryptocurrencies. There are concerns about how this might evolve over the coming years and its effect on value. Second is supply. There are only so many Litecoins that can be mined, which is 84 million. The rate at which coins are introduced to the market can also effectively availability. Third is stress. Public opinion, security, durability, and the pricing of competing cryptocurrencies like Bitcoin can all impact Litecoin prices. And fourth is adoption. Neither consumers nor businesses have yet embraced Litecoin as a form of payment. However, some believe that blockchain technology has promise and may one day be more widely used. Now, the biggest question of concern is, should you buy Litecoin? According to Blasky or BitIRA, Litecoin might be a good addition to the portfolio of an experienced cryptocurrency investor who values its stability and adaptability, particularly for those who want a combination store of value asset with the side bonus of convenient transactions. So, according to some experts, Litecoin might be a suitable investment for a beginner looking to learn the ins and outs of cryptocurrency trading. Mania makes the following conclusion about whether LTC is a good option for your wallet. There are other blockchain competitors that individuals may pick from, but Litecoin still remains a relevant choice. So, let's have a look at what we are going to learn in this video. First, we will learn what is Algorand, followed by what is ALGO. Then we will look into its foundation and protocol. Then we will understand what is Algorand staking mechanism and how does Algorand work. And at the end, we will see how to buy Algorand. So before we understand the in-depth mechanism of Algorand, let's first understand what Algorand is. The blockchain network and project Algorand was established in 2017 by MIT computer scientist Professor Silvio Micheli. In June 2019, ALGO, the network's native cryptocurrency, and the mainnet network both became live. The blockchain facilitates smart contracts and, as was already mentioned, focuses on increased scalability. With support for customizable layer 1 blockchains, the Algorand network is a public, decentralized, pure proof-of-stake blockchain. Now, these can be used to build blockchains that are customized for particular purposes. According to the initiative, financial services, decentralized finance, fintech, and institutions can all benefit greatly from its technology. Well, this reminds me, do you know which nation is the first nation to accept digital currency? To figure out which nation is taking a step toward future technology, hang on till the end of this video. Till then, you can all comment down your answers below. Now let's get back to the video. So now that we have come to its crypto algo, let's understand that also in detail. The native currency of Algorand, ALGO, has a total supply cap of 10 billion coins, which will be issued by 2030. Each newly forged block is accompanied by a new algo that is sent to particular algo holding wallets. So you must have at least one algo in a non-custodial wallet. To obtain these algo incentives, approximately every 10 minutes, this reward, which offers algo holders an APY of between 5 and 8%, is given out. Now, due to this process, you can passively stake the algo coin, making it one of the easiest cryptocurrencies to earn a passive income. Now that we know what is Algorand, let's have a look at how its foundation was built and what projects it deals with. The Algorand network is funded and expanded by the Algorand Foundation, a non-profit corporation that was established in 2019. Additionally, it contributes significantly to blockchain governance, research, and community. For instance, the foundation has provided developers with education through university programs and has assisted Algorand projects within its ecosystem with accelerator programs. However, the private corporation Algorand Incorporated is in charge of technical development. Additionally, the Algorand Foundation holds a sizable amount of algo which it utilizes to finance its operations. Now this raises the question of what protocol Algorand primarily follows. So let's have a peek at them. The Algorand network asserts to address three main problems referred to as the blockchain trilemma: security, scalability, and decentralization. These are the three main issues the Algorand protocol intends to address. So let's discuss them one by one. First is security. Now the Algorand protocol is resistant to malicious assaults, which makes it perfect for transactions. keeping valuable assets, and developing secure business applications. It keeps security at both the network and consensus protocol levels and safeguards user accounts individually. Second is decentralization. Now, Algorand lacks a single point of control or centralized authority. Participating nodes in the network verify transactions, and all nodes have an equal voice in decision making. Algorand is an extremely decentralized system as a result. So, because the selection is both random and private, anybody on the network has a chance to be a member of the committee of users that approves each block. So, there is a no set committee, and volunteers from all over the world administer its nodes. Third is scalability. Now, the Algorand protocol is more scalable than Bitcoin or Ethereum because it can process several transactions per second. Now, the consensus protocol developed by Algorand eliminates the requirement for the computational power that Bitcoin or Ethereum uses to address cryptographic issues. Well, this brings us to the staking mechanism of Algorand. Algorand employs a special proof of stake variant known as pure proof of stake. One ALGO token is all that is necessary to participate in pure proof of stake and to help secure the network. On the contrary, Ethereum 2.0 has a 32 Ether minimum stake requirement, creating a substantially higher entrance barrier for consumers. On the other hand, a low minimum staking requirement can compromise network security since users may not act ethically if they have little money at stake in the network. So now that we know that Ethereum and Algorand are closely working with proof of stake, there is a huge rivalry competition between them. So let's see how they both actually differ from each other. Now, blockchain technologies like Algorand and Ethereum can be seen as rivals. Both platforms employ smart contracts and provide the infrastructure necessary for creating more blockchain-based projects. So Algorand and Ethereum differ from one another primarily in the blockchain's consensus mechanism. Ethereum employs the proof of work algorithm, which needs a lot of energy and processing power to mine new currencies and complete transactions. Ethereum is increasingly switching to the proof of stake algorithm, the most popular kind that needs blockchain network users to choose them as validators. On the other hand, Algorand is already using pure proof of stake. Now, on average, a new block of transactions can be processed on the Ethereum platform every 12 to 14 seconds, whereas Algorand network transactions are completed more quickly, in less than 4 seconds also. So now that we have covered all the basics of Algorand, let's dive deeper and have a look at how it actually works with proof of stake. Now, Algorand has provided a two-layer smart contract design since 2020 that differs significantly from past methods. And this is how it goes. Now, layer 1 is on-chain for smart contracts that carry out basic, usually transactions directly on the blockchain. Now, Algorand layer 1 deals with atomic transfers, or when several parties consent to swap cash. Whereas layer 2 is off-chain and is for specific two required smart contracts. This covers too large, too complex, or too computationally demanding smart contracts. The gist is that less complex smart contracts, which will take longer to process, operate outside the blockchain and run on a different platform. Now, Algorand can operate more efficiently than single layer blockchain thanks to this architecture. Algorand uses a pure proof of stake mechanism to validate transactions. Now, anyone can stake their tokens and take part in the validation process if they have at least one algo in their possession. The Algorand protocol chooses participants to validate blocks of transaction. The possibility of selection for each online user depends on the number of algo tokens. Users receive participation benefits for confirming their transactions. So here are the 3 steps that Algorand undergoes while working with. First is proposal stage. Now users become participation nodes once they have staked and generated their participation key. Algorand relay nodes serve as the channel for communication between these nodes. Now the block proposal phase then uses a verifiable random function to choose several block proposals while taking into account the percentage of each validator's stake. The identity of the chosen block proposer is hidden until the new block is offered, because harmful actors cannot target the selected validator. Network security also increases. However, proposers can exhibit their VRF output with the proposed block to demonstrate their legitimacy. Then comes the second stage, the soft vote stage. Participation nodes are chosen randomly to join the soft vote committee after a block has been submitted, so that only one candidate can add to the blockchain. This stage screens ideas. Voting power on the soft committee is proportionate to each node's stake, and votes are utilized to choose the proposed block with the lowest VRF hash. Now, because the lowest VRF hash is an unpredictable value, it will be hard to attack the block's proposal in advance. And then comes the last stage, certify vote stage. The integrity of the transaction in the block from the soft vote stage will be examined by a new committee established to look for double spending. Now, the block is added if the committee accepts the work. If not, a new block is chosen. The current block is rejected and the blockchain goes into recovery mode. It is an aspect of pure proof of stake consensus mechanism, since the leader who suggests a faulty block is not subject to a slashing penalty. Algorand forks are relatively uncommon because only one block proposal may be certified at a given time. All transactions are then deemed as final after the block has been added. So now that we have covered all the technical concepts and functionalities of Algorand, let me tell you where you can actually buy Algorand. Basically, you have a wide range of choices available when it comes to purchasing cryptocurrencies. Thankfully, Coinbase, Binance, eToro, Kraken, and Crypto.com works wherever Algorand is available. So you may purchase Algorand. It is speedy, simple, and secure. Well, this brings us to the end of this video. But before ending this video, let's have a look at the question I asked you before in this video. Well, the first nation to accept digital currency is the Marshall Islands. The Republic of the Marshall Islands is a country that embraces emerging technologies to create an open financial system that uses blockchain technology. The SOV, a digital currency, will coexist with the US dollar in circulation and support the Marshall Islands' productive participation in the world economy.
First, we will understand what an Avalanche network is and why it is so special, followed by what AVAX crypto is used for. Then we will understand the working of the Avalanche network. And then we will look into the benefits of the Avalanche network, and at the end, where and how to buy. So first, we will understand what the Avalanche network is. So Avalanche is a blockchain platform that can support smart contracts, and it was introduced in 2020 by Aave Labs. Avalanche focuses on low prices, quick transaction times, and environmental friendliness to create a scalable blockchain system while maintaining decentralization and security. Users can build as many unique and functional blockchains as they want with Avalanche. One must pay a monthly subscription fee to run a blockchain on the Avalanche coin AVAX. But why is Avalanche Network so special? Well, Aave Labs estimates that the platform can process 4,500 transactions per second, compared to about 7 for Bitcoin and 14 for Ethereum. Additionally, it can complete a transaction in less than 3 seconds. Multiple competing platforms will have bottlenecks, making them more suitable for massively scalability decentralized applications. Also, Avalanche is designed to address interoperability, another significant issue currently plaguing blockchain-based systems, and is very scalable. This is accomplished by permitting communication between blockchains within and between subnets, allowing them to complement one another and support cross-chain value transfers. Well, now that we know what an Avalanche network is, let's look at the usage of AVAX crypto. Technically, AVAX, the native token, is a utility token. The currency of the Avalanche ecosystem is AVAX. Well, in other words, the token is utilized as money within the network, generally for rewards, fee collection during transactions, and many other use cases. Additionally, it is employed for staking AVAX, which protects the network. Then, Followers are rewarded with more AVAX, and some users stake AVAX to generate passive revenue on the network. Now let's have a look at the working of the Avalanche network. Avalanche's developers set out to find a solution to some of the typical issues that earlier blockchains like Bitcoin face to advance and improve blockchain technology continuously. Incompatibility, scalability, and usability issues are just a few of these. Now, by utilizing 3 blockchains, Avalanche uses a novel strategy to address these issues. According to time to finality metrics, Avalanche claims to be the fastest smart contracts platform in the blockchain industry. The 3 blockchains that make up the Avalanche mainnet are Xchain. This blockchain is employed for asset management. The Avalanche Consensus Protocol is employed. Then comes C-Chain. To develop smart contracts, this blockchain is used. The Snowman Consensus Protocol is employed. And in the end, it is P-Chain. And this blockchain is utilized to create smart contracts, and the protocol for Snowman Consensus is used. By having all nodes operate concurrently, the Avalanche Consensus Protocol randomly verifies validators' transaction confirmations. The goal is to improve the likelihood that a transaction is true or legitimate by periodically performing random checks. The Snowman Consensus Protocol uses blocks in a linear manner, but otherwise functions similarly. Well, now that we know the basics of the Avalanche network, let's have a look at problems that is solved by this network. Well, as we discussed before, Avalanche was developed to deal with many of the problems that most blockchain networks have. Platforms like Avalanche aim to reduce centralization in the cryptocurrency industry by offering an alternative to networks like Ethereum. Avalanche primarily addresses 2 issues: congestion. Scalability was a purposeful consideration in the creation of Avalanche. Avalanche offers sub-second transaction times on par with top-tier payment processors like PayPal and Visa. With the ability to handle up to 6,500 transactions per second with sub-second finality, Avalanche is incredibly strong and effective. And second is low fees. Avalanche, which many people view as Ethereum's rival, outperforms Ethereum regarding gas costs. Avalanche's fees are significantly less expensive than Ethereum's. The network charges fees for several things, including producing and minting assets, staking, transaction fees, and blockchain development. After these things are done, the fees are burned, permanently lowering the amount of AVAX on the platform. And now let's look at some of the benefits of Avalanche Network. The manner Avalanche was constructed is mostly responsible for its key advantages. The founders of Avalanche discovered a solution to the frequent issues with blockchains by utilizing the network's special design. First on the list is interoperability. The trade of different types of cryptocurrencies and data with other platforms is only supported by a few blockchains. Avalanche makes interoperability possible by enabling several blockchains to exchange information and essentially interoperate with one another. Then it is scalability. For instance, mining Bitcoin uses a lot of power and processing resources, and Ethereum can handle only 15 transactions per second. These restrictions make these blockchains difficult to scale, despite their strength and great value. On the other hand, Avalanche promises sub-second transaction rates and amazing processing capacity and was designed to be expandable. And next is usability. Usability, or how simple it is to use and implement the technology in many applications and use cases, is one of the issues with adopting any technology. Avalanche is gaining popularity in the cryptocurrency world at a rate that can compete with Ethereum and has demonstrated utility in several situations. So, now that we have discussed all the necessary concepts around the Avalanche network, let's see where and how to buy AVAX. These are a few platforms with illustrations of how to buy AVAX on that particular platform. First is Uphold, followed by Binance, and then Bitpanda, and then Gate.io. Hey everyone, we often encounter situations where we feel like buying our own house, but sometimes it becomes a little too expensive, but you buy it anyway. Well, to make that happen, you need to borrow a loan from the bank. So you put up a down payment of 20%, so you can borrow the rest of the 80% from the bank and make the payments. And if you fail to make the payment to the bank, they can easily confiscate the house. Now, what exactly happens is the bank lends you money knowing that you will pay high interest on it. And then the banks give that interest to its lenders, of course, after having their profiting charges. Well, Aave is a cryptocurrency version of that bank.
So why wait? Let's embark on this exhilarating adventure together. But before we dive in, if you're looking to take your career to new heights and become a true expert in the realm of blockchain and cryptocurrency, consider checking out our professional certificate program in blockchain in collaboration with IIT Kanpur. It's an excellent opportunity to master key architectural principles and develop the skills needed to excel in this rapidly growing field.
In this video, you will explore what is Aave, and following that, you will see how exactly Aave came into existence. And then you will see how it works. And after that, you'll see some real-life usages of Aave. And at the end, you will explore whether it is safe or not. But before moving ahead, please do subscribe to our YouTube channel for more such interesting videos. And hit that bell icon so you never miss an update from Simplilearn. Now, moving on to what is Aave. Aave is technically a decentralized application that allows people to lend and borrow cryptocurrencies, all without a middleman, in return for some fees. Aave uses an algorithm to determine the lending rates and match the borrowers with lenders using a smart contract. Smart contracts enable these assets to be managed by a distributed network of computers running its software. And when lenders deposit cryptocurrency into the protocol, it is routed to a liquidity pool, where it is used to meet the demands of the protocol's borrowers. Now, if you're unfamiliar with what a liquidity pool is, you can definitely see our video on liquidity pool, which will be appearing at the top of your screen right now. This means that Aave users do not have to put their trust in a certain institution or individual to manage their money. They merely need to believe that the code will run exactly as intended. Well, now that you know what Aave is, this raises a question of how and why it came into existence. Aave was founded by Stani Kulechov, who was very interested in Ethereum and how it could disrupt traditional finance. In November of 2017, Stani Kulechov and a team of developers released ETHLend in an initial coin offering, or ICO. By letting users publish loan requests and offers, the intention was to enable users to lend and borrow cryptocurrency from one another. Although ETHLend was an innovative concept, the network and its associated token Lend lost popularity once the 2018 bear market began. Lack of liquidity and the difficulty in matching loan requests to offers were the platform's main problems. In 2020, ETHLend revamped its offering and changed its name to Aave, switching from the Lend token to Aave in the process. Aave was redeemable for 100 Lend for every token as part of the migration. And since that movement, the group has received more than $32 million from some of the leading venture capitalists in the blockchain industry, including Blockchain Capital and Standard Crypto. So now that you know the functionality and the motive of Aave, let me take you through the workings of Aave to make you understand how it fulfills its motive. So the first step is to submit Aave request for comment, or ARC. The post should provide all the details of the potentially final AIP when an ARC is submitted on the governance forum. As a result, the community will have the opportunity to offer suggestions for improvement and, if a general consensus can be reached through a community poll, to successfully submit and vote on the AIP. Now, following that, the second step is to create a snapshot. All queries and remarks are addressed after being placed on the governance forum in order to enhance the ARC. To get input from the community and choose the preferred course, a snapshot vote is advised. This quick view enables a general agreement to be reached to increase the likelihood that the AIP submission will succeed. And then comes the last step, which is to submit an Aave request for improvement, or AIP. A GitHub pull request is used to submit the suggestion, and the community decides whether to approve it. Moving on, let me take you through some of the real-life uses of Aave. First is security. Users can stake the Aave ERC20 token to help secure the system and receive compensation in return. Second is collateral. Borrowers who pledge the native token as security for their loans are required to pay lower costs than those who utilize other cryptocurrencies that are locked within the platform. And the third one is DAO. Aave serves as the DAO's governance token and can be used to cast votes on proposals about the addition of additional tokens to the protocol, platform functionality, and other uses. Well, this was all about Aave. But wait, one question remains unanswered. Is Aave safe? Well, Aave, a decentralized money market, paves the path for a more transparent and open financial system. Aave is an intriguing DeFi project that enables transparent access to funds and services for Bitcoin users. Another encouraging advancement is the Aave token. It gives its owners the power to change the Aave protocol. The procedure is additionally safeguarded from black swan situations. So now this was all about Aave. Let's look at the concepts you will be exploring in this topic. First, you will understand what is IOTA. Following that, you will explore what is Tangle in IOTA's Tangle. And then you will come across the working of IOTA and IOTA's architecture. After that, you will see some features of IOTA's Tangle and the impact of IOTA in real life. So, what is IOTA's Tangle? IOTA's Tangle is a distributed ledger that is open, cost-free, and scalable, and is made to facilitate frictionless data and value movement. The IOTA network is the backbone of IoT and is designed for the Internet of Things and has low resource requirements, tamper-proof data, and fee-free microtransactions. The Internet of Everything is a network for exchanging money and data between devices, and this distributed ledger is the first one designed for it. Also, IOTA has no blocks, no miners policy, which means you validate 2 additional transactions when you send an IOTA transaction. And this enables IOTA to get around blockchain's financial and scalability constraints. In short, IOTA is positioned to be a key player in the upcoming industrial revolution by facilitating business interactions between machines and connecting the economies of people and machines. But this raises a question. What does the Tangle stand for in IOTA's Tangle? Well, IOTA's network is called the Tangle. It permanently documents the data and value exchange. It guarantees that the data is reliable and cannot be changed or erased. It's kind of a digital ledger that is replicated on all nodes in an IOTA network. All the data in the Tangle is stored in objects called transactions. And when a transaction is attached to the Tangle, it cannot be changed and is immutable. In short, it contains the current transaction history and is the single source of truth. So now that you know about the basics of IOTA's Tangle, let me take you through the working of it. First, let's make this clear that IOTA is not a blockchain. It's a DAG, which stands for Directed Acyclic Graph. DAG is used to agreeing on all of the transactions inside their Tangle. Though DAGs are similar to blockchain, they are still way faster and can scale better, seeming to be the next evolution of blockchain technology. In IOTA network, each transaction is called a node, which are connected to each other using edges or arcs. Directed stated that the graph has a direction, and the acyclic part states that the graph always continues in one direction and never has a loop. Now, each node will try to point to at least 2 other past nodes, but you can find up to 8. Once that node has 2 other future nodes directed toward it, it will be a confirmed transaction. And this whole network of nodes is called Tangle. And the more people use IOTA, the faster it gets, because you have those 2 nodes pointing towards your transaction faster. But what is IOTA's architecture for those transactions to take place? IOTA's architecture includes the following basic components. Client. Users who send transactions to nodes on the IOTA network, such as wallets, applications, and etc., can join the Tangle. Nodes. Devices that are connected and in charge of maintaining the Tangle's integrity. IOTA is a network made up of these devices. Tangle. The Tangle stores all of its data in objects referred to as transactions. A transaction becomes immutable and unchangeable once it is linked to the Tangle. Well, now that you have understood all the concepts of IOTA's Tangle, let me tell you some unique features of IOTA's Tangle. First, it is highly scalable. Unlike blockchain alternatives, IOTA uses a DAG, or Directed Acyclic Graph data structure, that enables transactions to be added in parallel. Second is fast transactions. IOTA transactions are confirmed within minutes, unlike other cryptocurrencies whose transaction confirmation rates depend on the crowd. Third is low resource requirements. As discussed in this video, IOTA is designed to enable devices to participate in a low-energy network, such as sensors. Fourth is finality within seconds. The approval of genuine messages happens extremely swiftly and effectively. Fifth is zero-fee transaction. As we know, this is the USP of IOTA's Tangle. If it sends 1 cent, it receives 1 cent. And if it sends $1 million, it receives $1 million. And sixth is distributed. IOTA is a globally distributed network that is resilient and robust against attacks. Continuing this, let me take you through the impact of IOTA's Tangle in the real world. First is social impact. The IOTA Foundation encourages the utilization of technology to improve society at large. It focuses on sustainability, harnessing the power of IoT to manage natural resources more efficiently. And identity, introducing digital identity to people beyond borders. And citizen-centric governance to enable more transparent and inclusive governance. Second is global trade. IOTA can make it easier for businesses, governments, logistic companies, and end users to work together while fostering trust. It focuses on track and trace, sharing updates throughout the supply chain with provenance data from the source. Customs and border management. Update trade certifications for international exchange. And digital twins. Turn any product, container, or consignment into a digital twin. And the third one is unifying digital identity. IOTA aims to provide trust between individuals, organizations, and things. It focuses on self-sovereign identity, a borderless digital identity that anyone can verify. The identity of things. Identities to allow devices to prove their authenticity and specifications. Regulatory compliance. Digital identities that meet data privacy regulations like GDPR.
Hey everyone, think of a situation where a person A with headsets wants to get an iPad and a person B wants to get a headset with an iPad. So to reach out to each other easily, they go to a gadget shop and sell their products to that shop and buy the other products, headset for person B and iPad for person A there itself. Well, similar to this gadget shop, Uniswap also serves as a platform where you can exchange Ethereum coin with any Ethereum token just by paying a very small fee and without any intermediaries. Hey everyone, well, in this video, you are going to explore what is Uniswap and what is UNI. Then you will learn about its governance process and how does Uniswap work. Following that, you will know how to use Uniswap and what are the pros and cons of Uniswap. And at last, you will know how to invest in Uniswap. So let's get started with what Uniswap is. Uniswap is a completely different kind of exchange that uses an automatic liquidity protocol, a latest trading methodology that is fully decentralized, meaning it isn't owned and run by a single entity. It enables peer-to-peer market making. Uniswap is also a cryptocurrency whose symbol is UNI. It enables users to trade cryptocurrencies without any involvement with a centralized third party. The Ethereum platform serves as the foundation for the Uniswap blockchain, which is controlled by UNI owners and is completely open source, meaning that anyone can view and contribute to the blockchain's code. Uniswap basically works on supply and demand mechanisms. Let me show you how. On Uniswap, when you exchange your Ethereum, they give you a fair market value of the basic Ethereum token. Now, after you are done, the price of basic Ethereum token rises because there are less of them since you bought it, and price of Ethereum drops because there is more of it since you sold it. Now, Whoever comes next will have to buy the basic Ethereum token at a higher price or sell some Ethereum at a higher price. This is actually done to even out the liquidity pool so that Uniswap has an even amount of Ethereum and the basic Ethereum tokens. So now that you know what Uniswap is, let me take you through what UNI is. Basically, the Uniswap token makes it possible for the community and stakeholders to own and actively manage the protocol by voting on important protocol updates and development projects. Through an on-chain governance process, UNI holders run this protocol. Therefore, anyone can earn UNI by agreeing to not sell or trade their crypto holdings. But this brings the question of what is Uniswap governance process is. So the first step is the temperature check procedure determines whether there is enough motive to change the current situation. A majority vote with a 25k UNI yes vote threshold prevails at the end of the 2 days. Now the subject is closed on the governance side if the temperature check does not suggest that there should be a change from the current situation. Then, if it does suggest any changes, then it is pushed to second step, that is the consensus check. Now, the consensus check procedure develops a formal conversation surrounding a proposal and takes into account feedback from the temperature check. Another off-chain vote follows consensus check, and a majority vote with the 50k UNI yes vote threshold prevails after 5 days. And then comes the last step, that is the governance proposal. The governance process ends with the governance proposal. The proposal comes with an on-chain executable code and should take into account the consensus check suggestions. A delegate must have a minimum balance of 2 million UNI in order to submit an on-chain governance proposal. A majority vote with a 40M UNI yes vote threshold wins after a 7-day voting period. Now that you know the mechanism of the Uniswap platform, let me tell you how it actually works. The Uniswap platform enables the decentralized trade of numerous different digital assets using smart contracts built on the blockchain through liquidity pools which utilize smart contracts to automatically rebalance themselves after each trade. Pairs or digital assets are exchanged. Uniswap is powered by 2 smart contracts, the exchange contract and the factory contract. These are automatic computer programs made to carry out particular tasks when certain criteria are met. In this case, the factory smart contract is used to add new tokens to the platform, while the exchange contract handles all token swaps or trades. On the new Uniswap version 2 platform, any ERC20 based token can be exchanged for another. Well, this covers all the internal functionality of Uniswap. So moving on, you will learn how to use Uniswap. Well, you only need an Ethereum wallet like Coinbase wallet and a small amount of ETH, which you'll need to pay for gas fees in order to utilize Uniswap. You can access app.uniswap.org to begin exchanging tokens or provide liquidity by using the app browser included in the Coinbase wallet mobile application or its desktop browser extension. Moving on, let me tell you about some of its pros and cons. Well, it enables the decentralized exchange of many digital assets, but it only supports the exchange of Ethereum compatible cryptocurrencies. Second, smart contracts enable asset trading that may be cheaper and more efficient, but it still uses proof of work, which is an energy and resource intensive process. Uniswap users can earn UNI by agreeing to not sell or trade their cryptocurrency holdings, but users must own ETH to pay transaction processing fee. Fourth, decentralized governance of the Uniswap platform enables anyone to participate. However, using a decentralized exchange requires a compatible self-hosted wallet. So now comes the most important question of this whole discussion. How can you invest in Uniswap? By getting UNI. You can make an investment in Uniswap using a centralized cryptocurrency exchange like Coinbase or Kraken is the simplest way to purchase UNI. Another coin like Ethereum can be used to buy UNI on the Uniswap platform.
It is Monero.
So, to make you familiar with what Monero is, let me give you the example of Lena. Lena is a journalist in a surveillance heavy country who wants to keep her financial transactions private. She's interested in Bitcoin but knows it's not completely anonymous and could still be traced back to her Bitcoin address. One day, Lena comes across Monero and discovers that Monero is designed to prioritize privacy and security. She decides to use Monero to buy some books from an online bookstore. She sends the payment from her Monero wallet to the provided address, which is completely private and untraceable. The bookstore confirms receipt of the payment and ships her books. Lena is pleased with the privacy and security of Monero and plans to use it for all her future online purchases. Now, if we speak in short, Monero is an open source, privacy oriented digital cryptocurrency that provides users with complete privacy and security when making a transaction. Its blockchain is opaque, which makes transaction details and amounts anonymous by obscuring the addresses used by participants. Lena's story is one just example of how Monero can be used to protect one's financial privacy and security in a world where data is becoming more and more valuable. But what makes Monero so private?
If getting your learning started is half the battle, what if you could do that for free? Visit SkillUp by Simplilearn. Click on the link in the description to know more.
Well, Monero's privacy feature makes it different from other cryptocurrencies. In order to provide privacy and anonymity, Monero relies on two important concepts: stealth addresses and ring signatures. Now, with stealth addresses, a sender can create a unique public address on behalf of the recipient for each transaction. But the recipient can still receive all payments using a single public address, just like in Bitcoin. Monero users will generate both a private view key and a private spend key. The private view key enables them to view all the transactions linked to the account, while the private spend key functions similarly to a Bitcoin private key, as it authorizes payments. Now, talking about ring signatures are a cryptographic concept that pertains to digital signatures. It allows any member of a defined group of individuals with private keys to sign a digital signature. In Monero, when you initiate a transaction, your wallet selects a group of keys from the blockchain and forms a ring. As a result, it is impossible for an observer to determine which key was utilized to sign, providing anonymity to the transaction. Now that you know the basics of Monero, let me take you through the process of mining Monero. Now, Monero is compatible with various operating systems, including Windows, Mac OS, Linux, Android, and FreeBSD. Unlike other cryptocurrencies such as Bitcoin, Monero mining doesn't require specialized hardware like ASICs, which can be really expensive. Instead, you can use the CPU or GPU of a standard computer to mine Monero. Monero utilizes proof of work mining as stated on the company's website. This algorithm is crucial for securing cryptocurrencies such as Monero by preventing issues related to double spending that can actually misrepresent the available supply. Now, let me tell you how one can access Monero. Now, although many exchanges have opted not to offer Monero, there are still places to purchase it. So, if you're in the United States, you can buy Monero on Kraken, Qcoin, or Binance. And another way to get Monero is to purchase it directly from another person on the decentralized peer to peer platform BISC Exchange. Or you can simply use Binance to do the exchanges. First, you will understand what is basic attention token. Following that, the working of BAT. After that, you will understand how to use basic attention token. And then you will learn how you can earn BAT rewards. And at the end, you will see what is basic attention token used for. So without any further ado, let's get started with what is basic attention token. The Ethereum network serves as the foundation for the decentralized open source basic attention token. Digital advertising ecosystem, some of the topics addressed by the project in relation to internet advertising include data security, data ownership, and consumer benefit. Its goal is to create an honest, transparent, and equitable system. Advertisers will be able to target users directly and reward them with tokens for their attention with the help of BAT. In contrast to traditional advertising systems that use personal data to target ads, BAT uses a blockchain based system that allows users to opt into anonymous ad targeting. Users can choose to view relevant advertisements without having their personal information shared with advertisers. BAT prioritizes your privacy and gives you back control over your data. This raises the question of how BAT is able to do this. Well, the Ethereum blockchain serves as the basic attention tokens foundation, as we know. Its creators have collaborated with the Brave browser to implement the innovative advertising strategy. Brave has implemented the basic attention metric or BAM attention measuring system. It uses an anonymous ledger system to distribute money between readers, content creators, and advertisers. In fact, it brings them together for so many reasons. For example, any content creator can publish their post on their website. Now, advertisers offer a certain number of basic attention tokens for ad space on their content. After that, they will reach an agreement based on their attention score on the basis of user engagement. It basically means that ads are more tailored to users and give the advertisers the window of profit, ensuring that Brave users see well-tailored ads while it also improves speed, privacy, and security of the browser. So now that you have understood the functioning of basic attention token, let me tell you how you can use a basic attention token. Now, because payments are made in the form of tokens, there are numerous opportunities for seamless use. The first is to donate them to publisher and other content creator. This could even include providing premium content to donors. These tokens can also be used to purchase digital products such as data services on the Brave platform itself. Now, how exactly to earn these BAT rewards? Now, the first step is to download the Brave browser. You can then sign up for Brave rewards by clicking on the triangle next to the search bar, and then you can now start earning BAT tokens simply by viewing advertisements. Now, advertisements appear as background images, push notification, or cards in your newsfeed, which is the second step. They are not included in videos or pop-ups, making the experience seamless and unobtrusive. So now that you have understood the basics, let me tell you the usage of BAT. First is advertising. The advertiser in this case provides the tokens that will be distributed to those who view their advertisements. Users who choose to participate in BAT rewards are also a part of this advertising ecosystem. They are compensated with tokens for each advertisement they watch, based on the amount of time and attention they devote to it. Second is tipping. Now, BAT makes it simple to express gratitude to your favorite content creators. You can use your tokens to tip internet users such as Twitch streamers, YouTubers, and Twitter users. This fosters a passionate community of users and creators, allowing for the creation of better content. And third is special access. BAT can also be used to allow content creators to create exclusive content for users who tip or pay them. Thus, free and paid content can coexist in a unified ecosystem. This also enables creators to give back to their communities by creating exclusive content for those who actually support them. But before diving right into the list, let's have a quick and crisp understanding of what crypto trading actually means. So, taking a financial on the price direction of individual cryptocurrencies against the dollar or against any other cryptocurrency is what crypto trading is all about. CFDs or contract for difference are a popular way of trading cryptocurrencies because they offer more flexibility, leverage, and the ability to trade both long and short positions. Also, It's essential to consider things like supported assets, fees, payment methods, and security when considering a cryptocurrency trading platform. So, we have also considered these factors to give you a better idea of which platform will be the best for you. So, now that we have a basic idea of what crypto trading is, let's dive into the list of top crypto trading platforms for 2022. The first platform in the list is Coinbase. For many first-time cryptocurrency buyers, Coinbase has become the go-to exchange. The platform has the appearance and feel of an online banking tool which the majority of consumers are already familiar with, making the transfer to crypto investing simple. Coinbase is the finest cryptocurrency exchange overall, as well as the best cryptocurrency exchange for beginners. It supports a huge variety of cryptocurrencies and provide a high level of security. It's also a wonderful alternative for expert traders because it offers an advanced trading platform, Coinbase Pro, in addition to being a beginner-friendly platform. So let's have a look at the account prerequisites for Coinbase. It supports more than 150 plus cryptos for trading with the transaction fee ranging between 0% to 0.60%. Also, the minimum deposit or purchase price should be at least $2. Now, let's have a look at its pros and cons. Coinbase offers a large volume of cryptocurrencies to trade for. It provides smooth experience to beginners as well as offer easy trading to advanced members of it. It also provides liquidity and ease on its platform. Now cons. The customer service provided by them is not up to the mark, as well as Coinbase.com is an institutional account, which means you don't have access to your private keys. Moving on, next we have is Crypto.com. Crypto.com offers a diverse digital asset ecosystem that includes its own blockchain, the Crypto.org, a native token known as CRO, a crypto Visa card, yield-generating crypto products, and more. It was chosen as the top mobile crypto exchange application because it offers a comprehensive digital asset trading and investing environment that you can access from your smartphone. Now, let's have a look at the account prerequisites for Crypto.com. It supports more than 250 plus cryptos for trading with a transaction fee ranging between 0.04% to 0.40%. Also, the minimum deposit or purchase price should be at least $1. Now, let's have a look at its pros and cons. Crypto.com supports a huge range of cryptocurrencies to trade for and other crypto-related services like payments and asset evaluation. Now, moving towards cons, its fees is relatively high. Also, the customer service is a little poor and stagnant. Next in the list we have is Gemini. Gemini stands out as a sign that prioritizes security and compliance. Hot wallet insurance is provided by the New York-based exchange to ensure that user funds are protected in the event of a security compromise. Because it has comprehensive security protocols, ensures customer cash, and is SOC 2 certified. Gemini is the most secure crypto exchange. Now, let's have a look at the account prerequisites for Gemini. It only supports 75 plus cryptos for trading with the transaction fee ranging between 0.99% to 2.99%. Also, it has a minimum deposit or purchase price and it varies according to the asset invested. Now, let's have a look at its pros and cons. Gemini is available in all 50 states of United States with extremely liquid market. All the funds stored in the wallets are perfectly insured and secure. Also, its UI is pretty strong. Coming to its cons, many traders in it have high cost also as compared to other crypto trading platforms. It supports less cryptocurrencies as well. Now moving on to the next platform in the list, we have Binance. The most appealing feature of Binance is its low cost when compared to other exchanges. Beginners will appreciate the simple buy sell option, while professional traders will appreciate the in depth basic and advanced trading platforms. Now let's have a look at the account prerequisites for Binance. It supports more than 500 plus cryptos for trading with a transaction fee ranging between 0.10% to 0.50%. Also, it has no minimum deposit or purchase price of $50. Now, let's have a look at its pros and cons. Binance purchase fees is non-immediate as well as instant. Also, a huge variety of coins is available on its platform. Along with this, it offers various other services. Coming to the cons, once the verification of account was hampered, it is not yet available in United States and its corporate structure is pretty opaque. Next we have is Kraken. Kraken is one of the world's most well-known Bitcoin exchanges. In the early days of the crypto market, it established itself as the go-to site for professional investors. It has retained its image as a trustworthy and professional trading venue. It has some of the lowest fees in the cryptocurrency exchange world. It's also a top pick for experienced traders as it allows leverage and futures trading as well as enables complex order types. Now, let's have a look at the account prerequisites for Kraken. Basically, it supports more than 120 plus cryptos for trading with a small transaction fee ranging between 0.00% to 0.26%. Also, it has minimum deposit or purchase price of minimum $1. Now, let's have a look at its pros and cons. Kraken supports a large range of cryptocurrency with minimum fee and also provide the traders more market liquidity. Coming to the cons, not all states in the US can accept it as options for financing your account are limited. Next in the list, we have Bitstamp. Bitstamp is one of the most cost-effective Bitcoin exchanges. It offers a simple pricing structure that bases your trading fees on your 30-day trading volume. For users with less than $10,000 on Bitstamp, the highest trading cost is merely 0.50%. Bitstamp is a fantastic alternative for fee-conscious crypto investors because its trading fees are lower than those of many of its competitors. Now, let's have a look at its prerequisites. Bitstamp offers only 45 cryptos for trading with a very small transaction fee ranging between 0.00% to 0.50%. Also coming to its minimum deposit or purchase, the price is $10. Now let's have a look at its pros and cons. In terms of trading fees, Bitstamp is one of the top cryptocurrency exchanges. TradeView, a real-time trading platform, is also available. This version contains more extensive charting and trading forms. This platform offers a diverse range of coins, including many of the most popular as well as some lesser-known cryptos. And the cons are, while Bitstamp offers a good selection of cryptocurrencies, there are significant ones that aren't available. Its Bitstamp Make program, which allows you to stake crypto, allows you to earn passive money, but there are a few drawbacks as well. In 2015, hackers were successfully in launching a phishing assault against Bitstamp workers, which resulted in a security breach. Following Bitstamp, we have Bitmart. Bitmart is a global Bitcoin exchange with over 180 locations. Users can purchase, sell, and store over 1,000 different digital currencies and tokens. Investors wishing to add newly launched or obscure crypto assets to their portfolios will likely find what they're searching for on this exchange, as it offers more assets and trading pairs than its market-leading counterparts. Let's have a look at the account prerequisites for Bitmart. Bitmart offers 1,000 plus cryptos for trading with a very small transaction fee that ranges between 0.045% to 0.25%. Also, coming to its minimum deposit or purchase, the price is $30 when purchasing via Bitmart. For spot trading, the price is not published yet. Now, let's have a look at its pros and cons. Bitmart supports a huge variety of cryptocurrency and provide great opportunities to earn cryptocurrency as well. Along with that, it provides an easy trade option for buying and selling cryptocurrencies. Now, moving on to the cons, there was a large-scale hack on this platform in 2021. Also, the customer reviews are average for this application. Moving on, next in our list is KuCoin. KuCoin is a third-party cryptocurrency exchange that lets you buy, sell, and trade a variety of cryptocurrencies. The founder's goal was to provide a simple and secure platform for people all around the world to exchange a variety of digital currency. KuCoin has a large number of cryptocurrencies to choose from and has minimal cost when compared to other cryptocurrency exchanges. Staking, leverage, futures, and peer-to-peer trading are all supported, which may appeal to more experienced users. Now let's have a look at the account prerequisites for KuCoin. So KuCoin offers only up to 28 cryptos for trading with a very small transaction fee ranging between 0.00 to 0.10%. Also coming to its minimal deposit or purchase, the price is merely $5. Now let's have a look at its pros and cons. KuCoin maintains the anonymity of the user while trading, yet it offers secure platform as well. Also, it supports multiple cryptocurrencies. Coming to the cons, the trading volume of cryptocurrencies are pretty low, and also during heavy traffic, it can face some serious issues. Following KuCoin in our list, we have Cash App. Now, individuals in the United States and the United Kingdom can use the Cash App to send, spend, deposit, and invest money. It's essentially a peer-to-peer payment app with an investment component through the Cash App. Users can also invest in stocks, ETFs, and Bitcoin. It enables you to purchase, sell, and store Bitcoin from your smartphone itself in a more simpler and safer manner. Now, looking at its account prerequisites, like we discussed, Cash App is only a Bitcoin exchange application. So it supports only one cryptocurrency, that is Bitcoin. The transaction fee varies depending on the action. Also, the minimum deposit or purchase is just $1. Now let's have a look at its pros and cons. Cash App provides an easy access UI and quick withdrawal from its wallets. Other than this, it also supports Bitcoin Lightning Network. It's a second-layer Bitcoin technology that employs micropayment channels to increase the blockchain's ability to perform transactions more quickly. Moving on to the cons, it only supports Bitcoin. The wallet is always volunteered and it has limits on everything, be it deposits, sales, and other items. So now we have reached a last crypto trading platform in our list, which is BISC. BISC is a peer-to-peer cryptocurrency trading platform that allows individuals from all over the world to trade a variety of digital currencies and tokens. Customers are not required to complete a Know Your Customer or KYC identity verification process, and this trading platform is not restricted to users in specific jurisdictions. It lets users to buy and sell Bitcoin and other cryptocurrencies with a variety of payment options such as bank wire transfers, ACH transfers, and cash deposits as well. Now let's have a look at its prerequisites. BISC currently supports 100 plus cryptocurrencies for transaction with transaction price ranging between 0.10% to 0.70%. And there is no minimal deposit or purchase required. Now moving on to its pros and cons. This BISC application is available throughout the world and anyone can use it. It provides a high-end security and doesn't require any sort of KYC or ID verification. And it provides almost 50 payment options for crypto transactions. Moving on to the cons, the speed of the transactions are pretty low and low trading values are also possible as it doesn't consist of any minimal deposit or purchase. Also, it is not a great option for active trading. And with that, we have reached the end of this captivating video on our cryptocurrency full course. We hope you found it both useful and entertaining. Do give this video a thumbs up and share it with your friends. If you have any questions or need assistance with any of the topics covered in this video, please feel free to ask away in the comment section below. Our team will reach out to you as soon as possible. Thank you for watching and keep learning.
Hi there, if you like this video, subscribe to the Simplilearn YouTube channel and click here to watch similar videos. To nerd up and get certified, click here.